Hello, everyone.
Hello, traders.
Hi.
Hi, guys. Yeah, we are live. Before our first speaker will be speaking and we'll begin our speech, I want to tell you something about our conference. My name is Serzhanovich. I'm founder and CEO of Tradefulness, the organizer of this conference. Today, thousands of traders will open chart, they will analyze pattern, they will calculate probability, they will look for signals. And many of them will still lose money, not because they don't understand market, not because they don't have strategies, but because they don't yet fully understand themselves. And that is exactly why this conference exists. Welcome to the Trading Psychology Conference 2026. Let me start with a simple observation. Trading is one of the very few professions where your greatest competitive advantage is not speed, not technology, not even information. It is self-awareness. Markets are unpredictable. Volatility is unavoidable. Losses are inevitable. But how you react to them, that is where performance is born. Over the years, we've seen incredible technological progress in trading. Algorithms have become faster. Platforms have become smarter. Access to market has become easier than ever before. But something fascinating has happened at the same time. The easier tradings become technically, the harder it's become psychologically. Because when barriers disappear, responsibility appears. Today, traders are not competing only against markets. They are competing against their own fear, their own overconfidence, their own impulsivity, their own fatigue, their own expectations. And very often, the most expensive mistake in trading is not a bad strategy. It is a moment when emotions override process. I'm a mental health coach, and throughout my work with professionals, athletes, and business leaders, I keep seeing the same pattern. Performance collapses not when people don't know what to do, but when they cannot execute what they already know. Trading is execution under pressure. It is decision-making under uncertainty. It is discipline in an environment that constantly invites you to abandon discipline. And that makes trading one of the most psychologically demanding professions in the world. This conference was created to change the conversation, to move trading psychology from something nice to have to something that is structurally to performance. Today, you will hear from some of the world's leading experts. That's true. People who work with professional traders, hedge funds, and high performers across industries. They will share research. They will share tools. They will share real experience from the front lines of performance coaching. And most importantly, they will help you see trading not only as a financial activity, but as a human performance discipline. But I want to invite you to approach this conference in a slightly different way. Don't just listen. Observe yourself while you listen. Notice what ideas resonate with you, what ideas trigger resistance, what insights make you uncomfortable, what insights make you curious. Because growth in trading often begins exactly at that age, between comfort and discomfort. Trading psychology is not about eliminating emotions. It is about learning to trade with emotions without being controlled by them. It is not about becoming perfectly disciplined. It is about building systems that support discipline when motivation disappears. And it is not about becoming fearless. It is about learning how to act wisely while fear is still present. I truly believe the next evolution of trading will not come from better indicators. It will come from better self-regulation, not from predicting markets more accurately, but from managing ourselves more effectively inside uncertainty. Thank you for being here. Thank you for investing time not only in your trading results, but in your professional and personal development. I'd like to thank our speakers, our team, our media partners, Forex24, Earn.eu, and Titan Trades. And now, let's begin the Trading Psychology Conference 2026. And I'd like to introduce our first speaker, my good friend, Desi Liriano, trading coach, head of Cerulean Mind Academy. And Desi will be speaking about journaling. Very simple, journaling. And the topic is journaling, your tool for emotional and strategic insight in trading. Desi, the stage is yours.
Hey, Alex, thank you so much. Everybody, thank you for being here. Glad to be back here again. I was part of last year's conference, which was fantastic. All the speakers were great. Before we get started, so we're going to be going over journaling and how it's going to give us insights into our mindset, our emotional well-being, and our strategy, right? As we go through the conference and the presentation, any questions that you guys have, I encourage you guys to write them down. We're going to have a Q&A session at the end, and then we can go over all the questions then. Cool. So let's get started. A lot of traders that I tend to work with and that I've come across during my time, I always ask them, do you guys journal? And a lot of them say no. And when I ask them why, a lot of them actually don't know what to journal. So I came here today to give you guys pretty much my whole process on how I journal and what we look for and what questions to ask ourselves when we are journaling. Because again, trading is one thing, but we also need to know what's going on under the hood, right? Like what is getting in the way of our performance? What are we needing to work on? And this is going to be a great tool to bring those things to light. Cool. So to get started, what is journaling and why is it important? So journaling is essentially the process of documenting our trades and our decision-making process so we can review what's truly happening in our trading, not what we think may be happening. Remember, we need concrete data to see what's truly happening, not what we're thinking might be happening, what we're guessing. We need actual facts, right? I find a lot of traders think they lose simply because of the market. But in reality, journaling is going to show you the truth. It's going to show you how your execution, your risk management or lack thereof, and emotions are negatively, or what we want, to positively affect our performance and our outcomes. I've always come across this, and even myself, right, when I first started, a lot of traders tend to blame the market, like, oh man, the market was super volatile today, or the market did this to me, or the market did that to me. And to some extent, sure, that can be true, right? Sometimes you're in a position, as some of you may know, Trump may put a tweet out and then it completely goes out of, goes against you, right? You can't really control that. That's understandable. But I find a lot of moments, it's traders making mistakes, but they don't want to put the blame on themselves. They put it onto the market. So it's important that we see what's actually happening so we can make the proper adjustments. Now, journaling our trades is going to be important to help identify patterns with our wins, our losses. It's going to help us refine our strategy and expose emotions and ways of thinking during our trading session, as well as help us build confidence by proving what actually works and what actually doesn't, as I mentioned earlier. And one point that I really want to have stick with you guys is that, remember, journaling is not about being perfect. It's about being honest. I'd imagine that everybody here is human. And as those know, the reality is that we're not perfect as human beings, right? The most we can do is just be honest with ourselves, see what we need to work on or we need to improve, and go from there, right? So don't think of journaling as you trying to be perfect or the perfect trader, because that doesn't exist. It's really just about understanding what's going on with us and what we need to work on to help improve our trading. Now, before I go into the next section, I want to ask you guys a quick question. For those who do journal, or if you don't journal, put it in the chat. You can put a quick little yes, a quick little no. And you can also add in how long you've been trading, just to get some other information for myself. Excellent. Cool. So before this presentation, I ran a small survey asking traders if they journaled, and what they journaled, etc. And from the survey, a little over half of the traders that did participate, they journaled. As we can see, only 54% of the traders that we asked the question to, a little over half of them journaled. And then this, I wasn't really surprised about, at least from my experiences with others and even myself when I first started journaling. Of the ones who did journal, less than half of them journaled their emotions. Now, remember, trading is not just about understanding, cool, is my strategy working? Can I tweak my strategy here, my risk management, my execution? That's just one part of trading, right? The other part is going to be your mindset and how your emotions come into play, right? I'm sure a lot of you have heard the saying like, oh, once you get rid of your emotions in trading, you'll be the best trader or what have you. Remember, we're all human here, right? We're emotional creatures by design. So to me, it would be impossible to not have any emotion, right? It's normal. It's to be expected. That's how our brain was designed, to protect us against danger and other things. So once we journal the emotional side, it can bring things up to us to help us understand, why am I getting emotional when this happens? Why am I reacting in this way? And then once we can understand why we're doing that, it'll be way easier for us to manage ourselves in those moments of trading when those things come up, right? Now, I took just quick little notes on some insights that what I got from the questionnaire, what individuals mentioned. So some insights that journaling gave these traders is overall, it helped them learn what they did wrong and what they needed to improve on. It helped clear up what and why they were feeling certain thoughts and emotions, help fine-tune their strategy and hold themselves accountable. And lastly, it helped them understand themselves more, which I want to speak on in a few moments. And it created space for them to be more patient and trust themselves more. For those who have been journaling, do any of these things resonate with you guys? Has any of these insights happened to you as well as you've journaled? Feel free to put it in the chat. Excellent. Before we continue, I quickly want to share 2 responses that I think is good for you guys to listen or to hear from some traders that filled out the survey. And I'll just say this in their words. So this one trader mentioned, I started journaling about a year ago. Definitely more emotions in my trade, even though I was methodical and managing position size. But I noticed an enormous difference in both my trading, my wins, and my emotions, win or lose, when I started sizing for zero. For those who don't know what sizing for zero means, that simply just means, let's say you put $1,000 in a trade and you don't want to lose more than $200, which would be 20% loss. Instead of doing that, this trader just puts $200 in the trade, and then, it does whatever it's going to do. So he continued with, managing my trading style and emotions have been 1,000 times easier and no longer hold space or clouds my judgment. And I certainly do not have the anxiety like I used to while trading. This is fantastic, right? So we can see with this trader that by journaling and, with his emotions and refining his strategy and the way he approaches the market from a risk standpoint, it's helped him lower his anxiety and any emotional process that comes up, which causes him to sabotage his trades, right? Another trader said, journaling has helped me understand me in a way. I have learned to trust myself by not jumping to conclusions. I have become more patient waiting on my setups. My losses have become small. I am more relaxed during my mornings. By journaling daily and weekly, I can adjust my mistakes and mindset. This is fantastic and super important, what he mentioned at the end. He journals daily and weekly. It's extremely important for us to journal on a consistent basis because we want to see real time, what is happening right now. What is a pattern that is starting to creep up on us that may be affecting us in a negative way? Or what are some good habits that we're doing that is helping us with our performance, right? You don't want to get into the habit of like, oh, I'll trade on Monday and then I won't trade until next Tuesday. Because during that time, something may happen that you're not actually fully aware of because you're not keeping notes, right? Let's say on Monday you followed all your rules, and then the next 3-4 days you started breaking your rules, right? Maybe you started getting up later and not you finishing your full morning routine. Maybe you started over leveraging again. Maybe you started being less patient to get into your trades. So by actively journaling on a daily and weekly basis, we can see real time what's going on so we can make the appropriate adjustments as soon as possible. One last thing I want to touch on is how he mentioned that journaling has helped understand themselves in a way. This is great because journaling, I believe, is about discovering yourself and about learning what works best for you, right? We all trade different trading styles. We all trade in many different ways, but we need to find out what works best for us, right? For example, I haven't used volume and let's say the VWAP indicator in about 3, probably 4 years now. But I know traders who do use that. But for the way that I trade, it doesn't really do anything for me, right? But for them, they need it for the way that they trade. So by journaling, we can discover what type of trader we are. We can discover what works best for us, right? And of course, everybody has different lives, different schedules. Some have families, some don't. So it's really about discovering ultimately what system you need to put in place for yourself, which journaling is going to help with. Let's continue. Actually, before I continue to the next part, has this been anybody? Has trading and has journaling helped you understand yourself more as a trader and what works best for you guys? Let me know in the chat. Excellent. Loving the responses. So let's get to the meat of the presentation. A lot of traders, when they come to me, as I mentioned earlier, they don't really know what to journal. They always hear like, oh, you should journal your trades and keep data. But it's like, all right, what do I write? Right? So this is pretty much everything that I ask myself. For those in here or watching the recording, there may be other things that you need to ask yourself depending on your trading journey or where you're at. So we'll start on the left with the daily review. Now, for those who may use like online trading journals, a lot of this information is just going to automatically get collected. But for those who may use a spreadsheet, or for those who may be using, let's say, like a notebook, which, to be honest, I used to, and then I got lazy, and then I started using an online one to just input all my information. I'm human, right? So starting from the very top, number one, the date and the day, right? We need to find out what day helps or what day are we making the most money at, what day are we losing the most money at, and then seeing any patterns that can come up from there, right? I'll give you guys an example from myself. When I started journaling and collecting more data, I noticed that on Wednesdays and Thursdays, and usually into Friday, I would usually be red Wednesday and Thursday. And after I started looking at all my information, all my notes that I would write down, it's like, all right, why is this the case? And I've noticed that during those days, I used to trade, let's say, about anywhere between 5 to 6 hours a day. And for me personally, doing that 2 days in a row back to back made me a little mentally fatigued. So when Wednesday came about, I wasn't at my peak, right? I wasn't 100% focused, which made me more susceptible to make more mistakes, right? So by understanding this, I actually ended up just lowering the time that I spend on the charts to about 3-4 hours maximum. Right now, it's about 3.5 hours. I don't spend any more than that in a day. Anything more than that, my brain gets fried, and it's going to be a little challenging for me the following days. So definitely keep track of each day and if you're making money or not and why that may be. Another reason why we want to keep this data is because, let's say there's for specific events, right? Let's say the FOMC event when Jerome Powell and the FOMC board decide what's going to happen with interest rates. If you find yourself losing money on that day consistently, you may want to simply just remove it from your trading schedule. So every time that day comes around, based on your previous data, you see that you're ending red, just eliminate it, right? It doesn't make sense to just get on that day just because. The data clearly says that we're ending red most of the time, so let's just get rid of it. And then, of course, number 2, if we made money or not, pretty straightforward there. One thing that I want to make a quick note of, this happened to me in the beginning, and I've come across other traders who happened to them. They only journaled when they made money, but they didn't journal when they lost money. Remember, I get it. It sucks to lose money. Nobody wants to lose money. But again, journaling is about being honest with ourselves. So we need to keep track of every day that we're making money and every day that we're losing money and see what happened and why. Was it simply because we were on the other side of probability and the trade just didn't work out? Or was it because something that we're doing, right, that's affecting the results? The number 3 on the daily side, the ticker and instrument that you traded. Very important. We need to understand where most of our money is coming from, right? I've pretty much traded everything. I started with penny stocks, crypto, forex, futures, options, all that stuff. I mainly trade options and futures now, and I'll dabble here and there in the other instruments. But for the most part, options and futures is where most of my money comes from. So I just stick to that. Now, for other people, they excel in trading, forex, penny stocks, so on and so forth. So we need to figure out what's working best for us and go from there. The ticker is also important because we need to understand, based on what we're trading, the instrument, what helps us the most, right? To give a quick example, I know traders who trade SPY and I know traders who trade SPX. For those who trade options on SPX, you know how volatile that is. So for some traders who I've worked with that trade SPX and they don't do well with it, I'm like, well, clearly this ticker is not working for you. So we should do something else, maybe SPY, or based on your other trades, we can focus on this, right? So definitely important to keep this information handy. Ooh, we got a question in the chat. Andre, I've been trading for a little over 5 years, 5.5 years now. When I first started, I didn't journal at all in the beginning of my trading career. I didn't even know that we had to do this. I kind of learned that, I think, about 1.5 years, almost 2 years into my trading career. Because I've always heard like some other traders as I watch videos on YouTube, like, oh, journal all your trades. I'm like, journal my trades for what? And then once I started to understand why we needed to do that, I started doing it consistently. Great question. Number 4. So the time of trade. This was super helpful for me because it helped me understand, all right, when am I making most of my money? I usually trade the New York session. For those who don't know, that's 9:30 a.m. Eastern to 4 p.m. Eastern time. So I've noticed that I made most of my money in the morning time, and then in the afternoon, I sometimes made money, but most of the time I gave money back in the afternoon. So once I saw this pattern, I'm like, all right, clearly, if I did not trade in the afternoon, I'd be making a lot more money than I am now, or at least not giving my money back. So I completely eliminated the afternoon trading, and I only trade the first half of the day, and that's fine with me. Sometimes more is not better. Number 5, the time frame that the trade was taken. This was helpful for me because it helped me understand what time frames works best for my trading style and the way that I trade, right? I tend to not use anything under the 5-minute time frame. To me, it's just too much noise and it just overwhelms me, right? I know traders who love the 1 minute, even the 30-second. I don't know how they do it, but they make it work, right? So definitely keep track of this so you can understand which time frames work best for you and the strategy that you're using. And then, of course, number 6, what's the reason for taking the trade, right? What was the idea behind it? Were all the parameters set up according? Were all the criteria that you need there? Did you maybe just FOMO into the trade, right? What was the idea behind it? So that way we can keep track of any bad habits that we may be exhibiting that need to be corrected. Excellent. So, quick question in the chat. What do you see as most common insights for recording tools, pen and paper, digital? Great question. We'll go off the survey since I actually asked people this. So 50% of the traders who did this survey, they use a notebook, so pen and paper. Spreadsheet, about 12%, and like an online or digital trading journal, about 37% of individuals use that. Again, I just prefer to use an online tool just because once I upload my trade log, it just plops in all the data. Then all I have to do is put in my screenshot of the trade, my notes, and then I can call it a day. Great question. Number 7. So this is a big one that I see a lot of traders not add during their journaling process, and myself included when I first started out. Our emotions and how we felt before, after, and during the trade, right? Remember, we need to understand our state of being during the trading process to find any blind spots that may be coming up. So to give you guys an example, let's say you're trading with your friends, or you're like in a Discord group or a trading group, whatever it may be. And let's say you haven't traded that day as a scenario. You started seeing everybody in the chat like, oh man, I'm making this much money. Oh, this trade is great. I'm doing this, I'm doing that. And you're like, oh man, I want to make money too. I haven't taken anything. So before you got into the trade, you were feeling a little FOMO, right? So what do you end up doing? Because you were feeling FOMO, you jumped into that trade. And then during the trade, what's something you may have felt? Maybe a little unsure, a little anxious, because it's not really a proper trade, right? You may not even know when you're going to get out. You may not know where your stop loss or your take profit is. So you may not even be confident in the trade. And then what happens afterwards? Let's say in this scenario, you lose the trade. And after you lose the trade, you might get upset. That upset might turn into anger. You might want to get back at the market and revenge trade. And then you go into the spiral of just going on tilt and then trading off emotions and then losing money, or even at the worst, blowing an account, right? So it's very, very important that you collect the data regarding how you're feeling during, before, and after the trading process. That way we can see what's going on with us, right? And what needs to be adjusted. So maybe for that scenario and that individual, when they notice that, and that's a common theme, they might want to just not be in trading groups or chats while they're trading, because this is something that continues to happen to them. Quick little note. I know for some individuals, it may be a little challenging, depending on how they trade, to take notes or journal during their trading session. I personally journal after my trading session, but you can keep like quick little notes, right? Like let's say trade number 1, and just quick little bullet points, not like try to do too much if it takes too much away from your trading session. So do the best you can. In the beginning, I recorded myself as well to notice certain things. So you may want to try that as well if you don't want to like actively take notes, and then say your ideas and thoughts out loud. That was a big help for me. Excellent. So, so far, all of this making sense to you guys? Anything here that you guys have not journaled that you're going to start incorporating that we've gone over so far? Good. So, number 8, what type of trade did we take? Right? Was it a reversal trade? Was it a breakout, scalp, day trade, swing trade, so on and so forth? This was extremely helpful for me because it helped me understand, what do I prefer or what works best for me? And what I've noticed is that usually when I'm trading, I prefer to get in on reversals rather, let's say, like a continuation or a scalp trade and things like that. I did scalp in the beginning, but based on my results, let's say if I took 10 trades, 4 of them being scalps, the rest being reversals, out of the scalps, I might win like 1 out of the 4, right? So once I saw that data that it wasn't really helping me, I just completely eliminated scalp trading, and then I just focused on reversals and such, right? The same thing for, let's say, day trading or swing trading. I know traders who only swing trade, and I also know others who only day trade, and that's what works for them. So always label your trade type. That way you can figure out, all right, is this actually working for me or is it not working for me? And then lastly, of course, what did we learn that day? What was the biggest thing that stood out to us? What's something that we need to work on, right? And even one thing that I quickly want to go over is when it comes to the thought process and mindset about trading, we need to collect as much data as we can, even if you might think it's not relevant. And I'll give you a story for me. So when I first started, I won't say too much to have some privacy, but my dad is really old school, right? He's like old school businessman. You go to school, and by going to school, you make a lot of money, X, Y, and Z, right? So when I started trading, he's like, "Oh, son, you should go back to school and finish your master's or whatever, and then you'll make a lot of money." But I'm like, "Hey, like this thing here is working as well, right?" But every time I would bring trading up, it would go right back to, "Oh, go to school, do this, do that, X, Y, and Z," right? And subconsciously, what ended up happening is I started noticing that every time that I traded after I spoke with him and then we would have that conversation, I would always end red. And it wasn't until I started seeing that pattern come up in my journal entries that I realized that subconsciously, to an extent, it felt like I didn't either deserve or I subconsciously I was executing based on that thought process that you can't make a lot of money trading, right? So it wasn't until I put that together that I was like, hey, if I bring this up, just be a little more supportive. And we've gone through this conversation a billion times. Cool, go to school, make money, X, Y, Z. But, these are the results from my trading. And clearly I'm doing well, right? So don't take any conversation you have with people for granted. It can always affect your trading, even if you don't think it is, right? Like the one that I had with my father. So always keep track of everything in and outside of trading, because those are big things that can get in the way. Cool. Next, let's go over the weekly review. So for the weekly review, I usually do these on Saturday, not on Friday, because I already did the daily review on Friday, and then I kind of just want to take the rest of the day off on the mental note. But again, do the best that you can when it comes to this. So for the weekly review, how was your performance that week? What worked? What didn't work? And one thing that I want to note about the word performance, don't tie your performance to if you made money or not, because you cannot control that when it comes to trading. The market determines if you're going to make money or not on that trade, right? So look at your performance in a different aspect of, did I follow all my rules? Did I wait for all my criteria for the setup to appear before I got in? Did I not FOMO? Was I patient? Right? That's how we should judge our performance, based on if we followed the trading plan or not. Because again, you can have a 90% win rate setup, but there's still 10% that it might fail, right? So always keep that in mind. Number 2, which setups performed the best this week? I have several setups that I go cycle between, depending what comes up or what doesn't. So I like to keep track of that, just to understand, are some being affected by the volatility in the market? Do I maybe need to put that one on the back burner and just wait until things relax, or what, right? Number 3, what was your best day? What was your worst day? And what made them your best day, or what made them your worst day? Was your best day, and let's say your worst day, due to just the market being the market? Did you, let's say for your best day, did you follow your full trading plan and then, properly manage the trade, not getting out early, so on and so forth? And maybe you had a bad day, right? Was that because the market was simply not on your side? Did you over leverage? Did you not even have a stop loss? Did you break any rules? Things like that. So we can know, as I mentioned earlier, on a real-time basis, what's going on with us, so we can adjust appropriately. Number 4, I have this because this was a huge thing for me in the beginning when I started trading, that I FOMO or jump into trades early. Sometimes, or not even sometimes, a good amount of the time in the beginning, let's say I have 4 pieces of criteria for my setup. I would wait until 3 are there, and I'll be, it's okay. I don't need the 4th one. And then I'll jump in and lose the trade, right? Because I needed that 4th piece of confluence to be present for me to properly get into the trade. So by FOMOing in or jumping into my trades early and not having patience, it affected me in a negative way, right? Has this happened to anybody? Jumped into a trade early thinking it was going to win, even though everything wasn't there? Many times. Yep. We're all human, right? Perfectly normal. But the biggest thing is to adjust, right? And improve. And then, of course, number 5 kind of ties in with number 4. Did you practice patience, right? In the beginning, I was like super anxious and like, oh man, I got to get into a trade now. I got to get off it within an hour for X, Y, and Z reason. But now it gets easier over time, right? As you practice patience more, because you understand, hey, the market isn't going anywhere. There's going to be opportunities every single week. So if I don't get a trade today, that's okay. Tomorrow's another day. And the more you, let's say, work out this muscle, the better it's going to be. So now if I get on a trading day and I just sit around for 2 hours and nothing happens, it's fine, right? It doesn't bother me as it used to in the past. It's just part of trading, right? Sometimes there might not even be a setup, and we need to be okay with that. Trading is not like our regular job where no matter what, we're going to get paid that day, right? For trading, you can sit there for 3 hours and literally nothing can happen. And you need to shift that mindset, as I like to call it, like the trader's brain, right? The trader's brain understands that if there is no setup that day, that's perfectly fine. But if we come into it with our working brain or our human brain, we're like, whoa, I've been here for 3 hours. I need to leave here with something, right? Far from the truth. We don't need to take anything if it's not present. Number 6, did I manage my trade instead of letting it play out? And what I mean by manage my trade instead of letting it play out, this is in a negative sense. Because what I used to do is I would get into a trade, and let's say it didn't even hit my stop loss or take profit, and I'm already moving things, like either moving my take profit level to be a little closer to, let's say, moving my stop loss up or adjusting the trade in some type of way. So keep track of that. That way we can adjust any bad behavior or bad practices that we have in our trading. Remember, you can't get proper data if you're managing the setup and managing the trade before it even pans out, right? You're going to get skewed data, and we want as accurate as possible information as we can. We have a quick question in the chat. What would you do when you freeze from taking good trades after multiple losses? Do you mean in the sense of, Lola, let's say you took 5 trades and the last 4 trades were losers back to back to back? Like, do you mean like getting a little anxious or nervous before getting into the trade? Gotcha. So when that would happen to me, you can do several things. You can take a day or two off just to kind of reset your mind, because if you keep on trying to attack it every single day back to back to back, that can kill your confidence. So when that would happen to me, I would take a day or two off just to clear my mind. What you can also do is lower your position size to just get some wins under your belt, to just get the confidence back, and then just continue as normal, right? Another thing is, if you tend to freeze or get like analysis paralysis, it's good to talk yourself through that, right? Like, let's say if you're like, give life to whatever it is that you're feeling or you're thinking. So instead of keeping it internalized, you can say, all right, and say it out loud. I'm feeling anxious. Why am I feeling anxious? Well, I'm feeling anxious because I've been losing a lot of trades and I don't want to lose this next one. All right. Well, let's keep the thought process going and change it to a positive light. Well, if I'm nervous because I've been losing some trades and I'm nervous that the next one will lose, let's say if this setup has a 70% win rate, for the sake of the conversation or what have you, let's look at it from a trader's perspective, right? I feel nervous, I feel anxious, but I know that as a trader, this is part of the process, right? So the other ones may have lost 3 times in a row, but I don't know if this next one is. So I'm going to take this trade, and whatever happens, I'll be okay with, right? So it's good to talk yourself through those moments, especially when you feel stuck or feel frozen, as you mentioned, just to give it life and start thinking on a more logical level, as opposed to just keeping it internal and then just having all these emotional thoughts all over the place. That helps me. Cool. Let's see. Do I track specific details about my setups? Yeah. Slav, I pretty much track everything. The time frame I take it on, the time that it appears at, the average risk reward on it, pretty much everything, as much as I can. We can talk about it in a few moments so we don't run out of time. Cool. Number 7, we got 3 more. Did I follow, and this is kind of tied into number 6. Did I follow my trading plan as I mapped it out? If not, why? Similar to number 6, let's say if I didn't follow my trading plan, why didn't I follow my trading plan? Did I get nervous that the market might take the green that I had? So I ended up just moving my stop loss up in profit, or I just took the trade off completely before it even hit the first target, or whatever it may have been. Was I speaking to somebody? Was I distracted? Like, what happened on why I did not follow my trading plan? Number 8, did I increase my risk, or did I lower my risk, and why? Some quick examples here. Did I lower my risk because I didn't feel confident in a specific trade? Did I lower my risk because I was losing a bunch of trades in a row? What exactly is happening there? I'll give you guys a quick little example when it comes to the number 8. An analogy I like to use is, if I'm about to get into a trade and I'm not confident in it, and because I don't have the confidence, I'm lowering my risk, to me, that's just a trade that I shouldn't be taking at all. Let's say if we're crossing the street. For anybody who may be from New York, like I am, we jaywalk a lot in New York, right? But when we're crossing the street, we're going to look both ways to make sure that no cars are going to come to hit us, right? Same thing in trading. If you're not fully confident that, and let me not say confident that the trade is going to win, because no matter how confident you are, the trade still may fail. But we at least want all of our pieces of confluence and criteria to be present, right? So if all of that is not present and something's missing, it's best to not even just take the trade, right? So when we're crossing the street, make sure that you're not going to get hit by a car, and then we can go. So tying this back into number 8, if I'm not even confident in the trade, and because of that, I'm just lowering my risk, I'd rather just not even bother taking the trade and just skip it and then see what's going on there. I might need to pull back, take a day off, clear my mind. Something's happening. Lastly, what can I improve or work on for the next week? Remember, we need to hold ourselves accountable and always be looking to improve on what we're doing, right? Maybe we need to work on our patience. Maybe we need to work on not getting distracted, whether it be by a group, our family, whatever it may be. I tell my family, hey, from this time to this time, my phone is on do not disturb, so nothing is going to come through. Unless it's an emergency, don't call me, right? Because I'm pretty much focused. For those who don't trade, I'm pretty sure that y'all may know, they think we're just sitting in front of a computer looking at green and red bars all day. But with trading, we need that focus, right? So very important to set goals for yourself on what you need to improve and work on moving forward to help your trading. Cool. So pretty much it for the meat of the presentation. Any insights here that you guys are going to take with you to continue with your journaling before we continue to the next session? Many. Excellent. Cool. So,
thank you so much. Thank you so much, Desi. A lot of discussions in our chat, and your speech was very interesting and created a lot of thoughts like to think over. I have some question to you. So the first question is, so people are lazy. So the majority of people are lazy. The majority of traders are lazy. Is it possible to make journaling as simple as possible for those people who are very lazy?
I'll meet them halfway in this one. So to me, I think you should not be lazy when it comes to trading, because you want to treat this as a business, right? You don't want to you don't want to approach it in like a halfway point, right? You want to go full into it. If you own a business and you own a restaurant, you need to collect data on what people are eating, right? You're not going to be like, oh, well, I think people are buying this or I think people are eating that. You need to collect everything, right? So treat trading as a business. If you are lazy and don't want to go through the full process, I'd say just keep information that's pertinent to you, right? You don't need to write like an essay every time you journal. It can be just quick little points. Hey, I felt this. This didn't work. All right, cool. Why did it not work? X, Y, and Z. So again, doesn't have to be a whole essay, but just write enough that it helps you.
Mm-hmm. Okay, thank you so much. So we have a lot of questions about the tools. So could you recommend any tools to journal? Any online journals or something you use personally and your students use?
I've personally been using TraderSync for maybe 3-4 years. It just has what I need. I know there's like, of course, the Tradefulness. There's also, I think, TradeZilla that I hear about as well. My students that I work with, it's half and half. A lot of them just use like either still use notebooks, some still use just spreadsheets, and some use online trading journals. Some just prefer the writing aspect of it because they want to spend as much time as they can with it without like, screen distraction. But those are some that I use are really just the TraderSync. Just upload, write my notes, screenshot, call it a day.
Okay. Any ideas about AI? Can AI replace journals, and can AI make this journaling process easier?
I definitely think it can, because AI, at least I actually used it maybe like once or twice, and I was like, oh, this is interesting. I'm like, hey, in the last 4 years of data that I've input here, what's a common theme? And then I was like, all right, this specific day during this specific time, you tend to not perform best. And I'm like, I wonder why. So I went back through all those days and pretty much found that, as I mentioned before, it's like, if I trade too much, it makes me a little more mentally fatigued. So with AI, I think it's definitely helpful to just collect as much data, because realistically, am I going to go through 4 years of data on a day-by-day basis? Definitely not. So AI can help us with the collection of the data to just streamline it and make it a lot faster and easier for us to see what may be going on.
Okay. And there is another question. So speaking about your students, about people you asked in the questionnaire, so is there any differences in the psychological outcomes between traders who journal daily versus those who journal only after significant trades?
Yeah, I definitely say so. From what I've seen is those who trade or those who journal like on a consistent basis, they can keep track of what's going on, and then, we just talk about it as quick as we can. For those who don't journal consistently, or maybe like, oh, cool, I made a lot of money today, let me journal. They're not fully aware of what's going on a daily basis. Like I'll ask them, hey, based on the last 2 weeks, what was a common theme that was happening on why you were losing so many days? They're like, oh, well, I'm not sure. And it's like, well, that's a question that we need to know, right? You need to understand why your performance wasn't the best that week, right? You need to understand what mistakes you were making or what maybe you just weren't doing to begin with to give you the success that you're looking for.
Thank you so much. That's it with the questions. Thank you so much, Desi, for your speech. It was very interesting, and it's much more important. It's very useful for the traders. Thank you for joining us, guys. So we are going to a little break, just 5 minutes, and after that there will be a Q&A session with Dr. Brett Steenbarger.
Excellent. Thank you, Alex. Thank you, everybody, for your questions and participating. I'll see you guys. Enjoy your day.
Oh, sorry.
There
I'm
you
so
go.
excited, and that's why my microphone is muted. So it's a real pleasure and a true honor for me to introduce our next guest. Dr. Brett Steenbarger is one of the most respected and influential voices in trading psychology. For decades, he has worked closely with professional traders and hedge funds, helping them improve performance, decision-making, and emotional discipline. Dr. Steenbarger is the author of several highly influential books, including Psychology of Trading, Enhancing Traders' Performance, Trading Psychology 2.0, and The Daily Trading Coach. His books and research have shaped how many traders and performance coaches understand psychology in financial markets today. Personally, I want to say that Dr. Brett has had a strong influence on my own professional development and the philosophy behind Tradefulness. So having him here with us today is truly special. Brett, thank you so much for joining us today. It's a great honor to have you here.
Well, it's a great honor to be here, Alex, and thank you very much for having me. I'm looking forward to the Q&A and talking about some important things in trading and in trading psychology.
Thank you so much. Yeah, we will have a Q&A session, guys. All the audience, if you have any questions to Dr. Brett, please put them in our chat. And let's begin our conversation. I want to start with a question about your experience. You've been worked with traders for decades. Did you calculate how many traders have you helped? So do you remember some of them or all of them?
Yes, I've worked at a number of trading firms. I don't work with individual traders, retail traders, and my work is exclusively with hedge funds and with proprietary trading firms. And so, yes, over the years, I've worked with quite a few people, and I do remember them, and every so often they get back to me and they ask questions, and we talk about things. In fact, someone I worked with at my first hedge fund and I were just talking earlier this morning. So it's wonderful keeping up with people. But to me, the real joy is not being someone's coach. It's teaching them to coach themselves. Mm-hmm. And so I am happy when a trader, a portfolio manager is managing themselves really well, and I'm always available to them, but they don't need to be meeting with me, every week and every month. That to me is real success at being a coach.
Okay, yeah, it is one of the core ideas of your books is to grow the coach in the trader's mind, right? So how is it possible to grow the coach inside?
Yes. Well, this is probably a good opportunity to mention the book that I have coming out at the end of this month called Positive Trading Psychology. And it's an application of what's known as positive psychology to the world of trading. Positive psychology is something I teach at the medical school in Syracuse, New York. I've taught at the medical school for many, many years. And in the curriculum, we teach not only about the things that go wrong with people, like emotional disorders and mental illnesses, but people's strengths, what they do well, what they are really good at. So in positive trading psychology, I help people identify, what do you do well in the markets? Because it turns out that the best coaching is not just correcting your mistakes, but understanding what you do right, understanding what you do well, and then doing more and more and more of it.
Okay, yeah, that's one of the idea you are emphasizing all across your books. So it's better to develop the strengths rather than only fix weaknesses, right?
Yes, and that's really the question is, what do you do well as a trader? Trading is like any performance activity. It's based on our talents. Those are our inborn abilities, the skills we develop, and our mindset. Many, many, many times, people have trouble trading. They run into trading problems because they might have the talents, but they don't develop the necessary skills. And so they put their money at risk, and that creates stress. And then they have emotional issues, and they think that solving their emotional issues is going to help them be successful in trading. No, they need to learn the basic skills of managing money.
Okay, yeah. So, and in one of the recent interviews, you told that actually controlling emotion and controlling behavior, it's a kind of the beginning level of the trading psychology, and the more advanced level is to develop your cognitive skills and develop your brain. Why did you say it? So, what is the main idea under this thought?
Yeah, people have emotional issues in trading like fear and greed and FOMO and all those things. They have those issues because they're trading well before they should be trading. They're trading before they've developed the necessary skills and experience. And so just correcting those negatives doesn't give them the experience and the skills that they need. Look at any performance field, look at in athletics, look in the performing arts. In every single performance field, a person develops the skills and a mindset for success through mentoring. No one becomes an Olympic athlete by themselves, working out in their own home gym. Like, that doesn't happen. No one becomes a world-class opera singer just by sitting at home and singing to themselves. We need mentoring, and the mentoring teaches us the skills. And when we learn the skills, then we gain confidence, we gain a sense of mastery, and that creates the right mindset.
True. Agree. Absolutely agree. So, speaking about your experience, getting back to your experience, if we compare the current traders and the traders 10 or 12, 20 or 30 years ago, is there any difference in their psychological skills, in their mindset or something? Do you see this?
Yes. Now, again, realize that I'm working with people in across different financial markets. Yeah. But the financial markets themselves have changed over the years. And that has created changes in how markets trade. And that has proven challenging to our mindsets. So, for example, economies and markets are much more connected now than in the past. Look at what we're seeing right now as we speak, with the relative strength in a number of commodities markets and how that's filtered through to commodity-related stocks in the US. Energy stocks like those in XLE, raw material stocks such as in the sector XLB. So you have global themes, in this case related to AI development, that are filtering through to individual sectors and companies quickly in ways that didn't happen years and years ago. And it creates new patterns in markets and new challenges.
You mentioned AI. So there are a lot of AI mechanisms, a lot of AI features now. So don't you think that AI machines can replace the human traders? that it will ever become?
Well, that's been debated for years and years, not just with AI, but with algorithmic trading in general. And algorithmic trading is big. There are many funds that manage a lot of money that are trading algorithmically. And I think the same thing will be true with respect to AI. The question is, can an AI-based platform innovate in the same way that a skilled human trader or portfolio manager could? And so what I see now is that AI is helping implementation. The individual trader or portfolio manager is coming up with new ideas, new approaches, and the AI is helpful in coding all of that and implementing all of that. So it's a partnership. Could we get to the day where the AI does the creative work itself and traders and portfolio managers aren't needed? Haven't seen it yet, but clearly it's much more a part of trading process than anyone envisioned even just a couple of years ago.
And okay, as a continuation of this question, so what should the human traders, the retail traders, develop in themselves to stay competitive, comparing with the algorithms, with the possible AI instruments? What do you think?
Yes. The individual traders need to be able to test their ideas, and they may not be 100% quantitative, but drawing shapes on a chart is not going to be the way to achieve success in the future going forward. The way the individual trader can succeed is by understanding what moves markets. And what moves markets is what gets the big institutions involved. They have the capital to be able to move markets, whether they're commodity markets, rates markets, stock markets, et cetera. And so if they can understand how the big institutions behave, they can be flexible enough to jump ahead of that or early on and ride those movements. That would be very useful. And a great tool or a great benefit that I think a trading coach can offer is helping individual traders understand how the bigger marketplace works with all the institutions and what they do and how they think.
Okay. And AI can help in this, just to help in analyzing all the information, all the volumes of information that traders have, right? But there is another question. So another problem, the situation of information abundance, because we have 24/7 financial news. Some of the instruments are trading constantly, such instruments as the cryptocurrency, for example. And that causes a lot of cases of burning out between traders. So how to manage the information correctly, not to burn out?
Yeah, so the issue is what information is relevant to your trading. And clearly there's a lot of news that really doesn't impact markets on a day in, day out basis. It really depends on how a trader trades. There are traders who are looking for moves in the markets based on economic data releases or based on changes in economic policy from the global central banks. And they are like event traders. When a big piece of news comes out, they want to understand it quickly and participate in the move that occurs. There are other traders who are not really trading those kind of news-based events. They're trading, as I mentioned before, the patterns from other larger traders. So they commonly are looking at patterns of volume and patterns of volatility, and they're detecting changes in those and then quickly acting upon those. So that's not so much news, that's really tracking market data on a very short time frame to understand what participants are doing.
So your advice is to be selective to the information the trader consume, right?
Yes, and to have a specific strategy that draws upon the right kind of information to help you make decisions. Just hearing a headline itself, there's no edge to that.
Okay, thank you so much. Let's get to the topic of your work with the hedge funds, because we have a question in the chat. So, Brett, is it worth it for retail investor to analyze data like hedge funds do, or is it a waste of effort? What do you think?
Maybe you could rephrase the question. Are they asking if individual traders should process information the way that hedge funds do?
Yeah, right.
Yeah. I think there is some advantage to doing that. Now, it depends on the hedge fund strategy. So there are hedge fund managers that actually go to meetings of management of different companies and will listen to presentations, they'll talk with management, and they'll make decisions based on what they're hearing. Clearly, an individual trader can't do that. But what hedge fund managers do is they look at themes in markets and what themes are dominating and how can they shift their money to themes that are popular, themes that are moving, stocks or bonds or so forth. And that, yes, the individual trader can very much learn and understand themes and benefit from those. On my blog, Trader Feed, TraderFeed, Trader Feed, I've outlined sector-related themes in U.S. equities by looking at the breadth of the overall market. How many stocks are up, how many stocks are down, how many stocks are making new highs, how many stocks are making new lows, but then looking at breadth sector by sector. So you're looking at communication stocks. How many are making new highs? How many are making new lows? How many are up? How many are down? You're looking at consumer staple stocks. How many are up? How many down? How many are making new highs and lows? You can detect when one part of the market is getting stronger, one part of the market is getting weaker. You can see the money flow from one area to another, and you can be quick. That's the advantage of the individual trader. You can be quick to jump on those moves. So that kind of analysis I find to be helpful.
Okay, yeah, that's interesting. And continuing about differences between the retail traders and the professional traders working for hedge funds, are there any psychological qualities that distinguish professional traders from the individual ones?
Well, professional trading is all about teamwork. It's rare these days, particularly, to see an individual portfolio manager working by themselves. Almost always, money is managed within a team. And when you put together the right team, everyone learns from everyone else. Everyone shares ideas, everyone talks out loud, everyone shares research. And so you're always feeding each other. And developing new ideas as a result of that interaction. Individual traders who are isolated, who are just working by themselves, don't have that benefit of teamwork. And that's why I think joining a trading community can be helpful. That's why I think joining a trading firm can be helpful, because you have many more people to learn with, many more people to learn from, and it gives a support system for what you're doing.
Okay, so this is an advice to gather with the other traders and to discuss ideas and discuss trading practice, right?
Yes. I think to expect to do it all by yourself every single day, that's asking too much. There's so much going on in different markets. If you have different people looking at different things, sharing different ideas, reading different things, sharing their views, it really helps you generate new ideas, and it gives you a positive focus even when P&L might not be so good.
Okay, thank you so much. And another question about the hedge funds. So you are working for the hedge funds as a psychologist, as a consultant. What do you see? Do the hedge funds properly maintain the psychological health of their traders? So do they focus on this problem or not?
Do they focus on psychology?
Well, yeah, on trading psychology. Yeah.
Yeah, absolutely. And that's why they have someone like me working with them. But I think they focus on psychology in other ways too. You know, the teamwork I mentioned is one aspect. But I'm thinking of a couple of hedge funds where I work, where in the building, right, in the offices where they work, there are spaces for meditation. There is a gym to work out. And so they're encouraging people to get off the desk and cool down and energize and have a balanced life. So I think in that sense, the hedge funds are interested in the psychology of their traders.
Mm-hmm. Okay, and here could be another piece of advice. So not to trade 24/7 as the majority of beginners do, but take a rest, get calm, and trade only when you are efficient, right?
Yes, but I would go even further. And actually, my most recent blog post talks about this. One piece of advice I've always given, particularly for beginning developing traders, is to always have something in your life or some things in your life that are more important to you than trading. Okay. So, for example, I have 5 kids, 7 grandkids, 4 rescue cats at home. I teach, I'm involved in other kinds of work, and of course I enjoy trading. But I have lots of different things going on in my life. Think of it as a portfolio, just like if you have a portfolio of investments. So if one thing doesn't work out, other things are giving you energy and are working for you. If you put all of your efforts into trading, if that's all you're doing, then you'll feel great when you're doing well, and you'll feel terrible when you're not doing well. And that creates an emotional roller coaster. Mm-hmm. So it's very important that trading be important to you, but that you have a rich life of many different things to keep you going when trading doesn't go well.
Okay. What do you think about the idea to live from trading? So because a lot of retail traders, especially beginners, they think that they can earn really big money and live from trading, but the majority of them fail, unfortunately.
Yes, and that's the reason they fail. In other words, most of the beginning developing traders don't start with huge accounts. If at one hedge fund where I've worked for years, the smallest portfolio, the smallest amount of money that you manage is 200 million. And many of the successful managers are managing over $1 billion. And they're putting that in different places. Well, if you're an individual trader and you don't have $200 million, let's say you start out, I don't know what, let's say you start out with $100,000. I'm just making this up. Well, that's good. If you make 10% on the year, which is a decent year, you've made $10,000. If you make 20% on the year, which is a really good year in the hedge fund world, you've made $20,000. Well, no one's going to get rich on $20,000 a year. And so what happens with the individual traders is they end up not having enough money to invest and to trade, so they take too much risk. They trade too much, they trade too big, and eventually that leads to blow up. Mm-hmm. So the important thing is to first build consistency of trading. And then once you're consistent, then you can raise capital, maybe by joining a proprietary trading firm, maybe by joining a hedge fund, and get the kind of capital that could make you really successful.
Mm-hmm. What do you think about the demo accounts? Is it a good idea to start with a demo account?
It depends on how it's done. To trade in simulation in demo mode in the beginning and make all your mistakes when you don't have money at risk, yeah, I think that's a great idea. And that's how I started. So you start paper trading. And then once you get consistent at that, then of course you start with small positions and then build your way up. Some of the demo accounts where if you trade and make money in the demo, then they will give you capital to trade. Many of those assume that you're going to make money and not lose much money. They assume that you'll have a Sharpe ratio of 5+, and they become very frustrating for people.
Mm-hmm. Okay, let's speak about a bit more about the trading practice. So there is a very common situation when many traders know their trading rules but fail to follow them in the real time. And from your experience, what is usually happening psychologically in these moments?
Yes, they're getting so caught up in the P&L and the risk and the reward that they don't follow their rules. That's where practice becomes super important, because if you are a developing trader and you practice following your rules, maybe like I said, in paper trading mode, in simulation mode, you practice day and day, and you get used to following the rules become part of you. The analogy I use is at the medical school where I teach. There are medical students who train to be surgeons, and there are rules and best practices to guide their surgery and different kinds of surgery. Now, why is it the risks in surgery are a lot greater, I think, than the risks in trading markets? Why is it that the medical students in surgery don't go on tilt and start cutting people all over? It never happens, ever. Why? Because they spend so much time learning, practicing, and training that the rules become part of them. Traders who are so eager to make money that they try to jump ahead and trade and put on risk right away, they never internalize those rules, and that gets in the way of their mindset, and that gets in the way of their trading.
Mm. Yes, thank you so much for this this thought, because yeah, the majority of traders they are thinking like, okay, the rules are okay, but I see this situation, I understand this market, so that's why I will break the rules and will act as I want to act.
Yes. Oh, and here's my friend. This is Nomi Lin. She's
Hi.
a chocolate point Siamese, and she likes to get it on the camera. She's the fourth of our cats. Anyway, yes. And again, would a student in surgery say, oh, I see this opportunity. I know what to do. I don't need to follow the rules. No, it would never do that. So by treating the situation seriously and having the patience to learn and internalize the rules, we develop the right mindset.
Mm-hmm. Right. Okay, so there is a question: how to manage long streak of losses and how to control emotions when you are in good profitability, to not give it all back.
Yes. So if there are strings of losses and strings of wins, strings of gains, then probably markets are doing something that is working or not working for you, and you want to figure out what are the market conditions where you're making money and where you're not making money. But the important thing is to recognize when those conditions are changing. So when you are winning, and then suddenly you stop winning, suddenly you have some losses, you immediately want to step back from trading and figure out what's changed. Am I trading differently, or has something changed in the market? Same thing if you're losing. So you cut your trading size, you cut your risk so you don't blow up. But then you start to see things pretty well. You make some money. Oh, what's different? What are you seeing well? And what might be changing in markets? So by adapting to the market environment, the market situation, and by noticing in your trading when things are going better, when things are going worse, you're using that as a barometer for what might be changing in markets. And that could be real information that helps you adapt.
Mm-hmm. Okay, so there is a statistics that 90% of traders are quitting the market within 2 years. They simply fail. What distinguishes traders who sustain success for decades from those who burn out?
I'm not sure that they burn out necessarily. How many athletes go on to be able to make their living from athletics? How many people in the performing arts are able to eventually make their living from music or painting or what have you? I think it's probably a similar 90% figure that don't make their living that way and can't. And that to me is not necessarily burnout. It might be that people are figuring out that this is not the right activity for them, or maybe they just haven't had the right kind of training to be able to succeed. So it doesn't surprise me that 90% don't go on. The 10% who do, I believe, are getting good training from experienced people. They are doing a lot of practice in their trading before they put much money at risk. And they're building their confidence and their mindset through that practice and through mentoring. So at trading firms where I've worked, where they actually teach people how to trade, the success rate is much higher than 10%.
Mm-hmm. Okay, and here is another question: how to find the right mentor or coach for the trader?
Yeah. I mean, there are trading communities out there, and you can certainly Google for that. And there are mentors within those. There are proprietary trading firms where there are multiple mentors. There are teams that are led by successful traders, and that can be a good outlet. That could be a good way to find the mentoring. But it does take some looking around. There are people online who offer services. They don't really publish their track record. You don't really know how successful they are. When you are in a trading community or at a trading firm, you actually see what they're doing that works and doesn't work, and you can learn from their example.
Mm-hmm. Is it important for the trading coach to be a very successful trader?
That's a really good question. If you look at athletics, the successful coaches have played the sport. They haven't been necessarily the top performers. And so you think about in college basketball, some very successful coaches. They've definitely played the game, and they understand the game very well, but they weren't necessarily the top players at the time. For a trading coach, I think it's necessary to have an understanding of markets and to have experience trading. I wouldn't want a trading coach who didn't really understand how markets move and what are opportunities in markets. But the important thing is their ability to teach what they know, and not necessarily give people the secrets that are going to make them super successful.
Okay. And we collected some questions from the audience before our Q&A session, and one of the questions was from the man who have been trading for 5 years. Also, he has a certification of as a coach, and his question is how to become how to make a name for myself in the mindset industry of trading to genuinely help others. What is your advice?
Yeah, that's a good question. I'll just mention how it happened for me, and it really wasn't part of any great master plan. I had been teaching full time I'm a psychologist. I was teaching in the Department of Psychiatry in Syracuse, New York. And I've had interest in financial markets for quite a while. And so I ended up writing my first book. And that was The Psychology of Trading. And people discovered that book, and that's how they discovered me. And later, I started one of the first trading blogs, and people discovered that, and then that's how they discovered me. So I think by getting ideas out there, you attract the right people. I've always said I have zero interest in promoting myself. I don't, if people hire me, don't hire me, I really don't care. But I do want to promote ideas, good ideas that can help people. And I think when you promote the right ideas, you attract the right people, and you can build interest that way.
Okay, just find the right people, promote the idea to right people, and then there could be a success, but no guarantee, right?
Oh, there are no guarantees, but if you write a good book, if you have good ideas, you write a good book, you're out there in social media putting out good ideas. I think the problem for many people, maybe, who want to be in the quote unquote mindset industry is they don't actually understand what goes on at professional trading firms. And actually this happened. We brought in some people at one of the hedge funds where I worked. we brought in some people who we thought might be able to help the traders, and they talked about trading in the most simplistic ways. And like buying something when a moving average crosses. The people in the audience were stunned, and eventually they walked out because the speaker didn't know what they didn't know. They didn't understand what makes portfolio management different from short-term trading of different patterns. And as a result, they weren't able to connect with their audience. So I think it's important to understand who it is you want to connect with, speak their language, and come up with ideas that will benefit them. And then you can really develop relationships.
Yeah, knowing your audience is a good feature of marketing, right? So is it possible to become a good trading coach without marketing now? What do you think?
Is it possible to be a good trading coach
without marketing?
Without marketing? Yeah, you might be a good coach. Whether anyone will discover you or not, I'm not sure. I mean, it's like you're a good chef and you make really good food, but you don't market your restaurant. Well, how are people going to discover you? So you do need a way of getting the word out about what you're doing, but marketing does not substitute for knowing what you can do. There are people out there who are marketing and they're going to make people successful and all that. And then you look at the details of what they talk about, and it's clear that they don't have any depth of understanding about financial markets.
Okay, so in this case, it's worth verifying, right? It's worth verifying trading coach before starting working with them, right?
Yes. Well, hopefully if they are writing about their ideas and sharing what they do, hopefully that is a kind of verification. Mm-hmm. Yeah. If they're only if they're only talking about, oh, I'm going to help you feel more confident, I'm going to help you get rid of your negative emotions. Well, that's stupid. I mean, you know right away that that person has no depth of knowledge about financial markets. They're not going to help you be successful. I mean, they could teach you, to do a meditation exercise or whatever the hell. And that's nice, but that's not going to make anyone successful in financial markets. You need someone who understands. It's just like a sports coach. If you had a football coach who said, oh, I'm going to help you have a better, more positive view, and you're going to play so much better. Well, no, no one does that. You have to teach them new plays. You have to teach them new exercises that'll help them play in a different way. You have to have some knowledge about the sport in order to help them perform better. And so if you find someone who has good ideas about trading itself that can help with mindset, that could be useful. But again, it's got to be a fit for the kind of trading you do and what you're interested in.
Okay, thank you so much. We also have a question. You often talk about emotional awareness as a performance tool rather than a problem. How can traders turn emotions into useful information instead of trying to suppress them?
Yes, emotions are definitely useful information. Emotions can tell us when there's opportunity. We notice, hey, this is coming together. This makes sense. And that's the beginning of what we call intuition. And that can be very valuable in trading. On the other hand, we could notice that we have emotions of frustration. We're blaming ourselves and feeling terrible because we've just lost money. And so when we recognize that we're beating ourselves up, we can step back from trading, not become reactive, calm ourselves down, refocus on market opportunity, and turn things around. So when we're aware of what we're feeling, we can make the most out of our positive experience, but also pull back from the negative experience.
Okay, thank you so much. We'll also have a question: how to adapt the strategy to different market environments, and I suppose how to adapt your mindset to different market environments.
Now, was the question about adapting strategy to different environments?
Right.
Yeah. Okay. Yes, that's a very good question. Because you adapt your mindset by adapting your strategy. So what I would say is there are different strategies that work in different markets. If you have a low volatility market where things aren't moving very much, a different set of strategies will work than in a trending market with higher volatility. And so you want to have different strategies that fit different kinds of market conditions. And then as you become better and better at recognizing when market conditions change, you can move from one strategy to another strategy. So for example, one strategy that I use in short-term trading takes advantage of cycles. And there are tools for measuring cycles in markets. John Ehlers, E-H-L-E-R-S, has written on this topic. And so you're trying to buy at the relative lows and sell at the relative highs in these cycles. Those tools are less relevant when you have a trending directional market. And so you have to have other ways of figuring out how to enter, how to exit, and so forth. So by adapting to different market conditions, you can make money in different types of markets. And when you have different ways of making money in different markets, that builds your confidence. You build your confidence by learning how to trade the right way, by being more flexible in your trading. It's not that you change your psychology and suddenly you're going to start making money. That doesn't happen.
It's only a question of practice, right?
Practice and, practice in different market conditions and different types of markets. Yeah. The US stock market right now is very, very different than it was a matter of months ago. The patterns that are working right now, very different from what was working, let's say, at this time last year. And so adaptability becomes really important, which means that in your learning, you have to experience many different types of markets in order to figure out how to trade them. You can't be adaptable if you haven't lived through different types of conditions. So that's why learning markets for a few weeks or a few months, it's not going to work, because markets will eventually change, and suddenly what you learned and what you did that was working may not work right now.
Yeah, but mostly nobody of the new traders, of the newcomers to the trading world want to spend like years to build their practice. Can you recommend any frameworks, any practices like to change the mindset and to be ready to work in a long-term period of time, not in weeks or months?
Yes. It's like developing expertise in medicine. It's like developing expertise as a portfolio manager. Or in any field that takes time and experience, and it takes mentoring. What I did when I was learning markets myself was that I traded part-time while I was working full-time. So I carved out a part of the day and I learned how to trade that part of the day. And I experienced many different types of markets, made lots of mistakes and learned from the mistakes. But I did that while I had a secure income. So I didn't feel pressure to have to make money right away. And that turned out to be the best way for me to learn how to trade, was to not feel financial pressure and have the time to experience big falling markets, narrow markets, markets in different parts of the financial world, and figure out what I'm really good at.
Mm-hmm. And how do you think, how long does it take to become a really professional individual trader? How many years could it take?
Well, there's that old research about 10,000 hours of practice is necessary to develop expertise in any area. What I would say is, in my case, I had to observe and practice trade markets for years, a couple of years, before I felt comfortable, like I knew what I was doing, to put on meaningful risk. And if you look at market conditions, you can see that markets change quite a bit from year to year to year to year. And so to build expertise over time, I think is realistic. It's not what everyone wants to hear, but it's a way of building lasting skills.
Mm-hmm. Okay.
The other thing, if I could just jump in with another idea that's very relevant to the positive trading psychology idea, the book I have coming out, is when you take the time to learn trading and try different things, try different markets, try different time frames, you can figure out what you're really good at. And that is so important. Where are your talents? What are you really good at? You can't know that just after taking a single course or, doing it for a few weeks or months. You need to try different markets, try different strategies. Some won't work at all. Some will really fit. So you're learning not just about markets, you're learning about yourself and giving yourself the time to figure out what am I really good at? That's very, very helpful.
Thank you so much. We also have a question from a chat. What do you see regarding trust that develops or not in teams, and what can individual traders learn from that when joining communities?
Developing trust?
Yeah.
So the rule that I use in helping develop teams is everyone on the team, each individual on the team, has to be better than every other individual on the team in some area. So everyone on the team has to have a particular area of experience and expertise. So everyone is sharing what they're good at, and everyone is making everyone else better. That's the kind of team worth joining.
Okay. Very good formula. So the could be the team of geniuses, right?
Well, yeah, and you find that different people on teams are good in different areas of trading. And some might be very good at researching, some might be very good at managing risk. And by putting those talents together, everyone can learn from each other and become more rounded, become better.
Okay, thank you so much. Okay, and the last piece of wisdom. If you could give one piece of advice to traders trying to improve their performance in 2026, what would it be?
Okay, so the advice I would give is related to something I learned when I was studying years and years and years ago. with a group under the novelist philosopher Ayn Rand. And what she taught is that anyone who fights for tomorrow lives in it today. In other words, if you are really working toward your future and you're figuring out what you're good at, where does your greatness come from? What are you really good at? And you figure out a way to bring that to your trading. Every great trader did something greatly before they started trading. They're taking their talents, they're taking their skills, and they're bringing it into trading. What do you do greatly? How can you bring that to trading? And then trading becomes part of your present, and it feels like it's part of your future. If you can develop the best within you, if you can use trading to identify what you're really good at, it can be a very rewarding field, not just financially, but personally.
Thank you so much. Thank you so much for this advice. And thank you so much for this conversation. It was very interesting and profound. Thank you for joining us, Dr. Brett. It was an honor to speak to you.
Okay, thanks for having me.
Thank you. Okay, guys, so we will continue in a few minutes with Agnieszka Wood. Thank you.
Alex?
Yeah.
Yeah. Now, was there going to be a panel presentation after?
In an hour.
Yes. It wasn't clear to me if you wanted me to be part of that because I wasn't on the invitation.
If you are free, so yes, welcome, please.
Okay. And I don't know if I have a link for that.
Okay, the link will be the same.
Okay. Okay. Very, very good. Thank you.
Thank you so much. Thank you. Okay, guys, Welcome back. So we continue our conference, and thank you for being with us. Our next speaker is my good friend, Agnieszka Wood, trading mindset coach, trader, and CEO and founder of a head coach. Agnieszka will be speaking about discipline in trading. So, and her speech topic is why discipline in trading breaks down exactly when you need it most. Agnieszka, welcome here, and the stage is yours.
Hi, Alex. Hi, everyone. I hope that you had a really great presentation with Brett. I was actually listening, so I know it was fantastic, and that you had the time to grab some lunch before we can begin. No pressure, even though we will be talking about pressure. So, but that's coming. So thank you, Alex, first of all, for having me here, and also Tradefulness team, because this event that you guys organize every year, I know it costs you a lot of effort. This is not something you just, wing it. So you're doing such a great job on that, and contributing to the community greatly. So really, thank you, everyone, for your efforts on that. And also, thanks for joining the conference, everyone. And I see some people saying hello. So hi, everyone. Thank you for joining and dedicating your time to participate. And I truly hope that today, even though it is just one day, that it will bring you the value and the inspiration that you need to put things into action and turn it into results, and that you will not just kind of, listen and then go about your life the same way as you did before. Because we are here to share our knowledge, experience, and also because we are living the struggle every single day. This occupation that we have chosen as traders is really very demanding, and this is not just technically demanding, but psychologically. And while most people get into trading to get freedom, they end up to being caught up in the struggle, and they want to make a reliable source of income, but then they come across this thing that's called consistency, and unfortunately they cannot break through that, so that the goal of trading for a living kind of becomes impossible. And this struggle to, sorry, I'm laughing about the comment. Hi, David. The struggle to make consistent profit is real, and that's why I'm saying we are living this every single day, because consistency, it is not a milestone. It is not something you work towards to and then boom, suddenly you have it and then it stays. Consistency is really a practice that you have to implement into your life every single day, every single moment. And there are not many people, speaking of the 90% of traders who are not succeeding, there are not many people who are able to sustain that kind of commitment, being consistent and really putting, living according to strict routine and process and discipline. And it is not just doing, because we'll talk about it, it's not about doing, but really enjoying your life, having the balance, and then being disciplined when it comes to trading as well. So the struggle to make consistent profit is real for everyone, no matter how consistent you are already. And maybe you can let me actually know in a chat whether you are already consistent, or are you here to look for a way to become consistent, or maybe other ways, or maybe better ways, or more ways to become consistent, something that will help you. Let me know in a chat, where are you in your trading journey? Because just like Brett said, consistency is really the first step. You cannot move beyond that with success. You got to build consistency first. So let me know in a chat, because I want, before we move on, I really would like to understand where you are, more ways to be consistent. Is anyone yet consistent? Or you are here to find out how to improve current level of consistency. So you see, this is also so interesting, because when you are consistent, there is always something to improve. So if you are struggling to be consistent, try to get that fantasy out of your head that once you are consistent, then the work is over. This This is just going to continue. This is something that is a practice, as I said. So let me share my screen. I'm not going to throw at you any theory. I just want you to sit back and relax, but I do want you to follow me, with, just give me a second. Screen. To follow me so that you can really understand where I'm trying to take you to, okay? Let's see. Can you guys see my screen? I hope you can. Lacking in discipline, but consistent in watching the market. Yes, that's a very interesting way that you said it, because a lot of times, like, you can say, yeah, I am consistent, but consistently breaking my rules, right? So you do have a level of consistency, just not exactly in the right things. And that's really interesting. So you know how to repeat things, but just not the right ones. So let me start with a question. How many of you have had a trading day where you knew exactly what to do and still did something else? Anyone? Or is it just like every day? You had a plan, you had your levels all marked up beautifully, you worked on it maybe the whole evening or pre-market, and then you told yourself, today I will follow it, right? You really had good intentions. And then the market opens, price moves, you miss the entry, or maybe the trade goes against you, and then suddenly something shifts. You don't think differently. You still think, I need to follow my plan, but then you feel differently. And then you start acting differently. And then you go off your plan. You start oversizing. You maybe remove your stop because you see it's coming closer and you don't want to lose, and you chase. And then later on you look back and you think, who was this? What just happened? Does this sound familiar? I know it sounds very familiar to me because I have lived that. Now, let me ask you something deeper. Do you consider yourself a disciplined person? And not just in trading, but like in life. How many of you think, yeah, I'm actually, if I look at my life, I'm actually pretty disciplined. I have, I'm a pretty successful person, right? Yeah. Most traders that I know of and that I work with are very ambitious people. They are high performing. They are used to taking this responsibility, and they are disciplined. They are used to solving problems. But still, in trading, consistency feels impossible. They follow their plan for a while, and maybe you recognize that, but then after they build some profits and they're finally happy, okay, it's happening now, then one decision and it wipes everything out. It's the same trader, even though I have to say, even though sometimes it does feel like there's someone else inside you making the moves, doesn't it? Like you're possessed or something. And when this happens over and over again, this is where the real damage happens, because it's then not just about the loss, it's the doubt that creeps in. That's the whisper that you get in your head that comes and says, maybe I'm just not smart enough. Maybe I just need to try harder. Maybe I'm not just doing everything I can. Or maybe I just don't have what it takes. And that doubt is not only exhausting, as you have probably already noticed, but it is destroying your confidence. And it's absolutely unnecessary. And here is why. Because while you are projecting all the failures onto yourself and making yourself miserable in the process, consistency is a completely different issue. It's not an intelligence problem. It's not that you don't work hard enough. It's a pressure problem. So today, I'm not going to talk about strategy or tools, even though I'm going to mention tools or setups. I want to talk about what pressure does to your decision making so that you can understand the mechanism. Because once you understand that, the conversation about consistency changes completely. And instead, what you will see is that instead of keep trying harder, you can finally start focusing on building discipline that holds under stress, and then trade with more ease and maybe even more compassion and joy. How does that sound to you? Does this sound like something you would like to actually enjoy trading again? How many of you feel like it's this constant battle? And maybe you question sometimes yourself. I know, like if I look at my old journals from years ago, at some point I was, I had written like, I don't think I even enjoy trading. I don't even know why I'm doing this, why I'm torturing myself. Does anyone feels like that? And I'm not saying all the time, but from time to time, you're like, what is wrong with me? Who would do something like this? So for those of you who do not know me yet, I am Agnieszka Wood, and I have been trading for 15 years now. And the beginnings were pretty tough, just like for most traders. It took me really many, many years and a lot of sweat and tears, as my husband, before I was actually able to make money and keep it. Making money was not a problem. I was doing it from the very beginning, but keeping it, that was the challenge, that consistency thing, right? And then since 2019, I started finally working with traders on building the discipline and the mindset that allows them to follow their plan with calm, consistency, and confidence. And that happened not because I just decided, hey, I'm going to do it, I'm just going to coach traders, but because when I was struggling and when I was stuck in that cycle of frustration and making money, losing it all, I was so driven and pushing. And I thought, if I survive this, if I manage to come on the other side, I'm going to help others to do that too. So I am on a mission to help you guys, to help traders, specifically day traders, because I know that day trading is like Formula One. To be really independent, and that includes coaching themselves, just like Brett mentioned earlier. And that's why I called my company a head coach, because I believe that if you can coach your own head, you can be ahead of the impulsive behaviors and be in the driver's seat. And that's the leader position. Because when you are following someone, you are always too late. So before trading, I have spent years working in high pressure environments. Just think international corporations, marketing, tight deadlines, huge budgets, constant responsibility, constant rush. I also built several businesses from the ground up. And some of them I was running next to my full-time job. So I had a track record of getting things done. In fact, my nickname was Busy Bee. So just to give you an idea, hard work was not new to me. And discipline wasn't either, because I knew exactly how to combine everything and how to manage everything, how to juggle things. So when I came to trading, I assumed that I could make it work. I was sure that pressure wouldn't be my issue. But it was. And not for the reasons that I expected. How many of you, when you started, you thought, this is going to be a piece of cake for me. I'm a successful person. I'm just going to do it, right? I know it's going to cost me work. I'm going to do the right thing. It's going to be easy. How many of you have thought that when you started? And I will get back on the plan question. If you could write it down and then come back later on that, that would be awesome. But it's definitely a written plan. So here's the interesting part. Most traders don't struggle because they don't have enough knowledge, they don't have enough intelligence. They don't struggle because they don't have the right strategy. They struggle because trading rewards a completely different operating system. Different than the one that made us successful in life. And that operating system is incompatible with how the market operates. Just imagine going to the moon. Market is a little bit like the moon environment. There are completely different rules of how you need to survive on the moon. And if you are not prepared for it, and just shoot yourself up to the moon and walk out without the right clothing, without the oxygen, I'm just gonna try it. You won't survive. In fact, you might start, you might get floating in space for years, never come back. And that's what many traders do, float, and not being able to get back on the ground. We are not wired for an environment that operates in probabilities. We are wired for certainty and control. Look at this. In life, speed is rewarded. And that means that you need to respond quickly, make decisions very fast. Don't hesitate. Effort is rewarded. Work longer, push harder, outwork the competition. Control, that's something that we always want to have control. Look at our insurance industry. Always managing the situations, fixing the problems, taking ownership. Certainty, you got to have the answers. You have to be confident. Minimize the doubt as much as you can. This is how we build our careers. This is how most of us have learned to succeed. And that's the conditioning that most of us have grew up with. And when I say most of us, I don't know, maybe if you were born in the last 20 years or so, maybe that's different. But traders that I work with recognize this very well. And they are not 20 years old, okay? But trading rewards completely something different. It rewards patience. It rewards waiting, watching the price move without reacting, and letting the setup form before you start forcing one. So really sitting on your hands if there's nothing to trade, instead of trying to create something. Trading rewards restraint. Speaking of discipline, not taking the trade, not adding to the position, not chasing the breakout, not revenge trading after the loss. Tolerance of uncertainty, because it's such a normal thing, the uncertainty. This is just a condition of the market that you have to be able to enter a trade knowing that it might lose, and accepting that you can do everything right and still be wrong. How many of you can easily accept it? Or be confident enough to make decisions with incomplete information. So it's not speed, it's patience. It's not effort, it's restraint. It's not control, but it's the acceptance that you have limited control and no control over the outcome. Not certainty, but the tolerance of uncertainty, or in other words, resilience. And that's the conflict, because we are not wired for probabilities. We are wired to reduce uncertainty. While trading asks you to sit inside uncertainty without trying to fix it. So when you combine uncertainty with money, the risk, then that's where most people become anxious. And that is already pressure. But now add an extra pressure to it, take a loss, or be in a volatile market, maybe miss the entry, or maybe simply a day that didn't go your way. Okay, you were hoping to make money, now it's red. So it's extra pressure. And the interesting thing is that pressure in life, especially when you find yourself operating well under pressure, pressure often sharpens performance. But in trading, pressure shifts your internal state. And when your internal state shifts, now your decision-making changes as well. So you don't rise to your best intention, no matter how great your plan was, but you default to your most familiar patterns. We all behave and live in patterns. So you will always default under pressure into your default pattern. And that's where discipline appears to break. Your strategy might be fine, but it only works when you can execute it consistently. So you are actually the key link in the equation. And the consistency is the hardest exactly when the pressure rises. So when you lose control under pressure, most traders automatically conclude, well, it looks like I cannot handle pressure. I think I need more discipline. And that's pretty logical, wouldn't you say? It's just, the problem is it's incomplete. So let me ask you something. Do you consider yourself someone who performs best under pressure? Do you ever procrastinate to finish something and maybe only get it done when, like, at the last minute, when you have no other choices? Anyone? And it's not a bad thing. And I can tell you, I still, to this day, still recognize this pattern with myself in my life. But I had to get it. I had to change that for my trading. Yes, exactly. So when you recognize that, you might be thinking this is a good thing because, deadlines and pressure makes me focused. But there is a little issue with this. I always believed myself that I perform best under pressure. Deadlines, I built my whole career around that. Urgency energized me. That's how I was operating. And I always felt disciplined because I could get so much done when the pressure was high, especially when it was just right against the deadline. It was incredible. It was almost like, why would I waste a week if I can do the same thing in 2 hours, right? But when it came to trading, it was completely working against me. And I thought that it was a discipline issue. But in fact, it was adrenaline. Let me explain this. So there is something like adrenaline-based discipline. And this is where urgency replaces regulation. So you feel focused, but only because there is a threat. And there is a threat response that's active, making you act. So your actions feel automatic and you're really decisive because this is your threat response in action. Now, without pressure, your motivation drops. And focus increases when you are under stress. Just like, when people are in a survival situation, their focus narrows, the blood starts streaming out of their vital organs into their legs and arms so that they can run. and protect themselves or fight. The thing is that pressure becomes the condition required for you to perform. Does that sound familiar? Do you recognize this? Performing under pressure. I perform best when I'm challenged, and the market challenges me every day. And that's the thing. Most traders love that, but they don't realize that this exact thing is what stands in their way, because they love the challenge. They feel alive. They feel like they conquer something. So while they think, okay, I'm performing, they're actually running on adrenaline. How many times you were like this, you were feeling like this in the market, but then at the end you were exhausted? That's what adrenaline will do to you. Just think about how many times you took a major loss, and of course it wasn't fun, but then somehow you were able to gather yourself and then work your way back into profit. And then you felt good about yourself, didn't you? Under pressure, you suddenly felt focused and decisive, and you were just acting. And many traders wrongly assume that that's what discipline feels like. But how often, when there is not much happening in the market and you sit there and watch the charts, how many of you feel restless? There's nothing to trade. You start clicking the buy and sell buttons. You start making up setups. Suddenly, when there is no pressure, your discipline completely falls apart. So here is the paradox. Most traders believe that pressure is the problem. They think, if I could just handle pressure better, if I could just control those emotions, then I would be consistent. But for many traders, pressure isn't the problem. Pressure is the fuel. Under pressure, they feel sharp, they focus, they locked in, they know how to grind, they can recover from losses, and they can perform. What actually exposes them to problem are calm conditions, slow markets, no urgency, no action. And this is where restlessness comes in. And that's where you start overtrading, you start stretching your rules, start, justifying your decisions to break the plan. And this is a pattern that many traders live every day without even realizing it. So inconsistency isn't a discipline problem, but it's a nervous system survival strategy. Most traders I work with are not undisciplined. They're adrenaline driven, and they learn to function at their best when urgency is present. They perform very well under pressure. They procrastinate until there is urgency. They break the rules when their emotions spike. The intention to follow their plan is there, like I said. That's not the issue. The intention is there. The issue is the state. When pressure rises, access to regulated decisions just drops. And then when calm returns, they just don't know how to operate without the urgency. And that's not a character flaw, that's conditioning. So let me know in the chat, do you notice yourself becoming more sharp, focused, locked in after you have taken a loss? Or motivated? Tomorrow I'm going to start being disciplined again. Do you recognize that from yourself? Like something that happens, like a problem. So after you say you feel distracted after the loss, but then how do you get yourself back on track? What do you do to get yourself back on track? Because a lot of times the loss, like after you have gone beyond the initial emotion, you know how to get yourself back on track and find the courage and find the power to come back the next day, or maybe even the same day or right away, and start making trades. I make pause and run, yeah. And then you come back and you start trading again. So that's, yeah, so that's really interesting to notice from yourself, like how that mechanism is working. And, you know, as Desi was saying, journaling is a good way to do it. When you start analyzing your behavior, you might notice what is actually driving you. So does doing nothing feels harder for you than taking trades? Or you're good? You're like, I can sit here for hours, watch the market, does nothing to me. How do you feel about doing nothing? Andre, if you could keep that question, I'll get back on that later. Terribly, right? It's like, I feel so useless. It's like nothing is coming out of my hands. And I can tell you that this is such an important thing to understand, that being comfortable with doing nothing, if you truly want the freedom you say you want from trading and the independence and doing anything you want with your time, this part is incredibly important, because this is exactly what keeps a lot of traders from having the freedom, because they simply cannot walk away from the desk when they should. Especially like if you maybe, you know, in the first 20 minutes, you hit your daily goal or maybe even exceeded it, or you made as much money as you would made in a paid job in a week. And then you still feel like, I need to work for my money. And then you're there and then you lose it. So knowing what is driving your behavior and your decisions is incredibly important, because if doing nothing feels unproductive, you will be creating situations for yourself where you will start feeling good about yourself. And trading might be one of the part that will be compensating it. And like Brett was saying, having other areas of your life that give you that fulfillment is incredibly important. And it serves a function. It's not like, oh, you know, I need to sit here and trade so that I can call it I'm a full-time trader. Remember, trading for a living doesn't mean living for trading. And a lot of times traders are mixing that up and let their trading run their life. And that's not the freedom that you envision for yourself, right? So you might be actually creating internally more pressure, because pressure feels familiar, because working hard feels familiar, because being productive is your default state. So you cannot step away, not because you are greedy, even though this is probably what you're saying is, why am I so greedy? Not because you're lacking discipline or structure, which that is definitely helping, but this is because your nervous system equates action with value. You have to work for your money. And if you don't feel you deserved what you have made, you are gonna compensate. And that's a very different problem than most people think. And when you look at this through that lens, then you realize that it isn't about good or bad decisions. It's about which internal state is driving you, because your system doesn't operate randomly. It operates from state. And there are two primary operating states that matter in trading. There's a survival state and there's a regulated state. So in survival state, your goal is relief and control. In regulated state, your goal is strategic execution. So when pressure rises, we don't rise to our best intention. We default to our most familiar state. And for many high-performing traders, and it might be for you, that state is survival. So your action sort of becomes automatic because doing something feels like being in control. And that gives you short-term relief that drives your decisions. And I know how productive and powerful that can feel, but it does destroy your long-term consistency. So here is where it gets interesting. Many traders, when they are in that situation, they try to solve this problem by reaching for regulation tools and use them in the exact moments that pressure spikes. Meditation, breathing, journaling. And let me be clear, those tools are absolutely help. Okay, I teach them too for a reason. But here is what often gets misunderstood. Tools support regulation. They don't instantly override a survival response. If your system is already fully activated, breathing won't magically restore it the full access to choice. Regulation is something that you build and maintain, like resilience. This is not something that you switch on and off in the middle of emotional escalation. So just think about it. You don't build emotional fitness in the middle of a sprint, right? You build it in training. And maybe you have noticed in your own trading that when you go on tilt and you don't pause there and think, oh, yes, perfect moment to take 5 slow breaths, right? When you're on tilt, you're not thinking. You are already in motion. Your attention has narrowed. Your system is looking for relief and control. And that's what survival does. And in that state, even if you know breathing would help, access to the choice is reduced. Not because you are incapable of doing that, but because the system has shifted priorities. And that's why tools sometimes feel like they don't work. So you try them and then you're like, it didn't work. But it's because that they aren't meant to be used reactively, but strategically. So just check with yourself, how do you use the tools? Are you using them during escalation to fix discomfort, which, by the way, adds pressure? Or are you using them strategically, consistently, outside of your trading desk, so that you can actually reduce the baseline reactivity? So some of you might be now wondering, so, well, does that mean I shouldn't focus on breathing while trading? Or should I completely stop journaling? Well, those are really good questions. And let me be clear, if something is working for you, don't stop doing it, but understand that tools don't fix the problem on their own. So if you are struggling and you say, yeah, but I journal every day and it's not working, look at how you are using the tool and what effect does it actually give you and what problem are you trying to fix with that tool. They are much less effective when when they are used to force yourself into a different state or to eliminate discomfort, because the tool becomes then another source of pressure. Now you're thinking, my coach told me to meditate so I can trade better. I have to journal because Desi said so. I want to, I want to do this differently. So I have to journal. And just notice, like when you say to yourself, I have to do this, just notice the tone of that. How it feels in your body when you say it. It's like, oh yeah, I still have to write down my trades. Oh yeah, I still have to upload my stats. How often do you say this to yourself and actually not do that? Does it feel spacious or does it feel tight? Does it feel like supportive or does it feel demanding? The tool becomes this another thing that you're supposed to get right. It stops being regulation as it's meant to be. It becomes performance. And now you're not calming your nervous system, you're evaluating it. You're trying to fix yourself as there's something wrong with you. And that subtle shift matters, because pressure doesn't come only then from the market, it also comes from your internal dialogue, how you treat yourself. So now the tool becomes just another requirement, another metric that you judge yourself with, another standard that you're failing or succeeding at. So that's still the survival mode. So what actually helps is using tools as support, not solutions. Support for noticing patterns, like Desi was saying, instead of fighting the patterns. Creating space instead of control, and building habits that can actually help your nervous system stay regulated enough to give you access to choice, to making decisions. Meditation isn't about becoming calm on demand. Journaling isn't about correcting yourself. A lot of people don't journal because they're afraid of their judgment. They are about changing your relationship to your internal experience, so that new patterns, those new states, can form naturally over time. And that's very different from trying to override stress response in the moment. And I personally wish that I had understood this much earlier, because for years, I didn't realize that I was operating almost entirely from survival mode. And I was so proud of how well I performed under pressure. I didn't realize that I was actually creating pressure just to feel focused and motivated. So I had learned that urgency meant productivity, that effort meant value. That's how I grew up. And that pushing hard meant progress. So when things were calm, I just didn't feel productive and I felt uncomfortable. And trading was really the first environment in my life that exposed my inability to perform and to operate, not just perform, but operate calmly and consistently without urgency, and feel good about it and about myself. So I had to learn how to be disciplined without having that pressure. And that was new. And here is something I want you to consider. Pressure narrows your choices so much that discipline isn't required. Just hear that. Pressure narrows your choices so much that discipline isn't required. Action just feels unavoidable. You just go, boom. It's when the pressure disappears, that's when real discipline becomes necessary. And that's where most traders fall apart. Not because they lack discipline, but because they never learned to operate without adrenaline. So here's where it gets tricky, because most traders don't realize that they are operating from survival. So when consistency breaks, they push harder and they try to force discipline. Maybe you tell yourself, tomorrow I'm going to do better. I'm going to be more disciplined tomorrow. Maybe you add more rules. You say, no more trading after 11. I'm going to switch off the computer. Max 2 trades. And if I break the rule, I shut down the platform. And then I cannot trade for a week. You start punishing yourself. You tighten the control. And you start scolding yourself for making mistakes and then failing. You start thinking, what is wrong with me? I know better than this. I cannot keep doing this. So you raise the stakes. So then you say to yourself, if I mess this up again, I'm done. But are you? No, you come back again. And then you tell yourself, I need to make my losses back today, right? And then you put so much effort and so much pressure on yourself that backfires. You say to yourself, I can't afford another mistake. And the crazy part, all that, in a way, it feels responsible. It feels like now you're accountable. You're straightening yourself there, like with discipline, just like we learned the harsh way, the discipline. But really, internally, you just put more pressure on yourself. And that's a problem, because when you are already in a survival mode, forcing discipline doesn't create stability. It just creates more pressure. And then under pressure, your system doesn't ask anymore, what's the right decision to make? It asks, what will give me the relief right now, the quickest, like the Advil pill? And that's when you start forcing trades, oversizing, removing stops, exiting early, staying too long, and overtrading. Knowing what to do now doesn't matter anymore, because your access to regulation has dropped. And then the cycle repeats. So let me simplify this. Pressure creates survival. Now your survival mode drives action to give you instant relief. That relief feels like control, but it's very short term, because the action you are taking to create that relief is often impulsive. So while it may calm you in the moment, it creates damage, long-term damage. And that damage creates more pressure. And you are back in that loop. And I have worked with traders who came to me after 5, 10, 15 years being stuck in that loop and still not understanding why are they not being consistent. So trying harder, pushing yourself and creating more pressure only fuels the loop. And you can stay in there for years, like I said, and from outside, this loop looks like self-sabotage. You make money, then you mess things up, give it all back, take yourself together, back on feet, and like, okay, I'm going to try again. And then you go again. And every time you feel like you're just around the corner. I think my slides stopped, but let me share my screen again. Does this sound familiar to you guys? Okay, cool. So this, even though this looks like self-sabotage, this is really your survival response on repeat. So you could ask yourself now, does this mean I shouldn't try to be disciplined? No, you absolutely need discipline, just not the traditional kind, not the forceful kind. Because traditional discipline is based on suppression and control. Do better, try harder, don't mess this up. And when you apply suppression under pressure, the system experiences it as a threat. And that sends you right back into survival. Discipline requires access to reflection. Reflection requires regulation. And regulation requires safety. And without that foundation, that's why discipline collapses. And once you see this conversation completely changes. The question is no longer, how do I force myself to be more disciplined? It becomes, what needs to change so discipline remains accessible under pressure? And I hope that you can now see that discipline isn't about effort. It's about the state you are in. And that's why in my work with traders, I don't start by adding more rules or tools. I start by changing the conditions under which discipline operates. And if there is one thing that I want to leave you with today, is discipline doesn't fail because you're weak, doesn't fail because you're not intelligent enough, you don't have it. It fails because pressure changes the system applying it. And when you change the system, this consistency becomes not only possible, but also much easier to sustain. Not because you're trying harder, but because you are no longer fighting yourself. And trading becomes more of a process. And that's the real shift. And that's what allows discipline to become stable. And if that inspired you, I would like to continue this conversation. I will be showing how to build discipline that doesn't collapse under pressure, a different type of discipline without forcing it, in my upcoming masterclass. It's completely free. You can scan the QR code or go to tradingmindsetmasterclass.com and register. It's February 25th, so still 2 weeks, but save your seat because space is limited, and there will be also recording available if you cannot join live. So that's where we can continue that conversation. And also, I don't know if you're familiar with my podcast. It's Confidence in Trading. I talked more about this topic in my latest episode. Here's the QR code you can scan. It's Confidence in Trading, available on major podcast platforms. Just make sure you check it out. And last year, actually, if you're interested in learning a little bit more about the freedom aspect and balance between, your trading and your life work balance, so to say, Brett Steenbarger was on my podcast last year, 4th of July episode, and that's where we talked about it. So make sure you check that episode out as well. That's all I had for you today. I hope that I was able to inspire you and give you some food for thought and maybe some recognition so that you can build a little bit compassion for yourself and love, so that you stop beating yourself up that there is something wrong with you, because there are things on the back of your head that are running that need work, and repeating the same thing over and over again usually does not give you the same results. So stay in touch. Here are my social handles. And if you have any questions, you can always email me. I respond personally to every email. It's awood@aheadcoach.
Thank you so much, Agnieszka. Before you quit this speech, I'd like to ask you a few questions.
Sure.
Here, not via email. So the first question we have in our chat, Agnieszka, how do you think, why our brain default to impulsive behavior during high volatility moments, even when we have a solid plan in place?
Because we always default to our default programming. The way that we operate in life is like to see it as a sort of software. And Brett was talking about building habits. Everything we do is based on habitual behavior and habitual thinking. So whatever you do is written in your neurological level, and the connections, so to say, in your brain are responding to whatever happens outside. So when you really want to make a change in your behavior, addressing it from the behavior level is kind of, like you can do that, but if everything inside is driving you in a different direction, you are fighting with yourself, because you say you want one thing, but your behavior is steering you the other way. So changing that programming is just more efficient and effective way to actually do what you want.
Thank you so much. Another question. So you were speaking about plan. What is the plan for you? It is just in your head, or you can actually write it down? How you iterate the plan?
Yes, I love the question. It's definitely not just in my head, because that I think everyone can relate to this, that we are very good negotiators, right? We can negotiate with ourselves, talk ourselves out of decisions and into decisions like the best lawyer, right? The moment that we are under pressure, or the moment that we want something, we know exactly how to do that. When pressure is on, we're very, very good at this. So when you're making your plan, this is for you, like when you're outside of the market, the best is when it's actually the market, at least for the way that I trade, I make my plan outside of market hours, not when everything is moving, because then I can actually think straight and I agree with myself on things. And if I write them down and I have it in front of me later on, I can always relate and see why I made those decisions. If I don't do that, I probably won't even remember. I can tell you that I remember like one of my students when he was, we were talking about journaling, even simple thing of journaling. He was saying, yeah, but I don't need to write things down because I can remember them. And then he took the challenge and he started writing it down. He was absolutely stunned how many trades he was taking. He said, well, I thought I was taking maybe like 5 or 6, but I took 28. And that's a distortion that we can make with our head, with our thinking. And if you write your plan down, it's very clear on what is it that you agreed with yourself, right?
Thank you so much. And we have another question. Are there specific pre-trade rituals and checkpoints you could recommend to strengthen discipline under pressure?
Yes. And I will be talking about it in my masterclass as well. But one thing that I can tell you is start bringing into your rituals, into your daily practice, awareness. And journaling helps you with that. So I definitely recommend journaling, not just when you are trading, but building awareness is one of the most underestimated skill for traders. Becoming aware, how do you do the things you do? So I know that a lot of times people would ask themselves the question like, why did I do that? Why did I do that? And, you know, it's a very blaming question, right? It doesn't really invite you to look at why you did it, because just the way you ask it even is very judgmental. I like to ask the question, how? How did you do it? Because if you can recreate the actions, how you did something, you can actually become aware of where did that go wrong? What did I say to myself? Because a lot of times the decisions we are making, they're very rational. You would be surprised how rational we are when we trade under pressure. You might have said to yourself, if I lose this trade, I will never make it. And it might have been just a thought that crossed your mind, but it's a huge thing. It's an existential threat, right? Or you might tell yourself, if I'm red today, it's gone, like I will never be able to be successful, or whatever it is. You might say to yourself, if I take this loss, there is like nothing else for me. And a lot of times people will catastrophize. So those things, like if you are not aware of how do you program yourself every moment of the time that you are in front of the screen, but even throughout your life, you're falling into those default patterns. So start paying attention. And this is not something which is actually interesting, because it's not something you have to do. Because you see, the very first thing, the very first question is, what can I do? This is like our very first response. Okay, so I want to improve this. What can I do? Now, probably the answer that I'm saying, you just become aware, doesn't satisfy you, because it doesn't require you doing. It requires you just becoming aware, which means just quiet your mind, notice pay attention to what you are thinking. Pay attention what you're saying to yourself. How do you steer yourself in a certain direction? But people don't like to get quiet. They like doing.
Right. Thank you so much, Agnieszka. So a lot of insights in your speech. And so I don't say goodbye, because we will meet in a minute during our panel discussion. Thank you so much. Yes. And a short break for 1 minute and we will get back.
Great. Thank you, everyone, for participating. I appreciate your engagement. And thank you, Alex. See you soon.
Thank you. Yeah, so I'm muted again. Sorry for that. Hello, everyone, and welcome to all the speakers of our panel discussion. Please meet Wiley, the founder of The Positive Point, Peter Robbins, the trader with more than 50 years of experience, author of the number of books, Dr. Brett Steenbarger, a trading coach, author of a number of different books, and a great trading psychologist, and Animal Think, author of Mastering the Trading Within. Thank you so much for getting to this conversation, and also I see that Agnieszka is here. So Agnieszka, welcome back to our discussion. So the topic of our discussion is why traders know what to do but still don't do it. And I want to get straight to the point and ask you why do you think traders often know exactly what they should do but fail to execute in their live market conditions? What are your ideas? Let's start with Sue.
Oh, thank you. Hello, everybody. I would have to say that for me, it is belief. So they've got to have a trading plan or a structure that they believe in that gives them confidence to act. So that's what I'm going to be talking about today, is that structured process that keeps you on the right track and helps you to make decisions when you're under pressure.
So it's belief, right?
Yeah, and it's a structured process. And I liked what Agnieszka was saying earlier about your awareness of the market and your awareness of the market and your structure and your process within that awareness.
Thank you so much. Peter, what do you think? What could be the reason?
Yeah, well, first I'd just like to comment that so great presentations from Brett and Agnieszka, and you've already, I think, covered a lot of those answers to that question in your presentations, right? But I think the thing is, I call it rule breaking, right? We break our rules, and it isn't a knowledge problem. It's a emotional management problem, right? And I think, Agnieszka, you talked about survival state versus a regulated state, right? So this, especially a lot of new traders, they're dealing from an emotional perspective, and how they manage that. And Brad, I know in your conversation, you brought up a couple of really interesting points, and that is that a lot of traders just don't have the skill set to be successful. They have the knowledge, they do the first steps to build that, but then they're struggling in this emotional environment, right, where they have to deal with these issues. And a lot of them, you made another comment about a lot of traders don't have enough capital to actually make a living or make what they expect to make, right? So they come with these unrealistic expectations, and they think, oh, I got a $5,000 account, I can trade for a living, and they end up, again, increasing risk, increasing all these things that actually makes it even worse from an environmental perspective, right? Because they're dealing with this extra pressure on top of just trying to learn the skills and trying to get experience. But so really, they're increasing risk when they really should be reducing it, and a lot of that ends up being, again, making all these steps, not honoring their stops, oversizing, taking profits early. And so again, on paper, rules are simple, but in practice, rules turn into really a stressful test. And a lot of them are failing that, right, by not doing what they know they should be doing. So just a couple of points based on what we've heard so far today.
Thank you so much. Brett, do you agree that it is a question of emotional management, or maybe there are any reasons?
Yeah, I'll play devil's advocate here. And thanks for having me. Really appreciate it, and really appreciate being part of this panel. It's a great panel. Traders don't always know what they're supposed to do. And I'll use myself as a trader as an example. As it happens, this very morning, I placed a trade and ended up getting out of the trade, making some money. I was short the S&P futures, and the trade was based on something I had learned when researching markets. And when I started out, I didn't know about this. I looked at charts the usual way, what I ended up doing was drawing bars on a chart where the bars are denominated in volume, not time. So every certain number of contracts traded, you draw a new bar, open, high, low, close. And what happens is that when you look at volume time and not chronological time, cycles in the market become much more clear. And I learned this working with someone named John Ehlers, E-H-L-E-R-S. Well, back when I was a relatively new trader, I didn't know that. I had no idea. And it turned out that that cyclical view ended up being very helpful in getting out of the trade and taking profits and so forth. So a lot of times we think we know something, we end up not doing it because we don't really know. But when we've done the research and we see it in real time, in real practice, we internalize it, and then it's much easier to act on our convictions.
Thank you so much. Thank you so much. Agnieszka, what is your point of view?
Yeah, I can think of so many reasons why we don't do what we should do. And I love all your perspectives. And I think, this is a topic, like if we knew why, then probably we wouldn't be here, because then everybody would do what they should do. And the first thing that kind of comes up is the whole word should. Like people generally don't like doing what they should be doing because it creates a kind of pressure again. And then it becomes a matter of being disciplined or not. It's like when you want to do something, it's a very different perception and very different approach to it. So when traders come into the market and they say, I have this plan and I should be doing this, they're in a situation where they know that they need to do it, but everything in them is just reacting differently to certainty, right? They have to make decisions that they have planned, but then uncertainty comes in and they have to make those decisions without knowing if they're right decisions. So like Sue said, there is this part of confidence that starts to wonkle and is like, I don't know. And they start second guessing themselves. They start to question whether the plan is actually good or not. And a lot of times they just choose to do something different because they're unsure if this is going to work. Now, one more thing that I think that adds to this confusion is that's where people put focus on. Most traders, they focus on the result and not on the effort. They focus not on the process, they focus on how much money am I making. And I think Brett was talking about it before, P&L. It's like you can, like in trading, it's a long-term view. You cannot judge yourself or measure your performance based on one trade or even a day or a week. You got to zoom out and step back and now look, okay, this is the plan. This is not just a plan that works for today, but today's plan is a plan of a big plan. And having that overview gives you so much more confidence about why the plan for today looks like this and how that looks in a bigger picture. So that I think builds much more confidence. And I'm so happy that Sue will be talking about the process and all that later on.
Yeah, thank you so much. Anmol, your opinion on this question?
Yeah, I mean, I think trading psychology is such a fascinating thing, but it's the same as life in general. Like a lot of people, they're like, I want to get in shape. I'm like, okay, do this, but they don't do it, right? So it's not the lack of knowledge. They have the information, they have the knowledge, they just don't know how to implement it, or they can't get themselves to implement it. And majority of that, in my opinion, is because of lack of consequences. Because, I grew up in the prop firm days. There's consequences. If you don't do what you're supposed to do, there's consequences, right? You can get demoted, you can get fired, you can get, your commission raised. There's a lot of things, there are consequences that hurt traders. Whereas retail traders trading from home, they don't have any consequence structure. It's so easy to make a mistake, close your laptop. Nobody will ever find out what I just did. So they have an escape mechanism there. So I think they have to set some consequence structures. So a lot of the people in my firm, we have consequence structures. Like if they have to post every single day their planned adherence percentage, so they're accountable to each other. and all of the people are assigned in different pods. So they keep each other accountable and they have to submit reports. So I think the difference really from retail trading standpoint is not having the structures in place, not having consequences in place, and not having somebody to hold them accountable, because they're not answerable to anybody. And when you're not answerable to anybody, it's very easy to fall into an emotional trap. So I think that's one of the biggest aspects. But then the other is discipline. But then discipline is enforced through consequences, for at least for my firm and majority of the firm. So I think that is what I think is lacking, emotional control. And I think I heard a lot of people talk about awareness, and that is 100% true, right? You have to do the inner work, because how you treat life is how you're going to show up in trading as well. Because, you tell people, hey, do this is the strategy, and they don't implement it. So there's a lack of integrity there. They say they want to do something. They'll say they want a result, but the actions show completely the opposite. And the way they can get the confidence is through having a trading plan, and that trading plan has to be back tested over different market environments to see how that would have performed. And then they have to basically stick to the plan, just like a casino would. You could go in a casino and win $1 million. They're not going to mind. They're going to say, here's some free drinks, keep playing, because they know their edge. The longer you play, they'll come out ahead. So I think that's one of the things that people need to cultivate: discipline, confidence, through back testing, and then implementing it through a consequence structure.
Thank you so much. Speaking about consequences, is it true that the retail traders, they do not have consequences of their decisions? They lose money.
Yeah, the consequences, they lose money, but people make mistakes. They go to even the casinos, they'll lose money, but that consequence is the consequence that they're going to feel, but nobody's holding them accountable. So they'll keep repeating that mistake, because humans are we're very fascinating people, me included. I made a lot of mistakes early on, and I still do from time to time. But when you have a consequence, knowing that somebody's looking over your shoulder, like if you had a boss or a CEO, like if you are in a job and your boss tells you to do something and you don't, there's going to be consequences. You could be laid off. But now if you're an entrepreneur, you got a little bit more leeway, right? Because you don't have those structures in place. So a lot of people, they are not attuned to that structure. They're not used to that, right? So when people leave a job and go in entrepreneurship, they face the exact same issue. Nobody's telling them what to do. You have to make your own to-do list yourself and hold yourself accountable. So self-accountability is very key.
Brett, you are working with hedge funds. Do you agree with this position?
Yeah, and I think a lot of the reason why hedge fund portfolio managers will meet with someone who's a trading coach is precisely what you're saying, Amnul, that they're holding themselves accountable. So they typically will review their performance. What did they do well? What did they not do well? And they want to learn both from what they did well and also what they could improve, so that there's accountability not only for the bad trading, there's accountability for all performance, including the really good performance, because perhaps that's something you could expand going forward. I think one of the big advantages of working with someone who is a coach is that you create a structure for looking at the best of you and the worst of you, learning from both and improving.
So I see you agree with Brett.
I love the point about accountability. That is so true. And one of the methodologies that I use is put training wheels on. So trade really small and understand the kind of stock that you're looking at. Are you looking at a Robinhood, which is I call them buckaroos. They're going to move all around all over the place. You better know what you're doing. Or are you looking at a Coca-Cola, slow and steady, methodical trade? So I encourage students to start off with the slow and steady, more predictable chart patterns, and put training wheels on by really starting with small positions and legging in one leg at a time and understanding the big picture. It's always really important, I think, to understand the big trend picture so that you're not making decisions. At least I'm a position trader, so I'm not necessarily making big decisions on a daily basis. It just has to stay in the pattern for the week and then the month. And so to summarize, there's a difference between a Robinhood or a GameStop and a Coca-Cola or a Lowe's corporation. And I encourage newbies to start off with those slow and steady kinds of stocks and charts.
Okay, and you are a leader of the Canadian trading community. And speaking about accountability, so during the Brett's Q&A session, we discussed the use of the trading communities and how they help the traders to become more conscious, more aware. So, what do you think about your community? So, does it give the traders some points in accountability?
Absolutely. So, in my Empowered Investor Pathway program, the students have. We each have our own portfolios that we are running independently and legging into positions. And we show those every week. We show the progress. And it's a learning thing. It's not an embarrassing thing. It's just like, let's critique each other's performance for the past month. Why did you choose that particular chart? Why'd you leg in there? And it's very, it's right in front of everybody for them to see, so we can weed the garden. And some people tend to jump in and add that second leg too quickly. Well, we have to fix that. And so next month it'll be better. So that's how we do it.
Okay. Peter, you have a lot of years of your trading experience. What do you think about this question of accountability of the retail traders?
You're making me feel old. Well, again, I think we're getting into solutions to the problem. I just want to go back a step for a sec. So Brett made the assumption a lot of people don't know what they need to do. So let's just start with the assumption that people know what they need to do. Then the question is, why don't they do it, right? And I think the analogy that I'm always saying about dieting is a great example, right? Where people know how to lose weight, but they don't do it, right? So why don't they do it? And so a lot of that is around either pain avoidance or pleasure seeking, right? So, and this is very much true in trading. So, pain avoidance, we talk about fear and greed, right? So we're scared, we're going to lose money, our money's on the line, so we do things to avoid that. And likewise, pleasure seeking, we're greedy, we're trying to get dopamine fixes, whatever, right? So avoiding the pain of being wrong is a very easy one to do, right? And that's where we see where people refuse to take their stops, or they hold on to long-term positions that are holding in a loss. And then the other side of it is, for dieting, as an example, well, one donut won't hurt me, right? Well, they just want that dopamine fix, short-term fix, and they continuously do that. And then the other pieces around the ego, right, and needing to be right, and making decisions, short-term gain for long-term pain. And often people are taking profits too early because they just want to have that good feeling, right? And so a lot of these come down to, okay, these are the real psychological issues we're talking about, that people have that thing. So the question then becomes, how do you get over that? And to Sue's point, right? So I agree 100%. Ultimately, traders need self-respect. It's just like committing to a diet as an example, right? They need to like themselves. They need to understand the long-term or the short-term consequences of what they're doing, and then build a structure around that, right? And part of that is, starting with having rules, having systems, having processes that tell you what you should be doing, so you do know, and then having a support system like what Sue's providing, say, to her clients as an example. It's like, okay, these are the rules. Having a partner, having a trading partner, having a team like what Brett works with that can hold each other accountable is huge, right? Because it's so easy as a individual retail trader just to keep making the same mistakes over and over. And so, yeah, I agree that that type of support is critical to long-term success.
Mm-hmm. Agnieszka, you spoke a lot about awareness in your speech. So how does awareness help traders to do things cautiously and do what they really know?
Before I get there, would like to add something to accountability, because I really love what Sue said and Peter about, if that's okay, Alex, is that
Absolutely,
all right?
absolutely.
Because I think the big part of the accountability is that people have the pain avoidance. And this is one of the reasons why they don't want to look at their stats. They don't want to see what they did wrong. They don't want to journal because they don't want to face what they actually did. And Sue was mentioning that in your community, so you have, the community is safe enough. And I think that one of the big, and I call it a skill, is a skill of vulnerability. Most people are not vulnerable because it means unsafe. But as a trader, you have to learn to be more vulnerable, because you are literally exposing yourself to the market and are willing to take a punch right in your face every single day, because this is how losses feel for many people. Basically, we are programmed losses bad, right? If you would ask someone, you would say to your friend, hey, listen, I got this new job and I'll be losing money. They would say, you are crazy, right? This is like in our head coming into trading. And we all know, yes, losses are part of trading, and everyone rationally, cognitively, we know that. But like every single trader that I have met does not like take losses. They don't want to take losses, right? So internally, there is a resistance to it. And market exposes that vulnerability. And in order to be self-accountable and have that skill, develop that skill, you got to work on developing vulnerability more and being willing to expose yourself, not just to the market, but also to yourself, and understanding that mistakes are not something to be afraid of. They're not something to judge yourself for, but something that are actually a condition for you to move forward. So I think that reprogramming that part of your self-protection system is really important. This is what I do. I help traders with in my programs. But I think that part of vulnerability is a condition of accountability. And now awareness. You say, how do you build awareness? Was that your question?
Yeah.
Yes. How do you build awareness? It's a very interesting question, is because this is basically just noticing. The act of building awareness is by noticing what is it that you are, what is it that's present in terms of your physical experience, what emotions are present, what body sensations are present when you are when you are trading, what is present in your head. Because everything that we do begins as a thought in our mind. So we program ourselves constantly into action. And when you are not aware of how do you program yourself, it's not very easy to change your behavior. It's like, you're trying to build some muscles on one hand and get a six-pack, but then you come home and you eat very fatty food and you're like sabotaging yourself. So becoming aware is really a process of just noticing. Journaling helps a lot with that, because that's the moment where you really take time, and there are different types of journaling that you can do to really see, okay, what is it that I'm thinking? What am I saying to myself? What am I talking, like, how am I talking to myself? How am I putting myself, like, what kind of identity I'm giving myself as a trader? And am I doing that is aligned, the way that it is aligned with what I want? Or is it that I'm constantly scolding myself for not doing the right things? Because as Brett wrote in his new book, that is not enough. You got to also emphasize the things you do good. You cannot keep scolding yourself for doing things wrong.
Thank you so much. I think the point you mentioned, the point about vulnerability, is very interesting. So, dear colleagues, do you have any opinions on this point? So should the traders really be vulnerable, and it will help them?
I would say absolutely to that. I completely agree. And when you're in a safe environment where you can come forward with your little, excuse me, the little things that you do wrong, and you feel safe, and you feel safe to own up to it, then it feels more productive in terms of fixing it. So I think that's absolutely essential.
Mm-hmm. Okay. Anmol, I have a question to you. So, what is the influence of the trading environment to the trading awareness, to the trading stability and vulnerability? What do you think?
Yeah, I think when I want to touch upon like the vulnerability, and we come to this question in a bit, but yeah, 100% important. Like when I usually start my calls, we usually call it like, all right, confession time, like who broke your plan? Because I know there's somebody out there who did. So it's really important to be open and vulnerable, because that's how you gain awareness, right? Because once you realize what you're doing wrong, now you have awareness of it. Once you have awareness of it, you can totally fix it. Now to go back to your other question, I think people have different trading strategies, different styles. But my style is more of a set it and forget it, bracket orders and manage it on a different sort of basis, pre-planning things rather than deciding it in the moment. Because for me, what I've noticed is, and also for other traders that I've coached, is when you're looking at the chart and just staring at it and you're just sitting in front of your computer, you're human. You will be tempted, right? You're going to either get fear of missing out. Maybe there's nothing good out there in this market environment. Today is a great example of that. I have some swing trades going, but for day trades, I was like, it's not really conducive to my strategy. So I was happy to sit back and just wait and not do anything. But if a trader is just sitting there, especially a newer trader without any guardrails or without any guidelines, they're sitting there, they will get tempted. And a community can be great for traders, but it could also harm them. It's like a double-edged sword. Because in the community, they see all the guys in the chat room, hey, I did this, I traded that. Maybe your strategy doesn't have any good setup at that moment, but you get tempted. Well, look at everybody else doing so great. Let me also find a trade. And then they manufacture a trade, they bend their rules, and then they end up trading something that was not part of their trading plan. So I think that the only way you can get rid of the movement of the market in real time is to have a system. Like you have to have a system that has clear, well-defined guidelines. It has rules when you're going to get out, when you're going to get in, and you've already accepted that loss as like a 1 hour trade, right? So you're risking what you were already intending to lose, and you're okay with it. So when you're okay with that loss, it doesn't matter if it's heading to your loss. That's what the stop loss is for, to get you out at your pre-planned loss. So I think the only way to get rid of those emotions in day-to-day is to have guidelines, to have rules, and more importantly is to stick to it, follow it. Because once you get that, then it just literally becomes almost like a numbers game, right? If you know that you have a 50% win rate, 50% loss rate, so you're really losing half your trades, but that's okay. If your expectancy is high, if your Sharpe ratio or your average win to loss ratio is 2-1, you only really need to be right 40% of the time. Once you know that, then the loss doesn't affect you, right? But you only know that if you've back tested it and you have years of data to prove that those numbers hold true. So I think that's how you get over it. But it'll still happen. It happens to the best of us in real-time market environment. The key is to be aware of it and catch it before you act on your emotions.
Thank you so much. Okay, so do you agree with the Anmol position?
Mm-hmm.
Okay, so I have one concern about the system. The system is a good thing, but the question is how to implement the system, how to follow the system, and how to make the right decision. And this is the core question. So the majority of the new traders, they do have rules, but they do not follow these rules. So how to manage it? And Peter, do you have any suggestion on it?
Yeah, so I just want to make a comment first of all on the market environment, because I think that was the last point, right? That just a point about coming back to what I noticed over with a lot of traders is they don't spend a lot of time looking at what the market environment is. They just have some strategy that doesn't include that. So it sort of comes back to Brett's point about, well, they don't know what to do, right? And a lot of them think they know what to do, but they don't factor in the environment into that equation, right? And a lot of times they're trading something that is, I forget, Sue, what you called hood, but they're trading a wild stock and 1 minute, and then the next minute they're trading something that's very low volatile and simple, right? And not factoring that into the equation. So I just want to make that point about, and then there's that, the instrument they're actually trading, and then there's the environment they're trading in, right? So someone mentioned, again, either a market's trending or it's in a consolidation phase. Those are two different strategies, two different environments and approaches that you should be adjusting depending on where that's at, either standing aside if you're a trend trader or, taking advantage of it if you're trade channels. So anyway, just factoring that in is critical to, because they might get lose a trade in an environment they shouldn't even be in. And then, so understanding that as part of that, right? But I think coming back to your question then around, okay, what are some of the approaches you can do to actually help to deal with this? So a lot of it is like Agnieszka started, like being aware, starting to understand things better, getting more knowledge. But I think a lot of it is, again, building practice in a lower risk environment, especially as a new person. It's like if you're going to learn how to sail, you don't go out in a really windy environment with high waves. You start off in a calm environment and learn the skill set. So building that up, right? And then a lot of it is, I know Agnieszka talked about tools, not relying on them, but these tools, there's a lot of tools out there to help build good habits and learn things faster and get experience better, right? So, like having a pre-trade checklist and, having hard rules around your entry and exit and stop loss, and, having limits on how much you trade in a day or how many losses you'll take in a row before you cool down. Post-trade review, we talked about journaling, all of these things. So these are all critical sort of things to help you build those skill sets. And hopefully, if you are looking at it seriously and taking that accountability aspect into it as well, that, over time that it develops. But I like, Sue, your point about, same thing I do, right? I encourage people start off slow, start off with very low risk trades and build up the skill set over time, right? Instead of what most people do is they jump into day trading, 4x with 400 times leverage, and it's it's hard to build up that skill set in that type of environment. So
okay, thank you. Sue, I see that you agree with Peter.
I totally agree. I think that's a super, super important point that he just made about understanding the overall market context. So important. So we are laser focused on what the S&P 500 is doing monthly, weekly, daily. That is our main guide. So we get laser focused on the S&P 500 sector rotation. And so having that market context. So when you're making a decision, am I getting into the deep end or the shallow end? Am I going to be okay? And I would have to say the group of folks in my group are more investors than traders. So we are positioning for long-term price action. So typically that's going to be more like months as opposed to days or weeks. Obviously, it depends on the chart and how the chart shapes up, but that's our goal. So it's learning how to read a stock chart, identifying those really solid areas of support, being in super, super high quality names, like the best of the best. And if the best of the best is sitting at a really strong area of support in a rising market environment, she's going higher, right? A really high quality stock at support in a rising market environment is likely not going to stay there long. So now you just have to have structured decision making around how you're going to leg in, stay safe, stay unemotional. So the legging in thing, leg one, you take leg one, week one, and it gets to it wobbles on you. Am I emotional? No, because I've only got one leg in. So it really helps with my emotion. And then I build leg two, and then I build leg three as the chart develops and it goes in the direction I'm expecting it to. So having that psychological cushion is super important, and that market context.
Yeah, that's what we discussed with Brett, right? So it's important to have some other life with the trading, right? Okay, Brett, I want to ask you, speaking about the external environment, how could you describe this pressure that traders feel reading some bad news, market news, seeing the lost position and so on? So what do they feel?
Okay, let me address one thing first, and then I'll get to your question, Alex. It's a good question. What I found, particularly with very active traders, is that what they trade ends up being every bit as important as how they trade. Being in the right places is just as important as how they put on positions and hold positions and so forth. And so if they have a structured system for finding opportunity, then that itself is a confidence builder. So your question, Alex?
Yeah, my question was about the feelings. So about the pressure from the market, from the news side, from some external factors to the on the traders. So what can they feel and how to cope with these feelings?
Yes, this is Molly. She is from Thailand. She's a Kalmani, a relatively rare cat in the U.S. And anyway, she likes to get on video. She's
Hi.
Yeah, quite taken with herself. Anyway, yes. So, processing news, a news item comes out and it contradicts what we've been thinking. Our position goes against us, that type of thing. That can be really destabilizing. So what I find that the more successful traders do is they are anticipating news events or potential news events and playing out in their mind what if scenarios. Okay, what if we break this level? What if there's an attack on oil facilities in the Middle East? What if, and so they already are thinking through what would it mean? How would I respond? And so they're not frozen and they're certainly not panicked.
Mm-hmm. Okay. Yeah. So it's a good scenario, but the majority of traders, they just feel fear, right? And they react to fear, and they forgot everything they know, and they are starting to act, spontaneously with the consequences, unfortunately, right?
A person will feel fear if they don't understand what's going on and if they haven't done anything to prepare for it. And so, this is one of those situations where prevention is the better part of cure. That if they become aware, if they rehearse what could happen, if we break this level, if we break that level, if news events come out this way, if the Federal Reserve suddenly hikes interest rates and markets do this, what would I think about it? How would I respond? That's all part of preparation before the market opens. So you're less likely to get surprised, and you're certainly less likely to get frozen because you're not prepared.
Thank you so much. Agnieszka, I see that you agreed with Brett, right?
Yeah, I think what really resonates is the preparation before the market, really putting yourself in the right state of mind of, we don't know what's going to happen, but what we can do is prepare ourselves. If something happens, how do we want to respond to it, instead of just waiting when it happens and then being very reactive. So there are just few scenarios that might happen, right? The price might just hang there, or might go up, or might go down. And what is it that you are going to do? So when you prepare yourself for that, it's much easier to have that confidence and looking at it, okay, which scenario is actually playing out in front of me. one thing that I saw also in the chat as a question, and we were actually talking about it just before Brett was responding to your question, was about that context, the market context, which I think is also important to mention, that there's also a life context, and that when you start trading and you want to trade for a living, there's this life context that you have to look at. It's a long-term view. This is not about, okay, I'm just now hopping on the train and I'm going to be making money tomorrow, because that doesn't happen in reality. Maybe you see it on social media, but this is not how you can actually sustain your performance. And I think one of the questions I saw in the chat, what do you do if you have pressure to pay your bills from trading? I can tell you that if you have pressure to pay your bills, go and find something that will pay your bills. Do not put the pressure on yourself at this moment. Like if you really need the money and you are not consistent yet with trading to pay your bills, don't add that extra pressure, because it's gonna work against you. So instead of asking, how am I gonna do it? Create the right conditions so that you don't expose yourself to that kind of split, because it really puts you in a split. Yeah, and just being fair to yourself, like knowing, like, okay, what is the timeline that I give myself to succeed in this? Because again, this doesn't happen overnight. And Peter can tell you, after all the years in the market, that, you know, the moment that you think you've got it, the market changes, and then you can start sort of over with like, okay, let's see now, is like, how is that working now? I have not experienced it yet. So it really, and this is also the reason why a lot of traders get into trading, right? Because that's exactly the exciting part, because it's constantly changing and we like challenges. But don't create extra challenges for yourself, because market is challenging enough. So give yourself a fair chance.
Thank you so much. Anmol, I saw that you agreed with Agnieszka, right? What do you think about this?
Yeah, I mean, I agree with everything she said, and it's so true. Because if you are putting pressure on yourself to make money from trading, especially when you're new, you're absolutely going to make decisions under pressure, and you're not being objective anymore. Because now you have a subjective thing of wanting to pay your bills. And when subjectivity comes in, well, you lose all sense of your rules. And I've seen that over and over with traders, where they come in, there's nothing good out there. They should just be sitting on their hands and not pushing any buttons today. But you know, I'm behind on my thing, my bills or whatever. And then they're going to just take a random trade and they're going to dig themselves into a further hole. And likewise, even if the trade is working, let's say they have a profit target of 2R or 3R. Now the trade is up 1-1. Technically, they should be holding on for their target. But the fear kicks in, like, I don't want to give it back because I haven't had a good month so far. And then they end up break their rules and they take their profit early. So I think everything Agnieszka has shared, 100% agree with that. And you should definitely not put that kind of pressure, because it's a very scarcity mindset. You know, you should have a long-term vision of where you want to be, because people underestimate, and years go by fast. I mean, can you believe it's six years since 2020 already? Time flies. So if you give yourself a long enough time horizon, it'll go by fast if you do things the right way. But if you try to get there now, like instantly, it doesn't exist. That's all social media hype that you see all around online, but that's not real. You know, that's somebody else's highlight reel. And you don't know what their process was. You don't know what their system was. And you don't even know how much they were risking to make that amount of money. So I think a lot of those things and your account size all have to be factored in. And, you know, if you're going to make a living from trading, you can't be undercapitalized, number one. And you have to have the long enough time frame, the stickability to stick around, because the first couple of years are the hardest. So you have to have that stickability, and you can have that with some rules and risk management guidelines.
Thank you so much. I have a question to Peter. Is it possible to be a retail trader and to live only from trading?
Well, I think Brett answered that earlier today, right? That sure you can if you have a large enough capital base, right? I think coming back to the other point too is that I think you can be prepared in trading, but you have to be realistic, right? And you have to understand the market. You have to understand what can happen, right? So it's, you know, I've seen so many new traders, and I always use the example of when Bitcoin was becoming very popular back, I don't know, 10 years ago or whatever, right? And there was a lot of, I remember my daughter was in university at the time, and I would pick her up at the bus station, and there was a coffee shop there I would sit in, and I would sit beside these students, and they were at that time sitting on their phones, opening up, I don't know whether it was Robinhood at the time or some crypto exchange. They're taking the tuition money that they had and putting it into these accounts, buying Bitcoin, and literally they were doing it like a week before the tuition had to be paid to the university, and they were losing it and then not being able to go to university, right? Because all they saw was, this is only going up. This is going to make me a ton of money. I'll be able to pay for the rest of my university for, the next 4 years and then some. And literally they have to call up their parents to say, the money I have for the tuition is gone. But again, being prepared for that, being prepared and having realistic expectations is something that, a lot of people get burned from right off the bat, right? So, and likewise to your question about, can a retail trader make a living? I had someone, DM me the other day, and he's like, he says, I was talking about realistic sort of returns. And I know, Brett, today you said 10% is a good return, 20% would be a great return for some of these hedge funds, right? And this guy's saying, well, if I can't make 400% a year, why am I even bothered trading, right? So it's like, so just, again, coming to the game, really understanding it before you get involved and being prepared is you can't prepare for something that you don't even know, right? So anyway, can you make a living? Yes, with a large enough capital base. I think there's a lot of people, if they decided that trading should supplement their income, continue working, they'd be a lot better off, right? Because a lot of them that end up leaving, the 90% we were talking about earlier that leave the business, it's probably because they thought they could make a living at it instead of just having it as a supplement. So
thank you so much. It's about realistic point of view, and we have like seven minutes, and I want to ask you the final question. So what practice could you recommend to traders to develop this realistic point of view, to know what to do and to do it finally?
Yeah, I can jump in. So I think for me, I come from like a very system standpoint. Is like you have to have a system, because then you know what to expect, and when you get a drawdown, you're not fearing the drawdown, and emotions don't impact you because you've back tested so many of your trades over the years in different environments that you know that this strategy, let's say, is going to lose X amount. So when you are losing that, you don't start going into self-doubt. Like, am I really got it? Do I have it? Can I do it? It's not about that anymore. So I think for me, I'm a very like systems based rather than like a gut feel based. Because when you have a gut feel based systems, and I know a lot of traders that make great amount of money, but the problem with that is it's hard to really build, a tracked system that you can have a predictable outcome on. And even in a system, there's going to be, events that are unpredictable. But in a large enough sample size, you're going to expect it to fall where the system tells you to fall. So I think once you create that, number one, and the biggest mistake traders make when creating a system is they think they have a trading plan. They think they have all these guidelines and rules, but the rules are not specific. So let's use market environment. Some traders might say, Anmol, I was in this trade. I know the target was over here, but the market environment didn't look right, so I ended up getting out early. I'm like, okay, you got to define it. What does that mean, doesn't look right? Because that could be subjective again. Now we're going into subjectivity, because for one person, it could be looks great. Other person could not look great. So what rules will you use to define that it doesn't look great? What does the chart or the stock have to do to tell you the environment is not great? Because once you have rules, then it's repeatable. It's a system, right? So you can repeat it over and over. And my systems remain the same largely over the last few years, is because it's been tested in different environments, and you have very specific rules. If this, then that statements. So if this happens, then I'm going to do this. The stock pulls back here, maybe breaks under the VWAP, I'm going to do this. So when you have rules, then you can almost take your emotions out, and you can just start executing on the system, knowing that it's going to produce results in a large enough sample size. So that's kind of what I would leave people with, is to make your rules specific, right? And ask yourself, like, what does the stock have to do? Tangibly, not like it doesn't look right or it doesn't feel right, because now we're going into subjectivity. So be objective.
Thank you so much. Thank you, Anmol. Any other recommendations, suggestions?
I can go. So okay, I can go. So just kind of circling back to what Peter said about making a living trading. I think one of the things that a lot of traders do not realize is that when you trade for a living, that it cannot become a situation where you live for trading. So in order to be able to actually sustain your performance, you have to be able to disconnect yourself from trading. For many traders, that's impossible because they evaluate themselves as a person and how they feel about themselves through their performance. So you might want to trade full time, but you might not be able to do it. And I'm not saying financially, but psychologically. And it might drain you and eventually burn you out because not being able to actually enjoy your life while you're trading, because every time you take a loss, you think there's something wrong with you or you don't feel good about yourself. So my tip would be start with doing something that you really enjoy when you have a red day. So start disconnecting yourself from your own worth, from your results, because that will really help you to take losses, stay less connected to the end result and more focused on the process. And then eventually when you do trade for a living, to actually enjoy your life while you're doing that, because isn't that the reason why you want to trade for a living? So when you have a loss or when you have a red day, instead of beating yourself up for it and trying to figure out what is it that I need to do different, yes, evaluate your trades, absolutely, but also go out, do something that you really enjoy so that you can show yourself some compassion and love and not just beat yourself up.
Thank you so much. You started talking.
So I would say, and everyone has touched on this, Peter, Amal, and everybody, context and market awareness. And so you've just got to work at it. You have to continue to work at it, iterate. And for me, it's, if I were going to give direct advice, it would be study the S&P 500 and the 11 individual sectors within the S&P 500 and watch how they rotate and they pass the baton to one another, because that's going to give you a really good sense and build your market awareness. So work at it and build your market awareness.
Thank you so much. Peter, your tip.
Sure. So this is an area that really frustrates me because I see so many people attempting to trade and knowing that they probably could succeed at it, but they fail because they don't come at it with the right approach, right? And so I have a book coming out next week. I'll just do the shameless plug for that. But I wrote a book called The Trader's Journey, which really documents all the different steps that really can help you get to a better foundation, real hard truths and education plan, strategy, etc. So just want to make that comment. And then, but I think the other one around community, right? So unfortunately, in our day and age with social media and things, it's so easy to get caught up in unrealistic expectations. We hear them every day, right? We're all sort of professional trading people here, and we see that and know what's real and what isn't, but the average person doesn't, and it's easy to get caught up in that. So one of the recommendations I would make is coming back to this thing of trading community, right? Find a community, find a group of people that actually trade and actually have experience, and spend time with them and really get a firm foundation from that, right? Because it's so easy to listen to the wrong people online and get caught up in that. So find a local group. So there's traders everywhere, right? So find some people that you can socialize with. I mean, our group, like I know Sue, your group is great. Find a group of like-minded people, like-minded approach, and really that can help build that foundation and realistic expectations.
Thank you so much, Peter. And Brett, final tip for you.
My tip is to get Peter's book. Lift the offer. Go for it. Yeah. I'll just echo something Sue said that I really like. She mentioned about the S&P 500, and she mentioned about the activity within the sectors of the S&P 500. So you look at the large institutions that are allocating capital to equity markets, and sometimes they are allocating more capital to stocks. And in that environment, everything goes up. There's just more volume, there's more activity. And sometimes they pull back from equities for the safety of bonds and other kinds of investments. And you can see everything coming down. But many, many, many times the activity is rotational. They're not adding a whole lot of money. They're not subtracting a whole lot of money, but they're taking money out of one area and putting it in another area. Like taking money out of consumer-related areas and putting it into commodity-related areas, which is happening just recently. And it's happening because that's where the resources are for the AI industry. So if you know how these larger institutions are thinking, then you have an opportunity to adapt and follow that. When we get down on ourselves about our own performance, we're thinking about me, my P&L, what I did. And we're not seeing what's going on in the whole world and in markets. And sometimes broadening our vision is the best way of responding to challenging situations.
Thank you so much. Thank you so much, everyone. Thank you for joining this discussion. It was a wonderful discussion. Thank you. Your speeches will be the next. We'll see you in a few minutes. And thank you all. Have a good day. And we'll get back in a few minutes.
Thanks, everybody.
Well, we are back. Welcome back. And we have the next speaker. it is Sue O'Reilly, founder of the Positive Point, creator of the Empowered Investor Pathway. So Sue will be speaking about the structure and process, trading psychology, the power of process, how structure and process help to eliminate emotional decisions. Sue, thank you so much for coming, and the stage is yours.
Thank you very much. I'm going to put my presentation up now. Let me know if you can see it.
Not yet.
Not yet. Okay. And then I also, Alex, I have some things for the chat that I'm going to put in there, if that's okay.
Absolutely. Yeah, you're welcome.
Let me see if I can, whoops, a daisy. Oops, a daisy. Sorry, guys. All right. So present. Share screen. Share screen. Can you see my screen now?
No, not yet. Unfortunately, we cannot see it.
Sorry about that, guys.
No worries. It's okay.
Wait a minute. Okay, hold on. So I hit the present, share screen. Choose what share entire screen. Sorry about that. Okay, now I've got it.
It's okay. Yeah, now we can see you.
Okay, sorry about that. And Alex was so good about practicing with me, and so you can see it now?
Yeah, absolutely.
Okay, thank you, everybody. And I am thrilled to be here for this very high quality event. I know Alex and his team put on tremendous events every year. And today I want to talk to you about the power of process and how a structure and process-driven decision-making system will eliminate emotional trading decisions and help to build long-term consistency. Before I get into my presentation, though, I've always got to read the disclaimer. The content of this video presentation is for educational and illustrative purposes only. It does not constitute either investment advice or a buy-sell recommendation of any kind. I always get so excited when I look at charts. And so if I do get excited, it's not that I'm recommending it to you. You always have to do your own homework. And so I think we can all agree that the biggest enemy to your success is emotion. Emotion is your psychological edge is going to be to discipline that emotion with a disciplined structure. And here's what I want to say, not an opinion. So I'm going to share with you today a 5-step process that I have developed that has really helped me in making decisions and staying unemotional when it's really, really tough to stay unemotional. I'm also going to give you a checklist that goes along with the 5 points I'm going to put together in the structure. So you're going to get 2 things. You're going to get the 5 points, and you're going to get a checklist to build and fortify your mental framework and help keep you on track when things get really emotional. And I want to say that I run an investment group. It's called the Empowered Investor Pathway, and we are a little bit different in that we're not so much traders as we are investors. And our goal is to really understand the market to the best of our ability, and we do that by really studying the S&P 500 and the sectors and putting together a plan that allows us to build positions into the market in a slow and steady way. And so what we do is we endeavor to engineer calm. That's what our goal is. We want to be really calm, clear thinkers. We want to turn doubt into conviction. So who am I? My name is Sue O'Reilly, and I have a company called The Positive Point where I coach individuals on how to become better investors and traders. And last fall, I launched the Empowered Investor Pathway. It's an online program where someone who has been around a long time like me can help you navigate the markets. And when I say I've been around a long time, here is a very long-term chart of the S&P 500. We're looking at monthly time frame here. And this chart starts back in 1977. And here's what I want to say. This dot-com bubble thing here, I was around for that. I was young, but I was very aware of it. And I had enough in savings to really feel the hit when that happened. And then again, the financial crisis here, where everything fell and it was kind of like a waterfall. And so these two events really informed me. And I said to myself, that's it. No way. I'm going to have a process for understanding the market and making decisions so that when stuff like this happens, I can get out of the way. So this part of the chart, the left part of the chart, most people that are watching this have never lived through. They wouldn't have experienced it. They've only experienced this. Look at this S&P 500 from, this is 2011. It started to catch that beautiful trend, and look what it has done ever since. So every time the market corrects, it comes back to this blue line and it recovers. So in my community, we are religion about the blue line. The blue line is our really important indicator. And the blue line is the 50-period simple moving average. So what we do is we learn the language of the markets. That's what I teach. And the language of the markets is super important. It's just learning how to read a stock chart. I was also the Toronto StockTwits community ambassador here in Toronto. I don't know if you guys are familiar with StockTwits, but it's a pretty popular platform in the US. And I was their community ambassador here in Toronto for about 6 years. I ran their meetup group. And when I took the meetup group over, it had about 300 members. And when it wound up, it had pretty close to 4,000 members. We had meetings every month. And after that 6 years, 556 people offered reviews, giving the meetup group pretty close to a 5-star review. So that was really reinforcing for me in terms of showing people the important things in the market to look out for and turn that doubt into conviction. So running that group, I think at one point it might have been the largest investor group on Meetup in all of Canada. I'm not sure about that, but somebody mentioned that to me once. It garnered me some invitations to speak at the Money Show. And so I have been invited to speak at the Money Show here in Canada 5 times. In 2024, I spoke about how to game the 11 sectors of the S&P 500 to your advantage. So that was April of 2024. And what I did in that, I had 30 minutes to say, folks, everybody should be paying attention to utilities. So this is the advantage of learning how to read a stock chart and the language of the markets, because we're looking at a 10-year monthly time frame of XLU, which is the ETF for the utilities sector. And here's where I said, utilities, utilities, utilities. How to game the 11 sectors? Guys, focus on utilities. They're about to light up. And look what happened after that. Beautiful, beautiful trend in utilities. And these guys, a lot of them are really nice dividend pairs if you can tuck in to those individual names. So this is all about process and learning how to read a stock chart. Then last year, 2025, I was invited to speak at the Money Show again. And this time I talked about the opportunities in copper. A quantum shift in demand is coming. That was May 28th, 2025. And we're looking again at the 10-year chart of COPX. This is the Copper Miners ETF. And there's our beautiful blue line. And this is where I gave my talk right here in May of 2025, where I said, guys, copper is about to light up and the opportunities are incredible. And this is where copper is now. So I hope I'm convincing you about the power of process and having a process-driven approach to finding the very best opportunities in the market. So one of the names that I highlighted during that copper presentation was Hudson Bay Minerals. It's a dual-listed Canadian company, dual-listed meaning that it trades on both the US and the Canadian side. But you can clearly see, if you understand how to read a stock chart, this pattern here bouncing off that blue 50 and the beautiful, beautiful uptrend it entered into after that. So that's what I mean about my group being not so much traders in and out, in and out. What we're doing is we're looking for opportunities like this, and we're getting into them and legging in one leg at a time until we have a full position. The second presentation that I made in 2025 was when Grit Capital invited me to speak on stage here in Toronto. It was their money summit, and look at the date, April 3rd, 2025. And if you've been investing or trading for any length of time, you know that last April was diabolical. So in terms of your trading psychology and being able to make decisions in the heat of the moment, this was a real test for me. So I'm on this panel, there's me, and it was a very distinguished group of people. And I was on a panel, what are your 10X ideas for the next 10 years? And at that time, the trade war was intense between Canada and the US, and the S&P 500 was falling like a rock. And I had to get up on stage and say, okay, what's your 10X idea? But because I have this process and this way of reading stock charts, I was confident in saying, guys, you want to pay attention to uranium. If you get a bullish candle in the month of April, I know it's bad now, but if this market recovers and you get a bullish candle in the month of April or May, sit up and pay attention because uranium is about to light up. So this is the day I made the presentation. And I remember the feeling in the room. People were leaving to check their accounts because it had been 1, 2, 3, 4, 5, 6, 7 weeks of the market falling. And of course, we all recognize this. It recovered. It had a bullish candle. We're looking at the weekly time frame here. And this is where we are right here, right now. So we had that swoosh, but this is where I had to check my system and get up there and, you know, make my prediction for 10X ideas for the next 10 years. And will you look what happened? So this is the candle for April. And this is when I said uranium is in a super cycle. When you can read a stock chart, this is a long-term trend of, this is URA. We're looking at the ETF for uranium. And what I hunt for on a daily basis are chart patterns where I see price move up and over the blue line, the 50-period moving average, this blue line, and show me attributes that say it's starting a bullish phase. So this signal here back in 2020 was just the beginning. Here it retested the blue line. And when it retested and it had that beautiful hammer candle that month, it told me that uranium was about to light up again. And this is where we are right here, right now. So it's the power of learning how to read a stock chart and looking at the big picture. I wrote an article for Substack last year in May of 2025 about silver. Is silver about to run higher? I used the same approach. Here's my article for Substack where I said, yeah, silver is about to break out. And I would be looking at this little name called SVM. Again, it's dual listed. That was then, this is now. So these are big monthly timeframes. So that's what I like to do. I'm absolutely obsessive about stock charts and interpreting them and reading them. And I'm looking for these guys all the time. So the reason I'm showing you all that is because I want you to understand the power of your process and believing in your process. And you don't have to bet the farm and take a position that's too large. But if you step in, if you believe your process enough, and you wade in and you build your position over time, it can be a very powerful thing. And so that's what prompted me to launch the Empowered Investor Pathway, where I take students one by one. Even if you're a complete beginner, I will take you, and it's a 10-module online program where I teach you how to read a stock chart. It's simple as that, and transform you into a much more confident investor. It's all about learning the language of the markets because they're always talking to you. And what we do is we use the 4 pillars, and the 4 pillars are candlesticks, moving averages, multiple time frames, and support and resistance to identify those beautiful, beautiful setups. And when you understand these 4 pillars, your investing confidence will really go, it's really a powerful thing. So I want to share that process with you here. So here are the 5 points that I wanted to share with you. 5-step structured process. Okay, here we go. Number 1, here are the 5 steps right here. Market context. We just talked about this in the panel that I was on, talking about understanding the market context overall. And for us, that is the S&P 500. We study the S&P 500 9 ways to Sunday so that we really clearly understand the posture that the S&P 500 is in. The reason we do that is because I deem, in the process that I use, the S&P 500 is the big engine at the front of the train, right? When the S&P 500 is moving higher, about 80% of stocks underneath it are moving higher. It's the big engine that pulls everything along. And so I always want to make sure that if I'm deploying capital, I'm deploying it in a rising market environment. So I really want to know that market context. Same thing is true when the S&P 500 is falling, right? It pulls down 80% of stocks with it, as we saw last April. So it's all about this process and really, really deeply understanding the current posture of the S&P 500, and then the 11 sectors within the S&P 500 and how they are moving and passing the baton to one another and how they are setting up. So when I go back to that presentation that I made to the Money Show on utilities, I could see that utilities were giving me these very bullish hammers on the big time frame, the big monthly time frame. And so it wasn't that difficult to determine that that was a sector that was about to light up. And so now you just plan your trades based on what you see and start doing your homework on the best names in that sector. I mean, if you can always buy the ETF itself, but if you don't want to buy the ETF and you want to look for individual names that perhaps have higher dividends than the ETF would have, then that's your time to start getting your shopping list ready and watch those names as they lift off that area of support. The other part of the process is filter for quality stocks, super high quality. So in my Empowered Investor Pathway program, I give you 6 curated lists. You get 6 highly, highly curated lists where I have already done that homework for you. So you don't have to look around at the 10,000 names out there in the market. You get to focus your attention on these individual lists, and they're super high quality. And my thinking is that in a rising market environment, a super high quality stock at support is probably not going to stay at support. So all I have to do is watch for the signs that it's going to lift. And that brings us down to the next process, the next step, which is structure and levels. And then risk and execution. So this is all about position sizing and making sure that you leg in and you have rules around where you're buying. So number 1, here's what I had to do, and it took me a long time to do this. I call it slay the dragon. What does slay the dragon mean? It means get rid of your opinion of the market. So do you want to be aware of the news? Yes, you do. Yes, you do. But you have to be able to corral the media and the news to the back of your mind to implement your plan to the best of your ability. And I will tell you that after the financial crisis and that dot-com bubble, I had a predisposition. I would come to the market and it was sky is falling. I looked at the market, and even though it started to turn in 2011 and we started that beautiful uptrend, I still had this dragon on my shoulder that said, the sky's falling, there's another financial crisis around the corner, and I missed trade after trade after trade. And so now I'm super strict each and every day that I come to the market. I come with a fresh perspective. I've got a very open mind as to outcomes. I never have a predisposed opinion. I don't care what article it is. I don't care who said it. It's the chart, the chart, the chart. If the chart is bullish and it's rising, that is what I go with. So I call it slay the dragon, because this has a big, deep psychological effect on you when it happens. So we've all been used to this, but at some point, something like this is likely to happen again in the future. And you don't want it to hinder you when this starts to happen, because look at this beautiful freight train of just up, 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 up. So the market environment that we are in is loud with all kinds of noise, right? So we're in a world right now where news is instantaneous and we're all connected to everything all the time. And so this is what it can feel like when you look at your news in the morning. The headlines make you very emotional. Like I'm just taking some clips here, but it's crazy when I look at CNBC in the morning, some of the headlines that I see. The bad news seems to be constant. Government shutdown, all kinds of macro events. The information is endless and it can be really harsh, and it's getting harsher. And the financial media does not exist to make you a calm, rational investor, right? So this is what I mean about you've got to be aware of the news, but then you've got to corral it in. So for me, what I do is I read the news in the morning, and then I turn it off once the market opens, and I'm just watching the chart. If I see something really unusual happening on the chart, yes, then I will go check to see what's causing it. But for the most part, I'm not letting myself get bombarded all throughout the day, because the media exists to grab your attention, and nothing grabs your attention better than fear and extreme headlines. The media amplifies fear. And so you need to understand that as an investor or trader, is that you're getting pumped up every day on that stuff. How often do we read in headlines that the words plunge and collapse and crash in them? I think it's just about every week. The media is not evil. They're just motivated to pump up what sells, right? So it's all about how they get your attention and what sells. And you just need to be aware of that. But here's what I want to say. You need to understand that all of that combines to make you emotionally charged, and that environment quietly conditions your behavior. So whether you know it or not, you might come to the market with a hidden bias about sky is falling or crash around the corner, and that's going to have an impact on your decision making. So it's all about understanding that. And sometimes, as I say, it can be subconscious, and it will sabotage your success if you let it. Okay. So the other market environment they were currently in, are you ready to take a deep breath? Is this one. Oh my gosh, isn't this a beautiful chart? Look, this is a 20-year chart of the S&P 500. Does this look calm and collected and beautifully organized? Look at this. So it's all about the blue line. This is 2011. The S&P 500 caught this blue line, and it's just been this beautiful, beautiful uptrend since then. Yes, we had some interruptions. This was the COVID crash, but look how the blue line caught price. So COVID, long wick, we close above the blue line. And as a reminder, the blue line is the 50-period simple moving average. And then we pick up with a bullish candle. If you can read a stock chart, you see that bullish candle off the blue line, and away we go. And then the Fed raised interest rates in the US, and we had a year of coming in. This is the S&P 500. But where do we catch support? At the blue line. And so if you can read a candlestick chart and see that bullish candle coming in, hello, you're licking your chops, you're getting your shopping list ready, and away you go. And then this was last April. So April was different. And there's a part of me that wonders if the new era that we're living in and the new trading environment we're in might be a little more AI driven, where stuff happens a lot quicker. I don't know. We'll have to get more time under our belt, but that was pretty diabolical, that April. And this is where we are right here, right now. So beautiful, beautiful uptrend. So these are the kind of charts I'm looking for. And again, it's that 50-period simple moving average on the bigger time frame. So understanding the market context, understanding the bigger time frame, and this brick wall, I call it the brick wall of support, the blue line. When a quality name comes down to the blue line, that's where I'm fishing. Okay, and I'm going to show you in a minute. So some other charts. These are all 20-year monthly charts. This is Apple Computer, again, financial crisis, and then it finds its mojo. So this is 2010, 11, 12, and this is where we are right here, right now. But what I want to draw your attention to is, look, Apple has this beautiful rise, and then it corrects. And where does it find its footing? At the blue line. So all we're doing is we're getting in underneath price here, and we're building positions for the next leg higher. And then it corrects. Where does it find its support? Blue line, blue line, blue line, blue line, blue line. So there's more to it, but in my course, it doesn't have to actually touch the blue line as long as it's in a structured pattern that we can identify. We're pegging those stocks when they get close to the blue line. So I hope you see how a process like this can keep you a lot more calm and a lot more decisive in your decision making, because look, this is a lot of history where you can, the blue line is the brick wall. It really helps create an area of support in a rising market environment. So as long as your religion is to stay above the blue line and you're building your position within this range, you should be okay. So that's Apple. This is McDonald's. These are the kind of charts we're looking for. Look at McDonald's, same 20-year monthly time frame. Look at the candles here. Look at the blue line. When it corrects, where does it find support? Blue line. There's COVID, corrects, support, blue line. And here's where we are right here, right now. McDonald's looks like a really, really super interesting chart to me right now. I think it's breaking out to new highs. So process, Microsoft, same thing. Look at Microsoft, 20-year monthly chart. Microsoft was doing nothing for probably about a decade. I think that was the Steve Ballmer decade. And then Satya Nadella took over as CEO, changed things up. They got into all kinds of different things, cloud and all kinds of different endeavors. And look what happened. The blue line started to tilt up, and Microsoft is one of those few charts in this period of time, like this is 2011 to 2021. Look, it didn't even touch the blue line. Look at, if you could get in on that trend, it did not get close to the blue line. And then again, as we saw with the S&P 500 at the end of 2021, when Jerome Powell raised interest rates, it caused that correction in tech, right? But look where Microsoft found its footing, right at that blue line. So it's all about getting in and having a process and rules around understanding that blue line, the beautiful, beautiful support that it lends, and getting in underneath price. I call it following the smart money. We're just following their footprints. When we see them start to come in and buy, the smart guys, then we're just right behind them. And then there's Microsoft again last year, a gift when Microsoft gets close to the blue line, and it's coming up again. So this is where we are right here, right now. Will it bounce off the blue line? We're going to have to wait and see. So to reiterate, slay the dragon, slay the media dragon, slay the things that give you an opinion. You have to come to the market with fresh eyes so that when something's bouncing off a key level of support, you see it and you can act on it and you can profit from it. The next thing is get laser focused on the S&P 500. The S&P 500 is our main trend indicator. If the S&P 500 is going higher, we are fine deploying capital and getting into quality names. So every single week we do a market video where we spend a lot of time looking at the S&P 500 on multiple time frames to see how it's looking, the posture it's in. Is it looking a little wobbly? Is it still looking strong? Get laser focused on what the S&P 500 is doing and only buy in a rising market environment. So I would never deploy capital when the market is falling, thinking that the name that I'm in is a high quality name and that it will turn around or weather the storm. Why would I do that? Why would I deploy capital when the market is going down? Wait till the dust settles, wait till the price gets to that beautiful, beautiful 50 on the bigger time frame, and then start fishing. Much safer place to be. So always deploy capital in a rising market environment and really have the tools and the ability to identify what is a rising market environment and check the health of that market environment as like every week at least. And that for me is the S&P 500. And then step back and see the big picture. When I showed you those big long-term charts of the S&P 500, Apple, Microsoft, McDonald's, doesn't it give you, at least for me, when I look at those charts, I go, oh, thank you. That's such a beautiful picture. It looks like such a calm, structured, methodical, step-by-step, year after year, higher, 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 right? So it builds a calm sense in me. And I know that if I'm fishing around that blue line on a quality stock and I deploy structure around it, that I'm probably in the safe zone because I've got a decade of chart after chart after chart after chart telling me that that's a safe zone. And then if I deploy strategies where I'm legging in and I'm not buying all at once, then it makes me feel extra secure. So it's all about stepping back, taking a breath, not letting the media get to you, and look at what's actually happening on the chart. Look at the big picture, because now I'm zooming it in. This is the 10-year monthly of the S&P 500. And this is where we are right here, right now. I took this was yesterday. So this is the monthly time frame, and these are monthly candles. But you can see after that whoosh down in April, look at where it caught its mojo again, right? Close to the blue line. And then you saw this candle in April, and it was followed by a bullish candle in May. And look what's happened since then. Beautiful. So it's all about being able to identify those areas. Number 2, understand sector rotation. So this really, again, I'm going to refer to the talk that I gave on utilities, because I'm looking at the 11 sectors of the S&P 500. There are 11 of them. Information technology, communication services, healthcare, materials, utilities, and each one of them has a big kahuna. So in information technology, it's Microsoft. In consumer discretionary, it'd be Amazon and Tesla. So when a sector is correcting and coming back into that blue line, it's really helpful to be able to look at the ETF for the sector, which, like in the case of utilities, that would be, or let's go with information technology because it's current to the now. XLK's had a little bit of a tough last couple of months, right? Technology, we can all probably agree on that. It's been in the news, it's been read, everyone's kind of speculating about technology having a hard time in sector rotation. But if Microsoft, which is the big name in the space, holds that 50 on the monthly time frame this month or next month, that's telling me that technology is okay and the uptrend is probably going to start to go up again. And if it does, do I want to be riding the Microsoft train? Yes, I do. So it's all about being able to understand the chart, understand the candlestick on the bigger time frame, and what that candlestick is telling you. So these are the 11 sectors. They don't have the ticker symbols here, but this gives you the weight. And so information technology is super interesting to know. In terms of its weight to the S&P 500, it's 21%. And so that's why everyone's talking these days about RSP, which is the equal weight S&P 500. And it's actually doing better this year than the S&P 500 because it's not hindered as much by information technology. I'm getting into the weeds a little bit on that, but if here's what I want to say. If Microsoft and information technology starts to turn around in the next couple of months, that's a big, big, big part of the S&P 500 starting to pull the train up again, right? So something to think about. So that's why I think sector rotation is super important and always coming to the market with fresh eyes. I'm not predicting that it's going to go higher. I'm just watching to see if that happens, just like it did with uranium and like it did with copper. That's something I really want to pay attention to and capitalize from. So it's all about understanding those 11 individual sectors and how they pass the baton to one another, helping each other and the overall S&P 500 move higher. So again, I want to remind you of that talk that I gave for utilities. There's our beautiful blue line. And look at the bullish candle off the blue line. So when price came into that bullish candle in April, when I was giving that talk, it was pretty easy to kind of say, I'd be looking at utilities. And that was in April of 2024. And I happened to see this later on. I'm in Toronto, Canada, and our big newspaper here in Canada is the Globe and Mail. And I saw this article and I went, oh my gosh, this is dated October 24. Remember, we gave this talk in April of 24. Now the Globe and Mail in October of 24 is saying, in a surprising turn of events, the utilities sector has emerged as one of the best performing sectors of 2024. Blah, blah, blah. So here's the advantage of learning how to read a stock chart, understanding that sector rotation. You are going to be in before everybody else. And then number 3 in the process thinking is stick to quality, 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 quality. Narrow your focus, the power of focus. So many people dilute their focus by looking at 10,000 different stocks out there. The latest, the greatest, the latest article, the latest, trending stock. Just narrow your focus to quality names. Because when you narrow your focus, you narrow your attention. And your attention is really going to help you see the trend. And when a really high quality stock comes down to that blue line, over time and with practice, you're going to learn to trust that trend because it is a powerful, powerful force. So we're buying when the odds are stacked in our favor. We use trend and support to create that margin of safety, right? I'm buying with my stop right at my feet. Think about that. The blue line is right at my feet to the best of my ability. And so I'm creating that margin of safety right off the bat. And I am legging in a very careful process. And I am trusting the trend because the trend I can see for the past decade, that trend has been has been amazing. It's the brick wall. And again, I'm going to come back to Apple to remind you, because I think, at least with my students in my program, sometimes I have to remind them because they get a little nervous, you know, when we're looking at Apple here and they're getting nervous, and I'm going, guys, like, what? Look. It's also Warren Buffett's largest holding. I mean, quality. So as long as you have a structured approach and you're looking at super high quality names, this is what I was saying earlier in our session. A high quality name like this in an uptrending market at support, if the S&P 500 is moving higher and Apple is at support, do you think Apple's just going to stay there and be ignored? Or do you think it's going to be bought and picked up and away you go? So it's away you go. It's going to be bought, and you just have to be fishing and being aware and being in this area ready with your plan. McDonald's 20-year monthly chart, same thing. Microsoft. I just wanted to remind you again. So this is what I teach in the Empowered Investor Pathway. I am absolutely like the most passionate person you're ever going to meet about stock charts. It's a 10-module program. Every single week, I create a video that is chart of the week. And it's a chart that I have taken from one of our curated lists that fits the profile that we're looking for, which is really, really close to the blue line on that big monthly time frame. And it's a really high quality stock in a really great sector. So think about the process of thinking here. We're going to check the box, and I'm going to give you the checklist in a second, but we're checking the box that the market, the S&P 500 is in an overall bullish posture, which it is. We're checking the sector to make sure that the sector is in a rising posture at support. And then we're going to pick the best name in the sector to be involved in. So this is our goal, chart of the week. And then we have weekly market overviews. This is a video I put out every Saturday where we check the health of the S&P 500. There's where the modules are. We have a community call every Sunday where we all get together and we talk about the chart of the week and how we can game the chart or be involved in the chart. And this is the leaderboard for my individual students. So here's an example of a quality stock and one of the curated lists that come with the Empowered Investor Pathway program. It's called the Buffett filter. We can all probably agree that Warren Buffett is one of the best investors of our time. So if he's choosing a stock, I'm going to say that's probably a quality stock. But it's not just one of his stocks. It's one of his high conviction stocks that we're looking at. So we always look at the Buffett list and we go to the top of the list because what do we want to do? We want to engineer calm, right? This is the whole point. Is if we're fishing for really high quality names, like on those charts I showed you, Apple, Microsoft, McDonald's, we're engineering a very calm market environment for ourselves. We're making calm, clear decisions with structured levels and risk and execution rules that are really clearly defined. We leg in. So we're not betting the farm. Nobody bets the farm on anything. We position size really carefully. So I found this little cartoon. So we're starting off with a exploring position. They're equal weight. We go in with 3 legs. Each of them is equal weight. So we leg in. And then we protect our positions and support. So once we're in that name, we are monitoring it every single week. So here's the S&P 500 currently. I printed this morning. So this is the 5-year monthly time frame for the S&P 500. We had this beautiful swoosh off the April low here, and these are the monthly candles. And then we went sideways, and here we are for the month of February. We've got 10 trading days left in the month of February because Monday's a market holiday. So I've got 10 trading days in the month for this reddish, slightly reddish candle on the monthly time frame to show me its orientation. Are you going to be red, Mr. Candle, or are you going to be bullish? And so I'm watching the sectors, especially right now, I'd be watching technology to see if Microsoft does start to lift. Then if the technology sector, which is 21% of the S&P 500, starts to find support here, then it would make sense to me that perhaps the S&P 500 might go higher. So I'm using the word might because I never want to have an opinion, but I'm looking at the chart and I'm going, that's interesting. If Microsoft can kick in, then the chart is telling me, I'm not telling the chart's telling me that perhaps there's more to go. So that's the 5-step structured process that I really wanted to share with you. Again, it's market context, sector alignment, filter for quality, understand the structure, the blue line and the levels, and then define your risk and when you execute. And so here's the checklist that I wanted to put in the chat. If you give me a sec after the presentation, I will put this for you in the chat. So this is basically, I have this on my desk and I just check these boxes. Check the box before I take action. Slay the dragon. Do I have a bias? No, I don't. Is my mind open and unbiased as to outcomes? Am I just watching the chart? Is the chart telling me? So is the S&P 500 trending higher on the monthly and the weekly? So you get the idea. I'm checking those boxes. Step number 2, choose from a bullish monthly sector. Step number 3. So here's a quick example I want to give you. I launched the Empowered Investor Pathway the end of last September. My chart of the week for October 6th, though this was right after we launched, was Coca-Cola. So here's the process in motion, okay? Coca-Cola is not only a Buffett stock, but it's a dividend king as well. And for those of you that are not familiar with dividend kings, a dividend king is a specially designated stock. There's a committee that decides who gets to be a dividend king. It is a super, super select group of about, I think there are maybe 60 names on the list, and they have been reliably paying their dividend for over 50, that's 50 consecutive years, 50 consecutive years of paying and raising their dividend. So that's why they're called dividend kings. It's very, very select. So not only is Coke a Buffett stock, but it's a dividend king too. So am I circling quality? Yes. So now I'm going to apply those 4 pillars, the candlesticks, moving averages, multiple time frames, and support and resistance to Coke. And step number 1 is the S&P 500 going higher. So we were circling Coke right about here. This is where we are right here, right now. But Coke, the market was moving higher. We had bullish candlesticks and we had an uptrend. So check the box. I'm buying in a rising market environment. Right? Here's the S&P 500. This is the long-term time frame. So I'm moving to the long-term to show you this is where we're buying Coke. Yes, rising market environment. Number 2, the sector. Coke is in XLP, consumer staples. Look at the proximity to the blue line of that sector, XLP, right about here where we were interested in Coke. It was coming into the blue line and we could clearly define this area of support. This is where it is now. So you can guess what happened to Coke. I just clipped this morning. But there's that beautiful, beautiful blue line. So that's the 5-year monthly. I'm blowing it up and magnifying it. But here's XLP on the 20-year monthly time frame. Hello. Look at this beautiful, beautiful uptrend. And look at the consolidation that was happening here when we were interested in Coke. So this is what we're doing. We're checking the market is going higher. We're checking the sector that it's in. And yes, it filled our criteria. And then we're going to go to the best name in the sector. And for us, that was Coke. So Coke is about 10% of Warren Buffett's portfolio. So not only is it one of his names, it's one of his most highest conviction names in the number 4 spot. And now I'm blowing the chart up to the 5-year monthly, and I can identify, And this is something I teach people and they learn in my course. This purple dotted line is support on the monthly time frame. So we're close to the blue line. We're at an area of support. So we're starting to leg into Coke in this area. So stop right at our feet. We leg in. This is the monthly. But think of how calm that is, right? And this is Coke now. So we're building our position in here. And then we're just managing it week after week after week after week to make sure it's doing what we want it to do. And this is Coke. This was yesterday, Coke. So quality, not just any Buffett stock, but from his top 5. So we like to really circle the top 5, the top 10. And there's Coca-Cola, his Berkshire Hathaway portfolio, 10%, and it pays a dividend. So I hope you understand the logic, right? It's in a rising market environment. I'm going to find the best quality names that I can possibly find at really, really strong areas of support. And the blue line is the brick wall of support. And I am going to leg in with a methodology that tells me and rewards me as I'm right. And for us, it's we look for the blue line at 5-year monthly support. So to summarize, buy when the odds are stacked in your favor, use trend and support to create a margin of safety, trust the trend, slay the dragon, because if you had a head full of negative thoughts about the market, it would be very difficult for you to take action on that Coke trade. I remember that was me back after the financial crisis. I would see chart after chart after chart and I would pass because I hadn't slayed the dragon. So I had to slay that dragon. And this is how we legged into Coke, 3 equal leg positions. This is as of yesterday, we're up about almost 16% on Coke. That's not including dividends. And so this is a picture of our weekly stop. So every single week, I just move this red line up for the week. And so this is the current look of our stop for Coke. And we just make sure that we're moving that stop off or the stop up week after week after week and always monitoring that blue line. So in summary, when these 5 things come together, it creates a powerful force and you become a calm and confident investor. So if you're interested in the coaching program, it's a very small select group. We interview people to be part of it. If you'd like to, I would love to have a chat with you where you learn this skill and the discipline and practice alongside me. And hopefully, you get a shift and slay that dragon following a process you trust, because process offloads emotion with clear rules, fewer decisions, and defined outcomes. It builds confidence, and confidence is not a feeling, it's a result. Confidence here in your ability to see clearly, limit emotion, and execute with precision. That's what we're all about at the Empowered Investor Pathway. So it's a 10-module training program. It takes about a year to make it through. They're all, it's online. They're all videotaped, so you can go through at your own pace. Then live weekly coaching calls with me, that weekly video, the private online investor community, and the option to graduate to the master's program. If you're interested, there's the QR code. I would love to have a chat with you and see you there. And that is my presentation for today.
Thank you so much, Sue. Thank you so much. And we have a question in the chat. Sue, please say, for a beginner trader, what is the most important structural element to implement in their daily routine first? What do you do?
So just you need to get a process going where you are looking at the markets every day and you are building your confidence in being able to interpret the market. So I would start there. I would start with looking at the S&P 500, those 11 sectors, and understanding how they move together and with each other and help each other out. And once you start to see the pattern emerging, there becomes this awareness in your mind about your ability to interpret the price action that will really help you out. So if I were starting out again, that's what I would do.
Okay, thank you so much. And we have another question. What is the difference between process and routine in a trading context? How does each impact decision quality?
Process is the big kahuna. Process is the big thing that you build over time. And I went through it with you. And then routine, now that I'm in a name like Coke, right? My routine every week is to just check that stop. So the routine is going to be a lot simpler and easier. It's a derivative of your overall process, but the process and getting your process, the one that's right for you, is where you spend a lot of time at first. You got to build that out so that you understand it backwards, forwards, inside out. So process. And then the routine is, now I just come to the market every day and I check Coke. How's it look? Is it still going higher? We're good. So I'm just going through that weekly routine of checking stops on all my positions.
Mm-hmm. And we have another question. Other two questions. If we have a solid process, but market is behaving irrationally, how do we stay committed to the structure without feeling like the process is broken?
That comes down to understanding the S&P 500 on the multiple time frames. So this week, I have to check. So I sent a movie out to my community this morning before the market opened, and I said, everything looks okay. The S&P 500 is over our purple dotted line on the weekly time frame. So if there's wobble today, don't get too emotional about it because it hasn't broken support yet. So I have to check at the end of today and tomorrow, but we look at the S&P 500 on a weekly basis. And if it's wonking around on the weekly, because I'm a position trader, right? I don't get too involved in the daily. The daily doesn't really, I mean, I'm aware of it and I'm managing it, but it's not shaking me out of my position because I'm more of long-term, right? So to answer your question, I really want to see what that weekly candle looks like on the S&P 500. And if it's red, well, then maybe it's going to turn the candle for the month of February red. So it's all about looking at things in multiple time frames and understanding support and resistance.
Thank you so much. And the last question, what are the 2 or 3 key structural signals you recommend looking for to confirm a sector is entering a leadership phase?
Okay, 3 from the top. Number 1, blue line, right? Blue line on the big time frame. So the 50-period simple moving average on the big time frame. Watch the sectors as they come into that blue line. So that's number 1. Number 2 is going to be, what does the candle look like for the month around the blue line? So as I showed you on that utilities chart, I could see the bullish candle, really big bullish candle. It was buying hand over fist. So that's a really clear indication that the smart money is starting to buy into that sector. And so I just interpret the blue line and the candlestick, and then I pull down another time frame to the weekly, and then I discern support and resistance on the weekly. So blue line, candle, and then multiple time frames, support on the weekly.
Okay, thank you so much. Thank you so much, the
You're
master of Blue Line. Thank you for your speech, and thank you for supporting us.
You're welcome. And I wanted to share with them some things in the chat, but if you want to, I'll try to share them, move them into the chat. I should have sent them to you earlier, Alex, but if you want to email me, it's sue.o'reilly@gmail.com. I will send you the checklist and stuff.
Okay, thank you so much for that. And we will share the checklist also in our Telegram community.
Perfect.
Thank you so much. Thank you for your speech, and thank you for your support of this conference.
You're welcome.
Well, guys, so we will meet in a minute with the Animal Sync speech. Thank you so much. See you. Well, guys, we are back. So it was really fast. Animal Sync is with us. Animal is the coach for traders and investors, author of Prepping for Success and Success Journal. So the topic of Animal will be mastering the trader within. The psychology always wins. Animal, thank you for joining, and the stage is yours.
Thank you. All right. There you go. I have some slides uploaded here. Let me get those up. There we go. All right, perfect. So today I want to talk to you about something that almost every single trader experiences, but very few actually master, right? And the what I want to talk about is psychology, right? Psychology always wins. Not your strategy, not your indicators, not your back tests, psychology. So let's see, I'm going to go to the next slide over here. There we go. So, a trader once messaged me after blowing up his account, which is pretty common, right? Most traders will never tell you when they're about to blow up their account. They always tell you after the fact. And he said to me, I knew the technical setup. I knew the stop loss. Yeah, reading charts, all of that. I understand everything. I got all of that. And I told myself, like, I'm not going to size up in that trade. But once I was in the trade, I couldn't handle the drawdown. Like, I moved my stop loss, I doubled down on the trade, and basically I froze. How many of you guys can relate to that, right? Like, you're in the trade and it feels like somebody else just took over and was making decisions. And then when you get out of the trade, that's when you realize, you're like, what was I thinking? Like, what was I even doing here, right? Because we're not in our objective state of mind, which I was talking about in the panel discussion earlier. So, and then he said something that really stuck with me. He said, it felt like someone else was trading my account, right? And I can certainly relate to that from my early on in my trading career. And if you have felt something like that before, and if you've traded long enough, you've definitely felt that moment at some point in your trading career. And if you're new and if you haven't felt that yet, well, guess what? It is coming, right? Yeah, at some point you're going to feel that. When you're watching yourself make the wrong decision, but you still do it. Right. And most traders fail because they don't know enough, right? It's not the main reason. A lot of times people think that traders are failing because they don't know enough, but that's not always the case. They know the right thing to do. They know how to read the chart. Like, if you give them a great technical chart, right, show them a nice smooth uptrend, they know that. They can see it. They know when to get in. But yet somehow they end up messing up that trade. And so it's not because they don't know enough. They know the setups. They understand risk reward. They've even back tested their strategies. But here's what happens. When money is real, this right here, your psychology takes over. Fear, impatience, ego, right? All those things start to come into play. The need to be right. The need to feel relief from their trade. And here's the uncomfortable truth that I want you to sit with. The market is never the opponent. You are. Right? The market is never the opponent. The market is what the market is. It's going to do what it's always going to do. It's going to go up, down, or sideways. Those are the only three opportunities in the market. But what happens is the market is never the real opponent. You are. And I want you to kind of just sit with that for a second. You are the biggest opponent when it comes to your trading success. So I want to give you some context before we dive into the presentation. I started trading when I was 18 years old. And at this point, I've traded for several different prop firms. I've coached thousands of traders globally, some of whom are running their own hedge funds. And I'm a psychology coach for institutions. So if you watch the TV show Billions, you know that woman in there, Wendy Rhodes, she's like the psychologist for hedge fund managers and institutional firms. And that's what a lot of the work that I do now. So I just wanted you to know you're in good hands, right? So I want to talk about demanding immediate feedback, because something that a lot of traders do across every single level, what I notice is across all levels, whether you're a retail trader, whether you're an institutional trader, the psychology is the same, because we're all human. We're all going to have human emotions. But only thing that's different between a retail trader and an institutional trader is the position size, right? We're just trading a larger account than a lot of the retail traders. But what never changes is the human behavior, right? That's as age old as time, right? It's almost like, you go to a personal trainer and he's like, yeah, do this for workout, do this for your diet, you're going to get in shape. And he's right. If I do that, right, you're going to get in shape. But why do some people then don't do it? It's not the lack of information. It's not the lack of knowledge. It's the lack of integrity, right? Your word. A lot of traders don't do what they said they're going to do. So one of the biggest psychological mistakes, and by the way, the slides are just there for you guys, right? I just kind of riff off based on my thoughts. And one of the biggest psychological mistakes that traders make is they demand immediate feedback from their trading results. They want the immediate feedback from the market because they want reassurance. They want proof. They want confirmation right now that they're doing it right. But results in trading will always lag your effort. And most traders, they end up quitting in that gap. Not because they're losing massively, but because they don't see validation quickly enough. They're not seeing the results. They're not seeing fruits of their labor, right? So faith in the process is not about positive thinking. Trading psychology is not about positive thinking, although that's a great thing to have, but it's not about positive thinking. It's about disciplined trust, trusting in your system, trusting in your trading plan. And notice what came to your mind when I said the word system. Do you have a system? Do you have written rules? Or are you trading based on gut feel and emotion? Because if you trade on gut feel and emotion, you don't have a system. And the results are always going to be random. You're going to get some winning streaks. You're going to get some losing streaks. And at the end of the year, you look at your account and it's like, oh, it's still here, right? If you want an account to go from point A to point B, you got to get out of the thinking of there's a holy grail that exists in this market. There is no holy grail. There's no technical indicator that's going to work every single time. There's no technical strategy that's going to work every single time. They always work sometimes, they not work other times. So the way you create a system is through making sure that on your winning trades, you're making more, and on your losing trades, you're making less. And then the combination of that win-loss ratio and your win rate is going to give you an expectancy. And if you don't know what expectancy is, after this talk, I want you to just go on Google and type in trade expectancy calculator. Plug in your own numbers in there. And if the expectancy is positive, you can expect to make money after a sample size of 50 trades or 100 trades. If the expectancy is negative, there's nothing you can do. In fact, the more you trade, the more you're going to lose. So talking about disciplined trust, when you stop measuring yourself as a trader by your P&L, right? And you start measuring yourself by execution. So not judging yourself based on the result of what you made or lost, but okay, did I follow my process? Did I do the right thing? So process over outcome. So stop measuring yourself by P&L and start measuring yourself by execution. When you do that, something starts to shift in your mind, right? Consistency comes first and confidence comes later. Because once you get consistent, you're automatically going to get confident. Most traders think like, I want to get confident now. Well, if you're not consistent, you're not going to be confident. So let's talk about capital, right? As you can read on the slide here, it says capital is not opportunity. But you know what capital is? Capital is responsibility. Every dollar in your trading account represents time, effort, sacrifice, and future potential. Because I'm sure you had to work really hard to get that initial capital to trade with in the first place. So let's treat it with respect, right? Let's not treat it like we're in a casino. This is the business. So let's start treating it and giving the respect and reverence that it deserves. So when traders gamble, they're not just risking money. They're also breaking trust with themselves. You know that feeling when you know what the stock is going to do, but you still end up doing the wrong thing? That's what I'm talking about. You're breaking trust with yourself. And growth does not come from being aggressive in the markets. Growth comes from capital protection. Okay? And if you cannot respect your trading when you're risking a small amount of money, it's not going to get better when you start risking more, because a lot of traders I hear say, yeah, Anmol, I know it's earnings season. I should not be holding my trade through earnings. But, I think this has the potential to go up. And I'm like, but you wouldn't do that if you were risking $1 million, would you? They're like, no, but I'm trading really small size. It's only 100 shares. It's only 10 shares. It doesn't matter. I can hold it through earnings. But now you're building good habits, right? Now you're actually not building good habits. You're building bad habits, because when you start trading earnings, guess what you're doing? You're basically going to the casino and placing it on red or black. It's a 50-50 odds. It could gap up, 50-50 odds. It could gap down. So you really have an edge? You don't really have an edge. So if you don't respect trading with a small account, large account will actually expose all of your weaknesses and your psychological weaknesses. So that's why I recommend traders don't look at your accounts as you're trading. Yes, you might have a small account now, but it's not going to be always that way if you trade the right way. But if you treat it like, oh, it's just small amount, then when you finally become a bigger trader, you're going to have bad habits you're going to bring with you, because you cannot compound what you cannot protect, right? Compounding only works in your favor if you can protect your capital. If you don't protect your capital, it's not going to compound. And another mistake that I see a lot of people make, and we saw that in the last trading psychology conference, I got a lot of questions after that, is, how do we get rid of emotions? Well, every trader feels the emotions. You cannot get rid of it. You're human, right? I'm human. I feel emotions too, even after 16 years of being in this business. Every trader feels those emotions, right? The emotions of fear, excitement, greed, frustration, doubt, and the big one, because of social media, is FOMO, fear of missing out. There might not be any good trade out there that meets your technical setup or your criteria, but because you see all these other people on social media, right, pretending or making a lot of money, then you get tempted. I want to take a trade too. And then you end up breaking your rules. You break your rules, you break your trust. You break your trust, it erodes your self-confidence. So emotion is not the problem. Your reaction to the emotion is how you react to that emotion. The difference between amateurs and professionals is that professionals just have a disciplined response. Okay, that's what professionals have. We have a disciplined response to our trading. But when discipline is missing, who's going to run the account? Emotions will run the account. But when discipline is present, emotion becomes just background noise, right? I feel the emotion, and I heard another speaker talk about awareness today. So awareness is you feel the emotion, you recognize it, you're like, yeah, I'm feeling a little bit jittery here. I'm feeling a little nervous here. Okay, but you know what? I'm still going to follow my rules. I'm still going to follow what my trading plan says. I'm still going to follow what my system says. So that's what a professional does. He also sees these emotions. He also feels the emotions, but then we don't act on it. We follow the process. Whereas a novice trader is going to feel those emotions. They're going to be like, I need to get out. I need to take my profit right now, even though it's breaking the plan. So we still feel it, but emotions don't control us. Rules are not limitations. They are guardrails, and they're there to protect you. Every time you follow your trading rules, when it feels uncomfortable, especially when it feels uncomfortable, you start building self-trust. And self-trust is the foundation of confidence. So let's go to the next slide over here. So one of the deepest traps that I see in trading is if your identity rises and falls with your P&L. Like you judge yourself based on how you did today. I lost money today. Oh, so I must not be a good trader. Or I made money today. I must be the best trader. Now your identity is rising and falling with your P&L. And if you do that, it's a recipe for long-term disaster, because you will always trade under pressure, because it's about your identity now. And you will need every trade to validate you. And the pressure distorts decision-making in trading. But when your identity is like stable, like you're a grounded trader, wins just become data. That's all that it is. And losses become feedback. We take those losses, we journal about it, we review it. What could we have improved? What could we have done better? Right? And once we have that, wins just become data, and losses also give us feedback on what to improve on what to work on, rather than taking losses personally. And then what happens is you start executing and you stop trying to prove yourself to anybody out there, right? The traders who last are not the ones with the biggest wins. They are the ones whose identity is not threatened by uncertainty. They are comfortable with uncertainty. So let's go to the next slide. Attachment. Attachment creates volatility, whereas detachment creates clarity. So if you attach yourself to an outcome that you want to receive in trading, your emotions are always going to be volatile. So is your P&L going to be volatile. But when you're detached to the outcome and you are a systematic trader, almost like a robot, where you're just executing and following a system, that detachment will end up giving you the clarity and the confidence. The confidence where you don't need anybody. You don't need a community. You don't even need me. You don't need any book. You don't need anything, because you are trusting in your own trading plan. So once you execute your plan correctly, your job as a trader is done. After that, outcome is just data, right? Go to a casino, go win $1 million in a casino. The casino's not going to mind. In fact, it's going to say, here's some free drinks. Here's a free stay. Just keep playing. Guess what? Because they know their data. They know after 100 spins, this is what they're going to win. Same thing with trading. When you trade systematically, it's not about gut feel. Ooh, I think this stock is going to do that. We're following a systematic rule, which we know after a sample size of 50 trades, 100 trades, we're going to be profitable. That's when you know you have a profitable system. But when you trade attached, you interfere with your system. You start tweaking it, trying to optimize it, trying to make it better. And in so doing, you completely mess up the odds of the system. But when you trade detached, you're going to follow probabilities and let them work. So I want to talk about short-term thinking. Short-term thinking will burn careers. And we talked about this even in the panel discussion earlier today, is if your goal is like short-term, I got to pay my bills from trading, it's going to destroy your career. Trading for excitement will lead to burnout. Long-term thinking is what builds sort of like your self-identity and your trust, because you're following a system that's proven to work. And professionals, trade in a way that allows them to come back tomorrow. That's the biggest thing I preach, is like trade so that you can come back tomorrow, right? So if today is not a great trading day, sit on your hands. Don't do anything. There's no need to push any buttons. Come back tomorrow. Tomorrow will be a better day. And come back tomorrow with more clarity. That is the difference between a streak, a trader who hits a hot streak, right? All those traders who are crushing it on crypto, crushing it on GME, AMC, that's just a streak. But when you trade with a system, now you build a career. And there's a difference between that. So I'm going to leave you with this. Trading is not just about making money. It's about becoming the kind of person who can handle uncertainty. Because markets don't just reveal opportunity, they're going to reveal your character. Who are you under pressure? Who are you when you go through a losing streak? Who are you? They will reveal your character. Trading will be the biggest emotional amplifier you're ever going to see. So when you master the trader within, all the concepts that I talk about in my book, Mastering the Trader Within, the outer results eventually will all just align themselves. Not because the market's changed, because you did. That's when results change, when you change. So if this resonates with you, I would invite you to come watch what disciplined trading looks like. I live stream every single day, Monday to Friday, trading live and talking through what trades I'm taking in real time. So if this resonates with you and you want to see what disciplined trading looks like, I want to invite you to come watch it live. There's a 7-day trial. You can just scan the QR code and I'll be live tomorrow morning. And I was live this morning as well. And there's no hype. There's no, signals. It's just live trading, risk management, and real discipline in real time. And sometimes the fastest way to understand trading psychology is to watch somebody do it live. Because what I don't want is for you to get into the hindsight type of trading. What do I mean by hindsight trading? Hindsight trading is when, you see these amazing slides. And we've all taken trading courses, I'm sure. We've all taken some trading courses. You see the perfect slideshow. Oh, just buy right over here. But if that's not the problem, right? We can all see the chart. Okay, but the psychology, how do I get myself to execute? How do I get myself to follow through on my trading plan? That is the biggest thing. And that's the main thing I talk about in my book, Mastering the Trader Within, which recently, I created this book this year. It was launched this year and I hit the Amazon bestseller. And it's all about that. Because when I get invited to speak to institutions or when I get invited to speak to prop firms, they're not inviting me to coach their traders on how to trade. They already know how to trade. They know the charts. They know their technicals. Some trade on level 2. They have their own systems. They don't need me to teach them how to trade. What I'm invited to is to create systems in place with rules and specific guidelines so that the trader can master the trader within and he can get comfortable with the psychology. So that's what I wanted to talk to you guys about today. And I wanted to also say, you don't need more knowledge. You don't need more information, right? If you go to my YouTube channel, Live Traders, there's hundreds of hours of trading lectures there. You don't even need to buy my course or anybody's course, in my opinion, right? It's all there. The information is all there. But I also know that you're not going to apply the information. The knowledge is all there. All of our courses uploaded for free. But yet, where do people struggle? It's right in here. So master the mindset, master the trader within, and watch how your results will transform. So I'm going to take some questions here. I have a question in the chat. what do you think, how much of a trader's success is due to their strategy versus the ability to master their psychology? So initially, yes, you do need a good strategy, right? Because a great psychology will not compensate for a horrible strategy. And likewise, you might have the best strategy in the world, but with the wrong psychology, it's still not going to work. You need both, right? It's like a pieces of puzzle. You need all the puzzle pieces to fit. But I would say strategy is only 20%, right? Learning how to trade is literally 20%. 80% is the ability for you to execute on that system, especially when it's tough. The ability to come back every single day and keep executing, because it's all about a sample size. Once you understand that trading is simply a game of statistical probability, right? And everybody who makes predictions online, they don't know any better than you do, right? The ability is to follow a plan. The novice traders get shaken out. They are jittery. They start doing random things in the moment rather than sticking to their plan. So great question. But I would say 80% of it is psychology, because I've seen traders, like I can give them my exact strategy. Hey, do this. And guess what? Even in my community, 60, 70% people, yes, they're making money consistently. They're making a living out of trading. But still, 30% of people are still not going to get the results. Why is that? It's the same strategy, or we're all literally executing the same strategy. Then why is it 70% make it and 30% don't? Because the rules are the same. Is that the 30% have not mastered the trader within. And that's what I spend majority of my time on. And all of my YouTube videos, apart from the strategy videos, will only be about psychology, because after being in this game for 16 years, I know that that is the difference maker, right? So great question. And if you guys have any other questions, feel free to drop them in the chat. I will be happy to answer those. Alex asks, in your opinion, what is the fastest way to shift your mindset back to neutral after significant winning or losing streak? Great question. And I acronize it by saying, GUAL, which is get up and leave. Because here's what happens. I tested this psychologically, right? We are actually in the process of building our own trading psychology software right now, which automates the systems and automates the trading, right? And it also could, measure your heart rate in those trades. But when we are scrunched up, you're going to notice this. Record yourself in video when you're trading, right? Record yourself and you're going to watch. When you're making a mistake, you're going to find that you're like leaning forward in the screen, trying to make things happen. You're scrunched up. Your body language is all closed off. Whereas a relaxed trader is like leaning back and we're just watching the system. We're watching the system work. So the key here is when you take a bad losing streak, or even when you have a big winning streak, set some processes in your systems to say, okay, let me physically get up, walk around, and then come back on my desk. Sometimes just the process of taking ourselves out of our little bubble of our trading computer is enough to reset your nervous system, right? There's breathing techniques you can do. We all are familiar with box breathing, right? So every morning I will do this before I come into the trading desk. I will regulate my nervous system. I'll take, 4 deep breaths in, hold it for 4 seconds, exhale for 4 seconds. And I start my day with a positive mindset. And then on my iPhone, while I'm trading, I will have an alarm set. Every 20 to 30 minutes, an alarm is going to go off. That's called my emotional check-in. So what I do then is I check in with myself on a scale of 1 to 10. How am I feeling right now? Am I feeling jittery, nervous? If I'm like ranking myself 9 or 10 or 8, continue trading. If I rank myself 6 or 7, I'm like, I feel a little bit tired, or I feel like I'm not making the right decisions. I will physically, and people can in the chat room in my community can attest to that, I will physically get up with an excuse. I'm going to get some coffee. I'm going to get water, and I'm going to take myself out of this bubble, because you can measure it. Trading releases the same hormones of dopamine and serotonin that you get when you gamble in the casino, when you have sex, when you do cocaine or any illicit drugs, right? Trading releases the same hormones, but here's the difference. Traders will get it every single day. Like, because I day trade, I swing trade, I do long-term investing. I'm actively in the markets every day. So then you are getting those hormonal spikes in real time. If you cannot regulate yourself, that's when traders fall into the trap. Poker players are the same way. It's called, trading on tilt. When poker players go on tilt, they lose their emotional control. They're like all in on a bad hand. And that's what traders do. Even though the trade has completely broken the support levels, it's not a good trade, but the brain just almost shuts off because the hormonal spikes kick on. And then you start making decisions where in the moment you're thinking you're making the right decision by adding to a losing position and all those things. But the moment you take that loss, you get out, it feels like somebody punched you in the stomach. You ever felt that before? Let me know in the chat. Feels like somebody punched you in the stomach. You feel like throwing up. And then later at night, you're sitting by yourself. You're like, what was I even thinking? That was not even me, right? So we all feel that. So how can we get ourselves to build awareness of that in real time? So Alex asked, what instruments do you trade and why? So I trade stocks and options. That's it, right? Crypto, I have long-term, but like I don't trade in and out of that. I don't trade foreign exchange. I trade stocks and options, US equities. And when it comes to day trading, I take 1 to 3 trades per day. That's it, right? 1 to 3 trades per day, stock trades or option trades. And then when it comes to swing trading, trades that I'm going to hold on for a few days, few weeks, same thing, stocks and options. I just try to keep it very simple. Okay. Let's see. How to manage long streaks of losses. So number one, first you have to know, is that long streak of losses part of your system? And that, again, that's why I keep going back to saying, what is your system? Because if I have, let's say I have my system says I'm going to win 70% of the time and I'm going to lose 30% of the time. So when I lose 3 out of 10 trades, it doesn't bother me. I don't look at it as like a losing streak because, well, that's what my odds said I'm going to get, 3 losers out of 10. And sometimes those 3 losers will come one after the other. So that's not a losing streak. That's part of the system, right? So you have to know what your system is. Go back. I want you guys, please do this. If you don't get anything out of today, take this one thing. Go back and look at your 100 trades, last 50 trades, or however many you have, and try to pinpoint what you did right, what you did wrong, and do you have a system? But you don't have a system if you're just entering based on, ooh, today this looks really good. You know what? People are talking about this. I'm going to buy this stock. That's not a system. Now that's gut feel and emotion. You don't have an edge. What you need is an edge. A casino has an edge. You want to be the casino in this scenario. So if you're having a losing streak and it keep happening often and often, then it's a strategy problem more so than psychology problem, right? Psychology problem happens when you do something where you shouldn't be doing, meaning you're supposed to hold on to your target, but you sell it too soon. You broke your plan, right? Or you're supposed to be out and take your small stop loss, but you keep holding. Maybe it'll come back up. Well, maybe is hope, and hope is not a strategy. So what are some of the indicators and trading data points that point out poor psychology? Great question. So your win-loss ratio is actually a really good determinant of that, right? If your average winner is, let's say, $100 and your average loser is like $300, your average loss is bigger than your average win, yeah, that's a psychology problem. That means you're not letting your winners run, or that means you're holding your losers more than you should. Right? The winner should at least be equal to your average loser, if not more. Ideally, it should be more than that. So that's a great point to look at. And then what I mentioned, trading expectancy, go on Google, type in trade expectancy calculator, and then it'll ask you to plug in your win rate, your win-loss ratio, and it'll give you an expectancy. If the expectancy is positive, just keep doing what you're doing because you're going to make money in the long run. If the expectancy is negative, there's nothing you can do to make it work. That strategy will always lose in the long run. So that is the key thing. Every prop trader that I coach needs to have that, right? And we have this whole system that we go through in our Evolve Mastermind group where we create these systems for people, accountability. But get some trading buddies, get plugged in some community, right, that are holding you accountable, where people are honest, people are being vulnerable and open and sharing their results. You need accountability buddies, right? The reason why prop traders and institutional traders make it is because they have consequences. They have a boss. They have a CEO. They have other prop traders to talk to. When you have that accountability structure, they hold you accountable. But when you're trading by yourself at home, alone, you make a mistake, you close your laptop, nobody will ever find out what you did. You know, but right? Because your account shows, you know. But it's very easy to hide behind poor trading results. So my question is an invitation to you to not hide, to be open and honest and just be upfront with where you're at, right? A lot of traders pretend online that they're doing really well, but I know the truth because I coach them, right? I know the truth. So be honest with it, right? Have integrity in trading. It's really important. Do you have any daily psychological practices? Yes. So we do this oftentimes is a visualization. So visualization simply could mean just a simple version I'm going to give you, but the one that I do is like a 30-minute to an hour visualization. And we have a recording of that I give all my traders, and they're supposed to listen to it every morning and every night. Because once you do that, you can rewire your nervous system and brain to be positive. So practices, what that would look like. You imagine yourself with your eyes closed, you do the deep breathing, And then you imagine yourself seeing the perfect technical setup that you want to get into. Imagine that. What does that look like? Then imagine yourself being super confident, pulling the trigger, taking that trade. You place your stop loss, you size your position correctly. Imagine good habits. And then also imagine it going towards your target. And then just try to feel those emotions in real time. How are you feeling? Right? Try to get comfortable with it. Right? And then imagine it coming all the way back down and stopping you out. Right? It almost hit your target, but it missed it. Imagine it coming all the way back down, stopping you out. Feel those emotions, because if you can feel it and practice that when the market is closed, when the market is now finally open, you're going to notice a different awareness, because you've already seen that picture before. You've already seen that movie before, right? When you watch a movie, if you've already seen before, you know how that movie ends. So when you know how the movie ends, you don't have any fear of uncertainty. So same way, imagine, visualize you doing good habits. And here's what people say. Yeah, Anmol, I know I need to journal. Yeah, I know I need to visualize. I'm like, you knowing it is irrelevant. Are you doing it? Right? That is what the traders, the highest levels are doing. Michael Jordan, right? Basketball, just practicing hoops. Middle of the night, nobody's watching. He just keeps practicing. Because when it's game time, guess what? He's got the most reps. So he's the one who's going to make it. Versus somebody who just market opens and he just shows up. No practice, no process, no homework, no pre-market prep. And then you wonder, why am I doing like this? Because you have the information, but you don't have knowledge. True knowledge is only when you can apply it. Otherwise, all you're doing is just gathering information, and more information will never change your life. More courses are not going to change your life. Listening to more podcasts is not going to change your life. What's going to change your life is to get plugged in on a community similar to the Evolved Mastermind. Get plugged in, learn the system, and then your only job is to execute the system. That is it. So build a system. How do you set yourself up before the trading session? So as I spoke about earlier, a habit that I have is every morning, I read something positive first. Why? Because I want to condition my mind into be in a state of positivity. Number one. Number two, some breathing exercises. Number three, at night, maybe visualize yourself trading the right way. Number four, set up these habits, alarms on your phone every 30 minutes, and just check in with yourself. How am I feeling right now? If you notice an emotion that you're not supposed to feel, get up and leave, right? You can come back in 5 minutes. So those are the things that you want to set in place. And then the other thing that I always do, which all of people in my community can attest to, is anchoring. So anchoring is a practice from NLP, neuro-linguistic programming. All the highest athletes at the highest levels, even politicians, every time they're about to go before a stage, they will do this practice. It's called anchoring. You can research more on that on time, or you can get my book, Mastering the Trader Within. It's all taught in there. And in fact, in this book, I go over everything. Teach you exact way to build a system, how to build a trading plan, journaling, pre-market prep, post-market prep. Everything is in there. And this is kind of my life's work. The same method that I use for institutions is all in here. But don't just read it. Apply it. All right. So that's what you want to do. Think of yourself as a professional athlete. You are running a business here. This is not a hobby. If you treat it like a hobby, it's going to be the most expensive hobby that you've ever taken on. Treat it like a business. If you're running a business, will you not collect the receipts? So then why is it then we're trading, we don't collect our data, right? Why is Facebook and all these companies so valuable in market cap? Because they have everyone's data. So it's not the thing, it's the data that you can collect, because the data is what helps you make decisions, not based on feel, not based on what some other trader thinks, based on actual fact, right? So you have to learn how to distinguish that. So anchoring, so every morning I live stream myself from 9 o'clock till 11 o'clock every single day. And I will get in, I will take a few deep breaths, 9:28, 9:29, I will do my anchor, which could be as simple as that. I say, let's do it, because that anchors good trading habits. But it goes, there's more covered in that, but because during our visualization exercise, we create that anchor. So then when we're in the real market environment, that anchor can get us back into the same state of mind. It's already proven in quantum physics. If you read the observer effect, it's already proven. You'll find what you're looking for and you will get the results that you create, right? Not the results that you hope to create. What do you think about positive thinking in trading? Isn't it working at all? So yeah, you're supposed to have an optimistic mindset, a positive mindset, but be careful with positive thinking on a bad trade, right? Because that's what newer traders do. That's why I don't like to talk about positive thinking, because there's more detail that go into that. because losing traders, novice traders, they're very positive, right, on their losing trades. This will come back, and well, I know I bought Bitcoin at 120,000, but yeah, it's going to come back, and it might, and I'm pretty sure it will. But what about opportunity cost? What about that capital could have been used to do other trades in the meantime while it comes back? People forget about all of those things because they're still treating it like a hobby. They're not treating it like a business. So that's one thing I want to talk about. Why not do algo trading and leave psychology aside? You can do that. I mean, that's the software that we're currently building. It's called TraderFlow. TraderFlow software, all the strategies that I teach, you can program it in there and do it. So now you're taking the psychology out of it, but there's still an element of psychology that's required, right? Because algorithms cannot see everything, right? They just can't. You can program rules on how to exit the trade, how to enter the trade, but you still have to find the trade, right? And I've seen traders, so many over the years, I've built this new system, and then they'll have a system that'll make money for 1 year, and then one bad year, they give it all back. So I personally still believe there needs to be human input in trading. We're not there yet, but there are AI tools and there's algorithmic tools that you can use to take the psychology element and minimize that. And that's what we're trying to build with our TraderFlow software, is that it'll give you insights in real time. Hey, your heart rate's spiking up. Maybe you should take a little step back. Hey, if you manage your trade like this, you could actually make 20% more money. And you can just one click apply that strategy. So that's coming. We're still in the beta phases of that software now, but it's going to be like, it'll basically turn you into a bionic trader, where now you are not reliant on technology, but you're using technology to take some of the human elements out of trading. So great question there. Why does short-term impulses so often override long-term strategies? Yeah, great question. So let me take a sip of water here. So short-term impulses, that is a human condition. It's not limited to trading. It's always going to be there. Right, all my guys in the chat room, can you relate to that? We all have impulses, right? We all have temptations. The thing is to train your mind. That's why I say master the trader within. Train your mind so that you can feel those emotional impulses and still choose to be like, thank you for sharing. So like when my emotions come in, I'm like, all right, emotion, thank you for sharing, but I'm still going to do my trading plan because I know the trading plan will work in the long run. You might be right now. My emotion might be correct. Maybe my emotion tells me to exit the stock, and I keep holding and it comes back down. Doesn't mean my emotion was wrong, right? Or doesn't mean my emotion was right. But that's not data. That's not a statistical probability analysis. What you want to focus on is not making money on the next trade. You want to make money on the sample size of trades. So that's why I say probabilistic thinking. Otherwise, you're going to get fooled by randomness. When you trade with your emotions, your gut feel, or some trader that you're following, you're not going to make it long-term in this business. And I just want to be honest with you because I over the 16 years, I've seen people come and go. It's like a revolving door. New traders come in, realize, oh my God, it's not that easy. They leave, more new people come in. But the people who stick around, they have a process, they have a system, and they have an ability that they've mastered themselves. And that's why the title of the presentation was Mastering the Trader Within. And I would ask you to come watch me do it live. I actually live streamed my whole trading live on YouTube. So if you go on our YouTube channel, Live Traders, I live streamed the whole day yesterday, whole 1.5 hour of live streaming. I only took one trade, and you're going to be able to see me do that live on YouTube, or you can just scan the QR code and watch me do it live every single day. So to what extent is poor execution a personal responsibility of the trader, and to what extent is it shaped by their environment? Great question. Poor execution is always 100% personal responsibility, right? Because see, we cannot control what the market's going to do. We cannot control what the stock's going to do. We cannot control how much we're going to make on the trade. We cannot control anything in trading. The only thing in trading you have actual control over is how much you're going to lose, because you can always get out. So execution is always a personal responsibility thing. You have to expect responsibility. It's never the market. It never is, because the market's always going to do what it's always going to do. And if you have a system, that system would have already accounted for all of that, different market conditions. So execution is always your responsibility, because guess what? Who's clicking the button? Right? Who's holding the mouse? Who's clicking the button? I'm sure it's you, right? If somebody else is doing it, then we got a different problem. But you're pushing the button. So responsibility lies with the person who pushes the button. All right. Do you think traders tend to overestimate or underestimate psychological component of performance? Yes, they underestimated by a huge margin. And that's why I'm a big fan and I participate with the Trading Psychology Conference, because I think it's the most important conference. I really do believe that, right? Meanwhile, the whole world is trying to teach you, learn this indicator, learn this chart pattern, learn this new system, learn this new strategy. But guys, why is it then that 80-90% traders still don't make it? If charts was the thing that was going to make you money, why aren't you making it right now, right? And you are here at the Trading Psychology Conference, so you know the importance of trading psychology, right? So you're already ahead of 90% of the traders out there. You're already ahead of them. They're still learning how the next indicator or this next thing, and they're never going to build a system. Like I've seen this over and over and over again. Psychology, everybody underestimates. Why is it that the hedge funds or institutions or prop firms invite me not to teach them how to trade? They invite to build systems, to psychology, for accountability, consequences, structures. That's what I'm brought in for. If those people risking tens of millions of dollars every single day are focusing on psychology, but novice traders will focus on charts because they think indicators are what going to make them more money. And I've proven that, right? If you go on my YouTube channel, Live Traders, we have tons of videos of technical analysis. They're getting 100,000 views, 50,000 views, right? 150,000 views, 500,000 views. And then I make a video on psychology, 3,000 views, right? Because people think, oh, I'll deal with that later, right? And you're never going to deal with that. Yeah, just simple. Trading is black and white. Log into your brokerage account. Look at the curve. If it's not going from A to B, then you know it's not your psychology. It's not the strategy. It's the mindset. So trading is very black and white. You cannot hide. You cannot lie to yourself. You can lie to me. You can lie to everybody else on the world. You cannot lie to yourself. Log into your trading account. It'll show you the truth right then and there. So have you seen cases where traders blame psychology when the real issue was their trading edge? That is a really good question. I would say blame maybe is not the right word, but sometimes they use it as a crutch. Oh, Anmol, I got out early because, that's just my psychology. I want to trade a system that matches my psychology. So they will use that as an excuse sometimes to say, I just didn't feel right. And I tell them, you don't feel right because have you done the visualizations? Are you journaling? Are you reviewing your trades? Are you collecting data? Oh, no. Well, okay, then it's not your psychology. You're not doing any of the work that's required to be done, right? So you can use it as an excuse, but psychology is hands down the reason. Like, because again, you email me right now. I'm going to give you my exact strategy on a piece of paper, and I'm going to prove it to you with my last 10 years of results that of me making money, and I'm going to give it to you, and you're still not going to do it because it's about execution. It's about psychology. So is lasting behavioral change possible? Absolutely. It is possible, but without, it's going to just take you longer, right? Yes, you can trial and error, try to learn on your own without a community or without accountability. But what's going to happen is you might be practicing the wrong thing and there's nobody to tell you otherwise, right? Because people say, if I practice too much, I'm going to really get it. I'm going to make it in trading. But you might be practicing the wrong thing. You might be building the wrong habits and there's nobody to correct you in that, right? With me, I'm looking at all of my traders are required every single day on our server to post what they did today, how they did this week. Accountability is created in there. So I think you need accountability. I think you need consequences in your trading. I think you should be plugged into a community. And I think as it relates to behavioral change, lasting, yes, it's possible. Now, when I say lasting change, I don't mean you're going to get rid of emotions. I'm going to go back to what I was talking earlier. You're still going to feel those emotions. I still feel them. I just choose not to act on them. I just go back to, okay, what does my plan tell me to do? What does my system tell me to do? And I'm only going to execute on the system. So I'll still feel the emotion. I'm like, ooh, you know what? This stock, it looks like it's going to go. I'm like, looks like it's going to go. What is that, Anmol? And I'll talk to myself. What does that mean? Look like it's going to go. Is that a system or is that gut feel? Oh, it's gut feel. Okay, then ignore, right? Do you think the role of psychology in trading will become more important? I think it already is the most important thing ever. And will it become more important? I don't know. I mean, it has to be. I mean, we're seeing that actually, because back in the day, only professionals were trading. Now everybody has Robinhood or a Webull, or now you can trade on Coinbase. You can trade, stocks. So now the average person has access to the stock market, which is actually a great thing because more participants. more money, more opportunity. But those traders, all they have is the app that they downloaded, or maybe a Reddit or Twitter that they're making their decisions on, or maybe they're following a trader, right? So psychology is still going to be important, more important now than ever before, because it's so easy now. You could be in a car, you could be taking a trade in the middle of night, you could be doing all sorts of things. So yes, more emotional control is required, especially now that we are progressing towards 24-hour trading, right? 24-hour trading is coming. Right? It's almost already here. Robinhood, you can already do that. But with 24 hours, now you have more opportunities to make mistakes, more opportunities to be tempted, more opportunities to feel all those emotions, right? But professionals, we don't look at any of that. When I day trade, I only trade from 9:30 till 11 o'clock. Majority of my trades are done at 9:45 to 9:50. And I leave. I physically get up and I leave because there's not good odds after that. And the only way to make a living from trading, because I heard this in the panel discussion, the only way you're going to make a living from trading is you have to day trade, or you have to be an active swing trader, right? Investing is not how you make a living from trading. Investing is investing to grow your money for the long haul. But if you're going to trade for a living and that's your only job, well, guess what? Your bills are still due monthly. You still got to pay your car payment every month, right? So long-term investing is not really going to pay the bills, right? You have to be a day trader. And the difference here is the day trader is like we're in a Formula One car. It's going fast. So psychology is way more important there. Long-term investing, you could be patient because you don't even need to look at the chart every day or every week. You can just write it. You can hold it, right? So psychology is less important there. But when it comes to short-term trading, because we're in and out every single day, psychology is like the most important thing ever, right? And it's going to get more and more important as we progress into 24-hour trading. And we have more IPOs coming out. We have, ETFs, SPACs, all these things to trade now. More temptation. So yeah, psychology is going to be more and more important. What role does physical and mental recovery play in trading performance? Mental recovery, for sure, is really important, right? And what I mean by mental recovery is like if you feel burnt out, if you feel like, you know what, I'm just not in the right state of mind, or I'm not feeling it, don't trade, right? Don't trade. Get up and leave. Take the day off. I'll do that sometimes, right? I mean, I travel and trade all the time. I was literally just a couple of weeks ago, I was in Bahamas on a cruise ship. Thank you, Elon Musk, for Starlink. We had Starlink on the cruise ship and I still traded, and I live streamed myself trading from the cruise ship. So with that, that was also recovery for me, right? So I've created my trading system in a way that I could be anywhere in the world and I can still do my job. I don't have to be home in front of my desk looking at multiple screens all day. I could be anywhere. So I can recover as I trade. But if you're a newer trader, maybe you don't have the luxury to travel and trade right now, then set up structures in your place. Maybe once a month, you're like, all right, I'm going to take the day off today. Or you know what, this weekend, I'm going to go recharge my batteries. So I always go into the woods. Maybe I go play golf. Maybe I go shoot some guns in the shooting range. I take my mind off it. And that enough is for me to recover. But I will tell you this. This is really important. And we're going to actually talk a lot more about this in my upcoming live event. We're doing a live event in Fort Lauderdale, Florida in a couple of weeks. So in that, I'm going to emphasize this a lot, because when you have systems, you actually don't need mental recovery that much because you have a system, right? You need mental recovery only because you get burnt out. You get tired. You can't handle the pressure. You can't handle the losses because you're doing random things, right? When you have a system, you don't need mental recovery because it's a system. You just follow the system. So it's as simple as that. But as far as physical recovery, really important. I will be the first one to admit, because about 3-4 years ago, and you can go watch the last Trading Psychology conference recording from me, I was much chunkier, right? I was much bigger. So at that time, I would often feel tired or lethargic. Right now that I'm getting in shape, I'm working out, I'm eating healthier, I feel better. So when you feel better physically, you will feel better emotionally. When you feel better emotionally, now your state of mind is optimal for the markets. All right, let's see here. What are some blind spot or self-lies you find the most common or problematic in new traders? Blind spots. So blind spot is that when you're not being honest, or when you're not tracking your results, it's very easy to have selective cognitive biases. We all have that. It's one of the human cognitive biases. It's called selection bias. Is that traders often end up forgetting all the bad mistakes they make. Maybe they do something that they shouldn't be doing, and then the trade works and they make money on it. Guess what? They're going to remember that trade. but they're going to forget all the times when they broke their rules and it didn't work. So it's a selective memory, right? We always remember the good trades we took. We remember all the 5 good trades I took this month, and I forget all the 20, 30 losing ones that I didn't, because you didn't track. But when you track it in a spreadsheet, guess what? Anybody in the world can lie to you. Your spreadsheet, your data is never going to lie to you. It's physically right there, right? Its proof is in the pudding. So those are the blind spots. Those are the self-lies. And I think that's why it's really important to get plugged in to a community like Evolve Mastermind, right? We have traders from around the world in our community, and we're holding them not only accountable, we're helping them create systems. And guess what? We can measure the progress of people that are now actually consistently making a living from trading. And I would like for you to be a part of that and start trading professionally rather than just trading based on your feel, because feelings will always let you down, right? Many traders struggle to adapt when market conditions shift. What mental frameworks help traders stay flexible and avoid rigid thinking? So I think what you need to be is you need to be rigid with your rules, but flexible in terms of adjusting with the market environment. So when it comes to what patterns are you going to trade, how much are you going to risk on that trade, right? That needs to be rigid. That should not be flexible, right? I lose the same amount on every single trade when I lose. Because let's say if all of my losers are minus $1,000, minus $1,000, minus $1,000, and then a winners are, let's say, 2,000, 3,000, I only need to be right 38% of the time. Just think about that. You can take 100 trades and you only win on 38% of them, but your average winner is twice the size of your losers. Even with a 38% win rate, you're going to make money. Even with a 40% win rate, you're going to make money. So you don't even need to be right half the time. You can win 4 out of 6 and still make money with a higher win-loss ratio. So that's what I talk about expectancy. Win-loss ratio is meaningless. I know traders that have 90% win rate, but then one bad loser, bam, they give it all back. So is win rate really important? By itself, it's irrelevant. It's not important at all. What you need is your higher win-loss ratio and the positive expectancy. So that's one of the things that you got to really keep in mind, especially when it comes to trading systematically. And I would implore you guys, after seeing this over and over, I want to save you the headache and I want to save you the trouble, right? Is to build a system. Systematic trading, you can do that for the rest of your life. Gut feel trading, you're going to burn out. I've seen people come and go in this business. I even worked at prop firms where traders are $1 million traders, making millions of dollars every year. 10 years later, they're burnt out. They do something crazy. They do something stupid. They burn out. It's because it's not a system. Systematic traders always win. All right. Many traders struggle to adapt when market conditions shift. So here's the thing. If you have, again, I'm going to keep repeating myself, but it's like when you build a system, the system should have already accounted for those market conditions. Because newer traders, here's the thing. That's the reason why I am not a big proponent of teaching people shift with market environment, because as a newer traders, you don't know what the market environment is. So you're going to use that as an excuse. I'm in this trade. I should be holding it to my target. I bought Microsoft at, let's say, at $150. I'm going to sell it at 160. It's at 155, halfway to your target. And then you make up an excuse. The market looks tricky. I'm going to just get out early. So that's why I don't teach that, because newer traders will use market environment as an excuse to break their trading plan. Type it in the chat if somebody can relate to that, right? You're going to break your plan. I know it. So you will end up breaking your plan if you rely on market environment. But if you have a system, that system would have already been tested in both a bull market, in a bear market, in a sideways market, and you know that you're just being the casino. Let him trade. After a sample size of 50, 100 trades, you're always going to make money with the system. In your opinion, what psychological traps are traders most vulnerable to in current market cycle? Current market cycle, the biggest trap that I see that people are falling into is listening to pundits. Listening to everybody online. But Michael Saylor said, I should buy Bitcoin at 120. It's going to $1 million. Michael Saylor said, buy MicroStrategy, at 400. And now it's at, $100. You're down 90%. Great job. Right. So don't listen to people. If this year is any example, everybody's been wrong. All the people on CNBC, Tom Lee, oh yeah, buy Ethereum at 3,000. It's going to 5,000. And now it's under $2,000. His stock is down 90%. So I'm saying that to tell you that nobody knows better than you. Nobody knows better. Don't get in the habit of putting even me on a pedestal. Say Anmol knows something. I don't know anything. I'm just following my system, and the system is going to work over time. So the key is in this market environment, people fall into the traps. They might be in a long position, but then Robert Kiyosaki, who is going to tweet that the market's going to crash, so I sold my position. And then the market's hitting all-time highs. So if you listen to people, people are going to let you down. You're going to lose money, right? And you're going to not even learn anything because you just blindly followed somebody. So don't blindly follow anybody. Make your own trading system if your goal is to be a professional, right? My goal is not to create traders with big moonshot trades. My goal is to create professional, systematic traders that you can build a career off of and you can make a reliable income from trading. That's my goal. And if that's the style of trading that you're interested in learning, I'm more than happy to help you. But if you're looking for the next hot stock pick, there's many other places you can go to for that. I'm not one of them. All right. So hopefully that was helpful. And I would love to connect with you. Feel free to reach out to me on X or Instagram or on YouTube. But there's plenty of resources for you. And feel free to scan that QR code. Thank you, Alex.
Thank you so much, Arnold. There's been a lot of questions, and yeah, I'm happy you answered all of them. Thank you for your time, and thank you for supporting us. Well, guys, so yeah, so hold on, please. Stay here. There will be another speech by Peter Robbins. So 4 minutes, and we will get back. Thank you. So we are back, and thank you for staying with us. So we have a final speech by Peter Robbins. Peter Robbins is a highly experienced trader who spent over 50 years navigating the financial markets. He has the experience working in finance and investments across the insurance, real estate, and medical technology industries. So Peter has an online community of over 100,000 followers. Oh my God, so much people there. And Peter's trading style involved to include day trading futures, swing trading stocks and options, and position trading ETFs. Peter's speech will be a moment. I lost it. Peter's speech topic will be Forearmed is Forearmed, the psychological traps every trader faces. Peter, thank you so much for joining, and the stage is yours.
Thank you, Alex. I'm just going to put on my slides here. Do screen sharing. Screen sharing. Where's my share screen? Select the share. Okay. Let me.
Yeah,
there you go.
Your screen.
Okay. Well, thanks, Alex, for that introduction. And it's always tough to be the last speaker, especially when it's almost dinner here, and I think it's almost bedtime over where you are. So anyway, but before I begin, I'd just like to thank you, Alex, and your team for inviting me to participate in this year's Trading Psychology Conference. I'm humbled and honored to be included alongside Dr. Brett Steenbarger, a longtime mentor of mine. I'm also excited to be sharing the stage with Agnieszka and Sue, two friends I've collaborated with over the years and admire greatly. Trading psychology has been a major focus of my work and the community you talked about. When Alex asked me to choose a topic, I immediately thought of an area many traders underestimate: the psychological impact of actually trading. So many people approach trading with a heavy focus on strategy, with little awareness of what they'll actually encounter when they put real money on the line. Whenever we're learning a new skill or trying to improve performance, a few key insights can make a significant difference. My hope today is that some of the insights that I share, you can take back to your trading and hopefully find some improvement. This is a professional conversation for professional traders. No therapy, no slogans, just the patterns that reliably show up when money and uncertainty collide. My aim is simple: protect your decision-making under pressure by understanding the psychological patterns that are inevitably emerge in real trading. Because the market doesn't reward what you know, it rewards what you can execute consistently. Just going to start off with a little background on who I am. My name's Peter Robbins. I'm Canadian, live near Toronto, Ontario. Just also starting off with a shameless plug on a book that I've written called The Trader's Journey, coming out actually next week. The book, like this talk, focuses on key areas traders often overlook that quietly prevent short-term success. Personally, I'm a long time, well, you can see 50 plus years, that's a long time, retail trader primarily. Most of the time is spent trading part-time while working full-time in finance and investments. I enjoy being part of the trading community, coaching, mentoring, and learning along the way. As a trader never stops learning new lessons. Over many years of market cycles, I've seen the same issues repeat again and again. Different markets, different tools, but the same human problems. So the promise: many traders enter this business believing anyone can do it. Easy money, little effort, We're bombarded daily with promises from supposedly successful traders offering simple strategies, guaranteed success, and unlimited riches. And to be fair, there are time-tested approaches that genuinely have an edge. If followed consistently, many would produce positive returns over time. But anyone who actually enters a trade, or even tried to, quickly discovers a reality they weren't prepared for. Decisions aren't as easy as they expected. And when decision quality degrades under pressure, the edge you thought you had becomes purely theoretical. Most traders don't fail because of bad strategies. They fail because they walk into a psychological battlefield completely unarmed. Today is about building protection, rules, routines, and guardrails so you can keep executing when it gets uncomfortable. This isn't about better setups. It's not about mastering emotions. It's about protecting decision quality under pressure. The goal is to build confidence in yourself, your plan, and your ability to execute when it matters most. Why this talk exists. When traders encounter inevitable struggles, psychology is often treated as optional. Most people start trading thinking it's a skill problem. They discover too late it's an identity problem. Strategy gets attention, psychology gets postponed. Eventually, it becomes the bottleneck preventing progress. In fact, it often becomes a primary reason traders continue losing money until they either address it or run out of capital or just give up. You can have a solid approach and still bleed from execution errors that repeat, especially after wins, after losses, or during boredom. Most traders know what to do, and we talked about this during the panel discussion. They just can't do it consistently. Like we discussed at the panel, why traders know what they do and don't do it. If you're human, you're vulnerable here. And addressing psychology isn't self-help. It's a risk management, protecting your edge from you. So the real risk in trading. The market is uncertain by design. We're paid to operate inside uncertainty, not to remove it. You can never get rid of uncertainty. Everyone understands market risk. What we consistently underweight is the psychological risk. How stress quietly changes what we do. The real risk is decision quality under stress. If you want consistency, you can't just manage positions. You have to manage the conditions that cause bad decisions. Risk isn't just a number, it's behavior. Patterns repeat. You just heard that in the previous presentation. Patterns repeat over time. That's the foundation of technical analysis, across instruments and cycles. But over time, you realize something else. Charts change, technology changes, market structures changes, but human reactions don't. The same wiring drives trader behavior, the same predictable traps. Think of FOMO as an example during the dot-com stocks, crypto, meme stocks, different eras, same response. If you stay in this business long enough, you learn that trading is a craft built on repetition, feedback, and humility. The roadmap, what we're going to look at is the diagnosis first and protection second, right? We're trying not to eliminate emotion. We're building a process that still works when emotions show up. First, we'll take a look at the psychological landscape, what's inevitable, what reactions are inevitable. Then we'll focus on, I've picked 5 major traps that derail execution. And then finally, we'll talk about guardrails, how professionals can contain them, building your process to counteract these traps that we encounter. Psychological landscape. What happens psychologically isn't a character flaw. It's default wiring. As humans, we're built to protect ourselves. These responses are inevitable. The goal, part of the title of the presentation, is to be forewarned. A lot of people approach trading not even aware that what they're going to encounter. So what we want is no surprises. If you understand the landscape, you stop arguing with it and start designing around it. A lot of trading pain comes from bargaining for certainty. Professionals accept uncertainty early. It never goes away. We always have incomplete information. Everyone else keeps negotiating with it and pays for that negotiation with bad decisions. Before we look at the traps, we need to accept a few foundational truths. So first of all, discomfort is permanent. We operate in an uncertain environment with our hard-earned money on the line. That's the definition of discomfort. Discomfort is part of the job. If you require comfort to execute, you've built a fragile process. Comfort is not a prerequisite for good execution. The goal isn't to eliminate fear. The goal is to trade well while fear is present. Steadiness beats feeling good. Now, outcomes are noisy and misleading. One trade can lie to you. A streak can lie to you. Even a month can lie to you. If you let outcomes trade your behavior, you'll hardwire the wrong habits. Short-term results do not equal skill. Both winning and losing can reinforce bad behavior. So instead of watching your P&L, focus on your process and rules, all the inputs that you can control. Track decision quality first, results second. Now, part of the psychological landscape, under stress, your brain does what it's evolved to do, which is to protect you. Our brains evolved for threats. So that's why we overreact to losses. We're hunting certainty. We're seeking control. These instincts are useful for survival, but terrible for trading. Your initial reactions are often the opposite of what's required. Trading demands probabilistic thinking, not emotional reactions. That requires structure and training. So default wiring meets unnatural environment. The human brain plus uncertainty plus money equals predictable distortions. We operate with unlimited choices, constant feedback, and immediate reward or punishment. Instead of stopping impulses, we rationalize them. That's why psychology is never solved. You don't graduate from being human. But you can spot the pattern sooner and contain it faster. That's going to be the goal. So I just want a quick reflection question for everyone. Just before we discuss the common traps, I want to take a moment for each of you to reflect on your own personal situation. What is the one behavior you keep repeating that you swore you'd stop? Think about that. Could be about your entries, could be your exits or sizing, maybe over trading, revenge trading, skipping trades. Remember your answer. Because often the traps that we're going to talk about cluster around these. So just want to make a point that, like I say, the traps are not mistakes. They're predictable human responses under pressure, not personality flaws, not something to be ashamed of. They are structural mental risks, predictable and therefore manageable. We'll treat them like any other risk. We'll identify the leak, build a guardrail, and repeat. So, the first trap, the need for certainty. This trap looks responsible. It feels like caution, but it often functions as avoidance. Craving certainty delays decisions and turns analysis into avoidance. You're not reducing risk. You're avoiding the feeling of risk. Here's the tell. Are you doing more thinking and less doing? When you finally act, it's later, sloppier, and often at a worse price. Common symptoms, overanalysis, endless scenarios, stacking confirmations. We need one more confirmation. Professionals don't wait for certainty. They define enough and execute. If your plan doesn't force decisions, your emotions will. You don't need certainty. You need a plan that survives uncertainty. Some guardrails, defining sufficient criteria, pre-commit to executions, and review missed trades like they were losses. The second trap we're going to look at is loss aversion. Let's be honest, the worst part of trading is losing money. The pain of loss outweighs logic. Loss aversion quietly destroys expectancy. Symptoms include cutting winners early for relief, holding losses longer, hoping that they'll turn around, and avoiding valid trades after losses. Loss aversion is the invisible hand on your mouse. If you can't take the loss, the position sizing is wrong, often wrong, full stop. Risk isn't what the chart says. Risk is what your mind does when the trade goes against you. Guardrails that you can look at, hard stops, non-negotiable. Rational sizing. Often people will put on too much size and then their risk is too much for them to handle. And then pre-commitment rules. Next one. Next trap. Identity and ego. The moment trading becomes personal, it becomes expensive. Ego wants proof. It wants to be right. Your identity is fused with outcome, and your trade becomes about self-worth. Objectivity collapses. The urge to get it back isn't about money, it's about identity. But the market isn't a therapist. When emotions rise, procedures should tighten. If they loosen, control is already gone. Symptoms, revenge trading, proving trades and breaking rules to repair self-image. Some guardrails, you got to focus on separating you from the trade. Defining the A trades clearly, and then some post-loss cool downs. Instead of revenge trading, walk away. I think we just heard that in the last presentation, right? Be willing to walk away. Fourth trap, recency bias. We often trade our last mistake. Recent outcomes feel more relevant than they actually are. Good systems look bad in small samples, and bad behavior looks brilliant during a lucky streak. That's how traders get trained in the wrong direction. Common symptoms would be system hopping. Had a couple losses, you try another strategy, another system. abandoning the plan after a drawdown, even though your testing was shown that a drawdown that you're experiencing is often reasonable. And often you abandon a plan just when it's ready to start working again. Overconfidence after a win streak, increasing size, putting more risk on when you should be actually taking it off, or staying consistent. And guardrails, sample size rules. Don't start switching systems or trading your rules just after a couple trades. Minimum time in a plan, commit to it, stick to it, do 100 trades before you make any changes. And if you are going to trade, make sure they're very controlled changes, that you have a logic for it, a reason for it, a retesting, and you make it according to that. The fifth trap, the discipline illusion. Now, discipline matters, but discipline alone is very fragile. If your process only works when you feel good, it's not a process. Willpower runs out, and design beats motivation. I know there's a lot of talk about discipline and being motivated, but ideally, you need a system that doesn't require it. The symptoms, rules are followed only when it's easy. Sloppy weeks after great weeks. And then friction triggers impulsive decisions. Guardrails, reduce decisions. Try to standardize your process as much as possible. Automate risk where possible. And have default routines, checklists, build good habits, build habits around your process. Build routines that you can follow on your worst day, because that's when the damage happens. So I just want to talk a bit about from fixing yourself to containing risk. A lot of people think they need to fix themselves somehow, but you can't remove emotions. A lot of people want to be a robot trade, think you have to trade like a robot, but you can not remove emotions, but you can become consistent. That's the goal. The goal isn't calm, it's control under pressure. Containment is professional. Self-judgment is noise. So, psychological risk management. So don't think of guardrails as restrictions, but think of them as protection. When decision quality drops, your edge disappears. Some examples would be daily loss limits, maximum number of trades, mandatory breaks, and cooling off rules. Process over outcome. If you want to improve, measure what you can control. We talk a lot about evaluating your trades, looking at what you did. So measure what you can control. Don't ask, did I make money? Ask, did I follow my rules? Did I manage risk properly? Did I execute well under pressure? Outcome is a lagging indicator. Behavior is a leading indicator. So some routines that can protect you. Routines carry you when the motivation disappears. Review turns experience into skill. Without review, you repeat the same year of trading over and over. Some examples would be pre-market preparation. Again, post-trade review, journaling behavior, and then time away. These are all topics that were covered in a lot of the speeches today. Take a break when the market condition is not aligned with your strategy. Identity shift. Okay, looking at the identity you bring to the trading has a big impact. Instead of, I'm a trader making money, you think about a risk manager protecting decision quality. This identity stabilizes when your P&L swings. Forewarned does not equal fearless. Being forewarned doesn't change how you feel. You'll feel fear. You'll feel discomfort. You'll experience doubt. Feeling it doesn't mean you're failing. It means you're trading. Forewarned means you shouldn't be surprised. Forearmed means you've built protection. So the idea today was to forewarn so that you can become better forearmed through the guardrail protections. The win is catching the trap early and reaching for guardrails faster. So I want you to have one practical takeaway from today. So right now, again, we're not trying to fix your whole personality. We just want to pick one trap. And again, going back to the reflection, what you were thinking, what is the one major one that you keep going back to, the rule that you keep breaking. Pick one trap and then write one guardrail and implement it this week. We talked on the panel why traders continue to do things they know that will hurt them. This is a great exercise to stop this recurring behavior. And again, you're not going to fix everything all at once, but as you review your trades, as you look at the traps you're falling into on a regular basis, make it an exercise to build a guardrail and implement it and stick to it. Simple rules and keep it simple. Simple rules beat complex intentions. Final line, most traders prepare for the market, but not for the person they become under pressure. You can pay psychological cost deliberately with structure or accidentally with impulsive decisions. The difference between being forewarned and being forearmed. Trading is a business that requires time to develop while trying to avoid costly drawdowns. The sooner you can identify the traps that you find yourself vulnerable to and build a process to counteract, the sooner you will be on your way to success. I hope you have found this helpful, and I wish you all the best in your trading. Thank you, Alex, again. It's been an honor to speak today. And one last shameless plug, and also my Twitter or X handle there is, feel free to reach out. And my DMs are open to anyone that wants to have a chat. So thank you.
Thank you so much, Peter. It was what a beautiful and a kind of academic speech you've done. So thank you so much. And I suppose people will ask for this presentation, so they can message you in X, right, and ask for this presentation.
Yeah, sure. Or hopefully maybe you can make it available as well, or I can make it available to you. But
okay,
we'll figure that out. But yeah, I'm open on X, so anyone wants to reach out, feel free.
Thank you so much. So because it's very, very useful. We have a number of questions. So the first question, what is one trap that newer traders underestimate, and how should they prepare for it?
Sorry, Alex, I'm just getting my screen set up so I can see the questions as well. Sorry.
Yeah.
Sorry, so the question was, what's the one trap that most encounter?
Yeah. So what is one trap that new traders underestimate?
Right. So I think as new traders, and this was really the reason I wrote the Trader's Journey. And it's not just for new traders, but primarily a lot of people approach trading with very unrealistic expectations, right? And part of the idea was to provide a process or roadmap, starting from having realistic expectations, which I think is a big one. And we talked about a little bit about that today, right? And I think it came up a few places where a lot of people think that they can make a living trading long-term with very little capital. They have very unrealistic expectations around that. And then just like the talk today about these, the issues that you're going to encounter, they're just not even aware of them, right? They just, until they actually start trading. But my biggest point of realistic expectations, understanding risk, what risk you're really taking, so that you start off without jumping into the deep end, right? You learn the steps and processes slowly, with hopefully with little risk on the line, with instruments that maybe aren't as volatile as you hope to get into. One of the big traps is that they come with expecting big money with little capital, and in order, just the logic financially, in order to make those type of returns or that type of money requires by definition huge risk, right? Because you're not going to make, if you have $1,000 and you make 10% in a year, you're not going to make much money. But if all of a sudden you start looking at options or futures or Forex, and where there's huge leverage available, then but the money management rules also just don't support that, right? So they end up just blowing up account after account. So anyway, so that's a big trap and niche for new traders, is just having realistic expectations.
Okay. Yeah, thank you so much. Another question, Peter, how can experienced traders avoid the complacency trap after they have achieved a period of consistent success?
The complacency trap, I guess that means that you just become bored or you become complacent. Ideally, that's where everyone wants to get to, right? They want to be complacent in their trading. They want it to be a process that's easy to follow, that provides consistent profitability or consistent returns. And they can, I think if a lot of people say the idea is to become bored. If what you're asking, though, is that what happens to a lot of people, they become bored, and then it comes down to the point of why are you actually trading, right? So in my book, I cover this, where I talk a lot about, should you actually be a trader? So a lot of people approach trading, they're not traders, they're gamblers. They're in it for the excitement, they're in it for the thrill. That's a whole other psychological issue, right? That they may be addicted to gambling. They may be, again, just wanting it's like going to a casino, right? They go there for, even though they know the odds are against them, they love that thing, the thrill of it. So I guess the idea of, watching yourself, again, it comes back to all the things of monitoring your emotional state and monitoring why you're putting on trades, right? And if you find you're putting on trades because you're bored, you just got to get that in check, right? And hopefully the guardrails that you've put on around what you trade, when you trade it, and how you trade it are going to help you identify that situation, right? But those are, chances are, if you're a long-term professional trader, you've got over that aspect of your personality, because if you still had it, chances are you wouldn't be consistently profitable. You continue. This happens to a lot of people, right? They make money. They think that this is the market's money, or this isn't my money. Really, it's the market's money. It's given to me, so it's easy money. I can take on bigger risk, and I'm playing with the market's money as opposed to my own. And they continue to do like one step forward, one step back, one step forward, two steps back, and they're not. If your equity curve isn't going from again the bottom left-hand corner to the top right, chances are you're succumbing to that exact issue, right? So, and I just want to make the point also, we had that panel conversation about why do traders continue to do what they know is going to hurt them, right? So this is exactly what we're talking about, right? Chances are, when you're putting on that trade, it's the wrong thing to do, right? So again, it's about recommitting to it and sticking to your rules. So
Okay, thank you so much. And the last question, how to avoid missing opportunities? I suppose fear of missing out while waiting for the right setup or environment.
Yeah, well, there's a saying that there's always a bull market somewhere, right? So I guess it's there's always opportunities, but I think patience is critical in trading, right? And it's interesting here, right? Because people, FOMO is big. They don't want to miss an opportunity. They want to keep compounding their returns. But oftentimes there's an environment where if you're participating in it, you're probably going to reduce your capital instead of increasing it, right? So having the ability to step away. I'll give you an example right now as an example, right? So the market for the last, 4 months has been basically just this big choppy sideways range, right? So a lot of people, especially that aren't day traders, maybe just standing aside. Like I know myself, I'm not doing a lot of trading in this environment. I'm waiting for the trend to start again, right? So, so oftentimes people think this mindset of, and we bring this from the work environment, right, where more work equals more money. And it's not necessarily the case, right? Oftentimes less is more, especially when it comes to trading, because oftentimes you're in there, you're putting on trades that you shouldn't be, you're losing money, and you would have been farther ahead if you just said stand aside when you recognize the environment isn't right for you, right? So.
Okay, thank you so much. Thank you for the answers. Thank you for your beautiful presentation, and thank you for supporting us and joining this conversation.
Thank you, Alex. Again, thanks for inviting me, and I'm glad I was able to participate. Thank you.
Thank you. Okay, guys. So, yeah, as we are coming to the end of this conference, I want to ask you a question. Not about trading results, not about strategies, not about markets, but about you. What did you notice about yourself during these sessions? Please write it in the chat. Over the past hours, you heard ideas, frameworks, and insights from extraordinary speakers. You heard about discipline, about emotional regulation, about routines, about cognitive biases, about traps, about performance under pressure. But the real value of this conference is not in what you heard. It is in what you will do differently tomorrow morning when you open your charts again. Because transformation in trading doesn't happen during conferences. It happens in small moments that nobody sees. It happens when you stop yourself from reverse trading, when you follow your process after a loss, when you step away from the screen instead of forcing trades, when you review mistakes without attacking yourself. Performance is built in those invisible decisions. There is a myth in trading that success belongs to people who control markets, but markets cannot be controlled. Another myth is that success belongs to people who control emotions, but emotions are not enemies. They are signals, they are information. The traders who succeed long-term are usually those who learn to control something much more realistic, their behavior. One of the most powerful shifts traders can make is moving from outcome obsession to process commitment. Outcomes are seductive, they are visible, they are measurable, but outcomes are also partly random. Process, however, is something you can influence every single day. And over time, consistent process builds consistent performance. I also want to highlight something deeply human about trading. Trading can be lonely. It is you, your screen, your thoughts, and your decisions. That is why building communities like this conference is so important. Because performance grows faster when people share knowledge, mistakes, and experiences. And this conference is not just an event. It is a part of building global conversation about human performance in trading. I want to personally thank our incredible speakers for their knowledge, generosity, and time. I want to thank our media partners, Forex24, Earn.eu, Teton Trades, and everyone who helped make this conference possible. I want to thank my team, Andre and Manish. Thank you guys for helping me organizing this conference. And most importantly, I want to thank you, because investing time in self-development is one of the most difficult and most valuable investments any professional can make. Before we finish, I want to leave you with one final thought. Markets will always test you. They will test your patience. They will test your discipline. They will test your confidence. They will test your identity. And sometimes they will test your belief in yourself. But trading mastery is not about passing those tests perfectly. It is about showing up, learning, adjusting, and continuing to grow. The best traders are not those who never make mistakes. They are those who build systems that allow them to learn from mistakes faster than others. Thank you for being part of the Trading Psychology Conference 2026. I hope the ideas you heard here will not stay notes in your notebook, but become habits in your trading. And I hope we will meet again next year. Thank you so much for coming here and for being with us, and have a good evening and night. Bye, guys.